Unit 18, Retirement Plans, including ERVISA issues and educational funding programs. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 18. A. Recall the features of traditional, Roth, and simplified employee pension plan individual retirement accounts. Learning Objective 18. B. Recognize the tax treatment of distributions from IRAs. Learning Objective 18. C. Differentiate between the different types of employer-sponsored qualified retirement plans. Learning Objective 18. D. Identify the characteristics of a 403B plan. Learning Objective 18. E. Contrast qualified and non-qualified retirement plans. Learning Objective 18. F. Identify the tax treatment of distributions from qualified plans. Learning Objective 18. G. Identify the purpose of the Employee Retirement Income Security Act of 1974 and its primary features, including the fiduciary obligations under the Uniform Prudent Investor Act. Learning Objective 18. 8. Compare the differences between the two major types of education funding programs. Learning Objective 18. I. Contrast UGMA and UTMA accounts. Learning Objective 18. J. Recall when health savings accounts, HSAs, may be used. Your exam will include approximately 7 questions from the topics covered in Unit 18. Introduction. Retirement plans allow investors to accumulate resources to fund their retirement. Individuals accomplish this through business-sponsored retirement plans, personal plans, or individual and corporate retirement plans. To encourage Americans to save for retirement, Congress has passed legislation that allows investors to invest in certain retirement plans on a tax-deductible and/or tax-deferred basis. Throughout this unit, we give you the contribution limits for all plans described that are current for those filing 2021 tax returns. It is highly unlikely that any of those numbers, other than perhaps the IRA contribution limit, will be asked on the exam. Therefore, you should consider these as included for reference purposes, not for testing. Lesson 18.1. Individual Retirement Arrangements. Learning Objective 18. A. Recall the features of traditional, Roth, and simplified employee pension plan individual retirement accounts. As with so much in this course, there are similar terms with sometimes dissimilar meanings. Here is a useful list of terms used in the discussion of retirement plans. Tax deferred. Simply, income tax is put off, deferred, to a later time. In most retirement plans, tax on the amount of the contribution is usually deferred until withdrawal. Tax on the earnings is always deferred until withdrawal. Qualified plan. An employer-sponsored plan, such as a pension, 401k, or 403b, where the contributions are made with pre-tax dollars and earnings in the account grow without any tax, tax deferred, until the funds are withdrawn. Qualified. This term by itself means that contributions are made with pre-tax dollars and earnings in the account are tax deferred until the funds are withdrawn. This can apply to either a qualified plan or an IRA. Non-qualified plan. An employer-sponsored plan, such as a deferred compensation plan, where there are no tax advantages other than that the payout is not received until sometime later when the individual should be in a lower tax bracket. Another advantage is that the employer can discriminate between employees. The term can also apply to an annuity purchased on an individual basis outside of a retirement plan, as will be described in Unit 24. Deductible contribution. The contribution made by the individual, whether an employee contribution to a qualified plan, such as a 401k plan, or by any individual to an IRA. This means the amount contributed is pre-tax or otherwise deductible on the tax return. Non-deductible contribution. A contribution to a qualified plan or an IRA that is made with after-tax dollars. The funds do grow tax-deferred, but there is no tax benefit derived from the contribution. Take note. Although individual retirement arrangements is the technical IRS term, not tested, because everyone refers to these as individual retirement accounts, IRAs, we're going to use the common phrase to avoid confusion. Individual retirement accounts, IRAs, were created to encourage people to save for their retirement. Most individuals with earned income can open and contribute to an IRA. 3 types of IRA are available, with different contribution, tax, and distribution characteristics. Traditional IRAs, Roth IRAs, and simplified employee pension plan, SEP, IRAs. IRAs are not to be confused with qualified plans or non-qualified plans used by businesses. Later in this unit, we will cover topics such as pension plans, 401k plans, and deferred compensation plans. At this point, keep in mind that a qualified plan means that it meets the IRS requirements for the contributions to the plan to be tax-deductible and the earnings to grow tax-deferred. Non-qualified plans do not enjoy most of the tax benefits of qualified plans. Take note. Although we may include some actual contribution limits, it is unlikely that you will have to know any others than the IRA and covered L numbers. Traditional IRAs. The first of the IRAs we'll cover is generally referred to as the traditional IRA, although there is no such term in the IRS regulations. This was the first IRA, and as others have been introduced, this first one acquired its name. A traditional IRA allows a maximum tax-deductible annual contribution of the lesser of $6,000 per individual or $12,000 per couple, or 100% of taxable compensation for the taxable year 2021. The income and capital gains earned in the account are tax-deferred until the funds are withdrawn. Compensation for IRA purposes. For purposes of contributing to an IRA, the IRS considers the following to be compensation: wages, salaries, and tips, commissions and bonuses, self-employment income, alimony, and non-taxable combat pay. Take note. Asterisk for divorce decrees signed prior to January 1, 2019, alimony is considered earned income to the recipient. That makes it eligible compensation for purposes of an IRA contribution, not compensation for IRA purposes. For purposes of contributing to an IRA, the IRS does not consider the following to be compensation: capital gains, interest and dividend income, pension or annuity income, child support, alimony, and passive income from DPPs. Although it is taxable, income from required minimum distributions, RMDs, is not compensation for the purposes of an IRA contribution. Take note. For divorce decrees signed after December 31, 2018, under the TCJA of 2017, alimony payments are not considered compensation. Alimony is not deductible by the payer and is not taxable to the pay. If the date of the divorce decree is not given, assume it is post-2018 and is not compensation for IRA purposes. Catch-up contributions for older IRA owners. The Economic Growth and Tax Relief Reconciliation Act of 2001, EGTRA, was the source of the legislation permitting certain individuals to make additional contributions to their IRAs. Individuals aged 50 and older are allowed to make catch-up contributions to their IRA as above the scheduled maximum annual contribution limit, which will enable them to save more for retirement. These catch-up payments can go either to a traditional IRA or to a Roth IRA. Year 2006 and later. Additional catch-up amount allowed, $1,000. Test topic alert. The exam may want you to know that the EGTRA is responsible for the catch-up provisions. Any taxpayer of any age who reports earned income for a given tax year may contribute to a traditional IRA if one spouse has little or no earned income and a joint tax return is filed. A spousal IRA may be opened for that person, and the contribution limits are the same as for any other IRA. Practice question. One member of a married couple in their 30s earns an annual salary of $45,000, while the other earns $2,000 annually from a home-based business. If they file a joint tax return, their maximum IRA contribution for the year is A. $6,000, B. $8,000, C. $12,000, D. $14,000. The answer is C. When one spouse's annual earnings are less than $6,000, the spousal IRA benefit permits that spouse to contribute the maximum as long as a joint return is filed showing combined income of at least $12,000. In this case, their income exceeds that, so they can each have an IRA with a contribution of $6,000, making for a total of $12,000. Choice C. Please note that when using the spousal IRA, the higher earning spouse cannot have more than the maximum contributed to their account, currently $6,000. One can't look at this and say the couple has $12,000 to be split however they wish. If this question had stated the couple were in their 50s, then, because of the catch-up provision, $14,000 would have been the correct choice. Time for contributions. IRA contributions for a specific taxable year may be made any time from January 1 of that year through the required filing date of that year's return, generally April 15 of the next year, unless the 15 falls on a holiday or weekend day. If the individual obtains a filing extension, the deadline is still April 15. Test topic alert. The exam may try to trick you into thinking that you can make a contribution later than April 15 if you have received an extension to file your taxes. You can't. You should know that an extension does not give you more time to pay your taxes. It only extends the time that you have to file your return. Excess contributions. Annual IRA contributions exceeding the maximum allowed are subject to a 6% penalty tax if the excess is not removed by the taxpayer in a timely manner. Roth IRAs. Much of what has been stated about the traditional IRA applies to the Roth IRA. What is important are the differences. The most significant difference relates to the taxation of contributions and withdrawals. Contributions to Roth IRAs, unlike those of traditional IRAs, are not tax-deductible. And earnings are not merely tax-deferred. They can be tax-free. Earnings accumulated may be withdrawn tax-free, 5 years following the initial deposit, provided the account holder is 59.5 or older. The money withdrawn is used for the first-time purchase of a principal residence, up to $10,000, or the account holder has died or become disabled. Regular contributions may always be withdrawn tax-free because they are made with non-deductible contributions. Practice question. Among the requirements for accumulated earnings in a Roth IRA to be withdrawn free of taxes: A. The owner of the account is at least 72 years old. B. The money is withdrawn for a first-time purchase of a vacation home. C. The initial deposit to a Roth IRA was made at least 5 years ago. D. The owner's spouse is declared disabled. The answer is C. The first requirement for tax-free withdrawals from a Roth IRA is that the initial deposit to a Roth must have been made at least 5 years ago, choice C. The other primary requirement is that the owner must be at least 59.5, not 72. If the 5-year requirement is met, then owners under 59.5 can receive tax-free distributions of accumulated earnings they wish to use, up to $10,000 for a first-time purchase of a primary residence, not a vacation home. The disability requirement only applies to the owner of the Roth, not a spouse. Contribution limits. Contribution limits to Roth IRAs are the same as those for traditional IRAs. Like a traditional IRA, contributions may be made at any age as long as the taxpayer has earned income. An individual may contribute to both a traditional and a Roth IRA, however, the maximum combined contribution is $6,000 or $7,000 if 50 or older. Eligibility requirements. Unlike the traditional IRA, there are limits placed on Roth eligibility based on income. Anyone with earned income is eligible to open a Roth IRA, provided the person's adjusted gross income, AGI, falls below specified income levels. The following numbers, which are never tested, are effective for those filing a tax return for 2021. A single person with an AGI of less than $125,000 may contribute the full amount to a Roth IRA. The ability to contribute to a Roth IRA is gradually phased out if the taxpayer's AGI is between $125,000 and $140,000. For married taxpayers who file joint tax returns, the AGI limit is $198,000, with the contribution phased out for couples whose income is between $198,000 and $208,000. Adjusted gross income, AGI. Adjusted gross income, generally referred to as AGI, is computed on the bottom of the first page of Form 1040. It might help you to take a look at yours. When you do your taxes, you begin by listing all of your earned income, salary, wages, and bonuses, plus other income such as interest and dividends, capital gains, alimony received, and profits from a business you may own. From that total, you deduct certain items to arrive at the AGI. Among the more testable items that are deductible are traditional IRA contributions, alimony paid as part of a pre-January 1, 2019 divorce decree, self-employment tax, and penalties paid on early withdrawal from a savings account. Test topic alert. Please note that although tax-exempt income from municipal securities is shown on Form 1040, it is not included in AGI. Take note. These eligibility numbers will not be tested because they change every year. It is the concept that is important. Roth conversions. Anyone with a traditional IRA is permitted to convert it to a Roth IRA, however, there are income tax consequences. Basically, the entire amount converted is added to the investor's ordinary income. As long as the funds are moved in a direct rollover trustee to trustee, or, if distributed to the owner, are rolled over within 60 days, there will be no 10% early distribution tax penalty for those under age 59 and a half. If some portion of the contributions to the traditional IRA were made with after-tax money, the IRS uses a proportionate system to determine how much is non-taxable. But that type of computation will not be tested. Conversions may also be done from any qualified employer plan, such as 401k and 403b plans, as well as simple and SEP IRAs. Key points to remember about the Roth IRA. Contributions are not tax-deductible. Distributions are tax-free if taken after age 59 and a half and a Roth account has been open for at least 5 years. Contributions can be made at any age as long as there is earned income. Distributions are not required to begin at age 72. If due to death, disability, or a first-time home purchase, the distribution is qualified and not subject to tax or the 10% penalty. A minor can be named as beneficiary. Characteristics of IRAs. IRA investments. Funds in an IRA account may be used to buy stocks, bonds, mutual funds, UITs, limited partnerships, REITs, U.S. government securities, or gold or silver coins minted by the U.S. Treasury Department, American Eagles, as well as certain platinum coins and bullion, gold, silver, palladium, and platinum, annuities, and many other investments. Take note. The list of allowable coins goes beyond those minted by the Treasury. We'd have never heard of any of these asked on the exam, but the more those TV commercials rave about gold in your IRA, the greater the chance NASA will start asking. In addition to the American Eagles, the IRS will permit the following coins: American Buffalo, Canadian Gold Maple Leaf, Australian Gold Nugget, Platinum Maple Leafs, and non-proof coins. IRA investments should be relatively conservative and should reflect the investor's age and risk tolerance profile. Because an IRA serves as a source of retirement funds, it is important that the account be managed for adequate long-term growth. Ineligible and inappropriate investments. Collectibles, including antiques, gems, rare coins, works of art, and stamps, are not acceptable IRA investments. Life insurance contracts, such as whole life and term, may not be purchased in an IRA. Tax-free municipal bonds, municipal bond funds, and municipal bond UITs are eligible, but they are generally considered inappropriate for an IRA or any tax-qualified plan, because their yields are typically lower than those of other similar investments, and the income generated is taxable on withdrawal from the IRA. Ineligible investment practices. No short sales of stock, trading on margin, covered in detail in Unit 23, or speculative option strategies, think uncovered calls, is permitted in an IRA or any other retirement plan. Covered call writing, described in Unit 4, is allowed. Ineligible investments. Collectibles, whole life insurance, term life insurance. Ineligible investment practices. Short sales of stock. Speculative option strategies. Margin account trading. Real estate in an IRA or qualified plan. Legally, you may invest in real estate in your IRA or as a participant in a 401k or any other could be. Probably the biggest reason why the provision is rarely found is because of the extra care that must be taken when making a real estate investment. If done improperly, serious problems with the IRS can result. If it is done as a truly hands-off investment, it is unlikely that there will be an issue. However, the moment the participant derives any personal benefit from the property, such as staying in a condo purchased in a resort area that is rented out most of the year or allowing prohibited persons to use the property, look out. Test topic alert. The IRS defines prohibited persons, people who can't benefit from real estate held in an IRA or qualified plan, as any member of the family. Who are they? A member of the family includes a spouse, ancestors, parents and grandparents, children, grandchildren, great-grandchildren, and spouses of children, grandchildren, and great-grandchildren. Believe it or not, for the purpose of this rule, a brother or sister of an individual is not a member of the family, while a legally adopted child of an individual is treated as a child by blood. Simplified Employee Pension Plans, SEP IRAs. The third type of IRA is somewhat different in that it is funded by an employer rather than the individual. Simplified Employee Pension Plans, SEPs, offer self-employed persons and small businesses easy-to-administer pension plans. A SEP is a qualified plan that allows an employer to contribute money directly to an individual retirement account, IRA, set up for each employee. Hence, the name SEP IRA following is a list of the key points of which to be aware. Eligibility. To be eligible, an employee must be at least 21 years of age, have performed services for the employer during at least 3 of the last 5 years, and have received at least $650 for 2021 in compensation from the employer in the current year. The annual compensation figure is indexed for inflation. Participation. SEP rules require the employer to allow all eligible employees to participate. Funding. A SEP allows the employer to contribute up to 25% of an employee's salary to the employee's SEP IRA each year, up to a maximum of $58,000 per employee per year in 2021. The employer determines the level of contributions each year and must contribute the same percentage for each employee, as well as the employer. Catch-up provision. Unlike the IRA and most qualified plans, there is no catch-up provision for SSEP. However, and this is unlikely to be tested, if the SEP IRA permits non-SEP contributions, they can make regular IRA contributions, including IRA catch-up contributions if they are age 50 and older, to the SEP IRA up to the maximum annual limit. Vesting. Participants in a SEP IRA are fully vested immediately, meaning that once the money is deposited in an employee's SEP IRA, it belongs to the employee. Taxation. Employer contributions are tax-deductible to the employer. Contributions are not taxable to an employee until withdrawn, and earnings in the account accumulate tax-deferred. Practice question. SEP IRAs. A. Are used primarily by large corporations. B. Are used primarily by small businesses. C. Are set up by non-employees. D. Cannot be set up by self-employed persons. The answer is B. Small businesses and self-employed persons typically establish SEP IRA as because they are easier and less expensive than other plans for an employer to set up and administer. Knowledge Check 18.1. Question 1. A taxpayer has earned income of $25,000 in 2021. Contributions to that individual's IRA may be made on Roman numeral 1, November 15, 2021. Roman numeral 2, January 4, 2022. Roman numeral 3, April 15, 2022. Roman numeral 4, October 15, 2022, if the automatic extension has been filed. A. 1 and 2. B. 1, 2, and 3. C. 1, 2, 3, and 4. D. 2 and 3. The correct answer is B. A contribution for the current year may be made any time that year. The contribution may also be made any time the following year up until the due date for payment of the previous year's income taxes. Note that an extension is only extending the time for filing, not the time for payment of taxes. That day is April 15. Question 2. A 52-year-old taxpayer has earned income of $50,000 in 2021. If the individual has a traditional IRA and a Roth IRA, the maximum contribution for the year is A. $6,000 combined in any fashion. B. $7,000 combined in any fashion. C. $6,000 into the traditional IRA and a like amount into the Roth IRA. D. $7,000 into the traditional IRA and a like amount into the Roth IRA. The correct answer is B. Because the taxpayer is 52, the catch-up provision of $1,000 additional applies. That makes the annual limit currently $7,000. That total combines traditional and Roth IRAs. It can be split however desired, but the total cannot exceed $7,000. Lesson 18.2, IRA Taxation. Learning Objective 18. B. Recognize the tax treatment of distributions from IRAs. Withdrawals from traditional IRAs and SEP IRAs. Up until this point, we've discussed contributions to IRAs. Now let's look at taking the money out. When it comes to traditional IRAs and SEP IRAs, distributions without penalty may begin after age 59 and a half and must begin by April 1 of the year following the year an individual turns 72. Distributions before age 59 and a half may be subject to a tax penalty, and withdrawals less than the required minimum distributions, RMDs, after age 72 may also incur tax penalties. Take note. When is the deadline for receiving an RMD from an IRA? An account owner must take the first RMD for the year in which the account owner turns 72. However, the first RMD payment can be delayed until April 1 of the year following the year in which the account owner turns 72. For all subsequent years, including the year in which the first RMD was paid by April 1, the account owner must take the RMD by December 31 of the year. To the extent withdrawals are from tax-deductible contributions, they are taxable as ordinary income. When there are both deductible and non-deductible contributions, a formula is used whereby a portion of the withdrawal represents a non-taxable return of principal. Taxable withdrawals before age 59 and a half are also subject to a 10% early withdrawal penalty unless they are due to death, disability, first-time purchase of a primary residence, $10,000 lifetime maximum, qualified higher education expenses for immediate family members, including grandchildren, but not nieces or nephews, certain medical expenses, up to $5,000 during the first year after a child is born, or up to $5,000 during the first year after an eligible person is adopted. Eligible adoptee means anybody under age 18 or who is physically or mentally incapable of self-support regardless of age. If married, each spouse can make the $5,000 penalty-free withdrawal. These qualified birth or adoption distributions, QBOADs, are also available for qualified plans, but only if the sponsor provides for them. These exceptions also apply in the case of a non-qualified, taxable distribution from a Roth IRA. Practice question. Who of the following will not incur a penalty on an IRA withdrawal? A. Man who has just become totally disabled. B. Woman who turned 59 a month before the withdrawal. C. Woman, age 50, who decides on early retirement. D. Man in his early 40s who uses the money to buy a second home. The answer is A. Early withdrawals, without penalty, are permitted only in certain situations, such as death or qualifying disability. As stated, withdrawals must begin by April 1 of the year following the year in which the account owner reaches age 72, and they must meet minimum Internal Revenue Code (IRC) distribution requirements or incur a 50% penalty on the amounts falling short of the minimum required distribution (MRD). One important respect in which the Roth IRA differs from other retirement plans is that the age 72 is irrelevant. There are no required minimum distributions. An account holder reaching 72 who does not need the money and who is in good health could let the money continue to grow tax-free for decades. There is one other way to tap your IRA before age 59 and a half without penalty through the Substantially Equal Periodic Payment (SACPP) exception. The Substantially Equal Periodic Payment exception under IRS Rule 72 states that if you receive IRA payments at least annually based on your life expectancy or the joint life expectancies of you and your beneficiary, the withdrawals are not subject to the 10% penalty. The IRS has tables for determining the appropriate amount of each payment at any given age. Take note. For exam purposes, other than with a Roth IRA, you can postpone beginning distributions until the later of April 1 of the calendar year after you turn age 72, or April 1 of the calendar year following your retirement, but only for qualified plans, not an IRA. Example. An IRA owner who reaches age 72 on January 1, 2021, must begin withdrawals by April 1, 2022. However, if this individual is covered by an employer-sponsored plan other than a SEP IRA, there are no RMDs from that plan, but there are from any traditional IRAs until after retirement. Non-deductible capital withdrawals. IRA investors who contribute after-tax dollars to an IRA are not taxed on those funds when they are withdrawn from the account, but taxpayers are taxed at the ordinary income tax rate when they withdraw funds resulting from investment gains or income. As stated above, if the client is in the middle part of the phase-out range, resulting in some of the contribution being pre-tax, deductible, and the rest post-tax, the IRS has a formula to determine how much of the money withdrawn is non-taxable. Example: a client has invested $25,000 in after-tax dollars in an IRA currently worth $75,000. If the client were to withdraw $75,000, only $50,000 would be taxable. Take note: the early withdrawal penalties for all IRAs are waived in the event of death or disability. Test topic alert. Assume questions are about traditional IRAs unless they specifically state otherwise. Test topic alert. Income and capital gains earned from investments in any IRA account are not taxed until the funds are withdrawn, and, if a qualified withdrawal, are not taxed at all in the case of a Roth. Moving IRAs. Individuals may move their funds and investments from one IRA to another IRA through one of two methods: 60-day rollover or trustee-to-trustee transfer. 60-day rollovers. If you just see IRA rollover, it will be the 60-day rollover. An IRA account owner may take temporary possession of the account funds to move the retirement account to another custodian. The account owner may do so only once per 12-month period, and the rollover must be completed within 60 calendar days of the funds withdrawal from the original plan. However, 100% of the withdrawn amount must be rolled into the new account, or the unrolled balance will be subject to income tax and, if applicable, early withdrawal penalty. A participant in a business-sponsored qualified plan may move her plan assets to an IRA if she leaves the company and elects to take a lump sum distribution. If the participant does take possession of the funds, she must complete the rollover within 60 calendar days of withdrawing the funds from the qualified plan. When the participant takes possession of the funds from a qualified plan to make a rollover, the payer of the distribution must, by law, withhold 20% of the distribution as a withholding tax. The participant must, nonetheless, roll over 100% of the plan distribution, including the funds withheld, or be subject to income tax and, if applicable, early withdrawal penalty. Example: a 50-year-old individual with $100,000 in her company retirement plan changes employers. Her pension plan may be distributed to her in a lump sum payment, minus the mandatory 20% withholding of $20,000. She must then deposit $100,000 in an IRA, a rollover account, within 60 days. Any portion not rolled over, including the $20,000 withheld, is considered a distribution subject to ordinary income tax and early distribution penalty. If she deposits the entire $100,000 into the IRA, she will apply on her next income tax return for a refund of the $20,000 withheld. Trustee-to-trustee transfers. Sometimes simply referred to as an IRA transfer. This is when account assets are sent directly from one IRA custodian to another, and the account owner never takes possession of the funds. Unlike the 1 per 12 months with an IRA rollover, the number of IRA transfers an account owner may make per year is unlimited. Direct rollovers and transfers generally make better sense than 60-day rollovers because the 20% federal tax withholding does not apply to direct transfers of portfolios, and because the transfer is basically immediate. The holder doesn't have to be concerned about meeting the 60-day requirement. There is another way of receiving funds in an IRA, and that is when moving funds from an employer-sponsored qualified plan that is the direct rollover. Direct rollovers from retirement plans to IRAs. A direct rollover is a distribution from an employer-sponsored retirement plan to an IRA, either traditional or Roth. When you terminate employment or retire, you have the option of moving your employer-sponsored plan assets to an IRA. In some cases, if you go to a new job, your new employer's plan may permit a direct rollover into that plan. The key to a direct rollover is that the money is never seen by the employee and moves directly from the current plan administrator directly to another administrator. Take note. How does a direct rollover differ from a transfer? A direct rollover is different from a transfer because it involves two different types of plans. For example, one would use a direct rollover to move funds from a 401k plan to an IRA, while the transfer is from an IRA at one brokerage firm to an IRA at another. Earnings limitations for tax benefits. Traditional and certain SEP IRA participants may deduct contributions to their IRA as from their taxable income. The deductibility limits are reduced or even eliminated for individuals who are covered by other employer-sponsored qualified plans. These AGI limits increase every year and will not be tested. Individuals who do not participate in qualified plans may deduct IRA contributions regardless of income level. For those filing 2021 tax returns, the IRA deductibility phase-out range is expressed in the table below. Year 2021. Phase-out range, single filers, $66,000 to $76,000. Phase-out range, joint filers, $105,000 to $125,000. Take note. The limits are higher, $198,000 to $208,000, if only one of the spouses participates in a qualified plan, but as with all of these numbers, it is only the concept that is tested, never the numbers themselves. These limits deal only with the deductibility of contributions. If your client earns in excess of the limits, the full contribution can still be made, but none of it can be deducted. The test refers to those as post-tax or after-tax contributions. The earnings still grow tax-deferred. Example: two persons who are part of a married couple, each of whom does not participate in a qualified plan and whose combined income is $200,000, may contribute and deduct a total of $12,000, $14,000 if both individuals are 50 or older. No deduction is allowed for a married couple where both are covered by a qualified plan and whose combined income is $125,000 for 2021 or more. Nevertheless, their contributions are permitted and all earnings are tax-deferred. Inheriting an IRA. The rules on the treatment of an inherited IRA depend on whether the beneficiary is the spouse or is some other relative or non-relative of the deceased. Another factor is if the deceased had already begun taking RMDs. This issue is very technical, and we will only cover points that might be tested. Take note. ARAs and employer-sponsored qualified plans have a beneficiary designation. That designation supersedes any contrary provision in a will. Spousal beneficiary. When the beneficiary is the spouse, there are two choices that can be made. Do a spousal rollover, meaning the amount of the inheritance is rolled over into the spouse's own IRA. Continue to own the IRA as the beneficiary. When doing a spousal rollover, this is treated, logically, as your own with all of the normal rules applying withdrawal ages, RMDs, and so forth. That means that if the spouse is younger than 59.5, any distributions prior to then will be subject to the 10% penalty, unless meeting one of the exceptions. If, however, the spouse elects to continue the account as the beneficiary, then there is no 10% penalty for withdrawals prior to age 59.5. That's the good news. The bad news is that our MDs from a traditional IRA or SEP IRA must begin when the deceased would have had to take them, a disappointment if the survivor is the younger partner. However, the RMDs will be computed based on the beneficiary's age, not that of the deceased. Also, if it is a Roth IRA and the account hasn't been open for at least 5 years, any withdrawal of earnings will be subject to income tax, but not the 10% penalty. Non-spouse beneficiary. Things are different when the person inheriting a traditional IRA is not the spouse of the deceased. For one thing, unlike the spouse, the beneficiary will not be allowed to roll over the inherited IRA into their own IRA. This is simply not an option. In general, there are two primary options available. Take the cash now. The non-spouse IRA beneficiary can withdraw 100% of the IRA account immediately. If this option is chosen, then 100% of the amount withdrawn, assuming the IRA was funded completely with pre-tax contributions, will be included in taxable income during the year of withdrawal. Cash out the IRA in 10 years. Unless qualifying for one of the exceptions listed below, withdrawal requirements depend on the age of the deceased. If the deceased owner of the IRA had reached the date where RMDs are required, then the beneficiary would need to take RMDs based on that beneficiary's age from the inherited IRA for each of the first 9 years, and then in the 10th year, withdraw any remaining balance. If, on the other hand, the deceased had not yet reached 72, then the IRS does not require the payments to be made with any designated frequency. That is, you can take a portion the first year because you can use some cash, nothing for the next 8 years, and the balance no later than December 31 of the 10th year. There are exceptions to the 10-year rule as follows. The surviving spouse, as described above. A minor child, 10-year rule applies once the minor reaches the age of majority, a disabled individual, a chronically ill individual, an individual who is not more than 10 years younger than the deceased participant or IRA owner. If the beneficiary does nothing by December 31 of the year following the year of death, the default option used by the IRA is the 10-year withdrawal option. Practice question. Grandma Abigail died at age 82 with a traditional IRA valued at $100,000. Her daughter Betsy, 53 years old, was the sole beneficiary. Betsy's choices would include A. Rolling over this IRA to her own IRA. B. Taking distributions over a period not to exceed 10 years. C. Taking the cash by December 31 and paying the 10% tax penalty because she is under 59 and a half. D. Leave the IRA in the name of the deceased and continue with the RMDs. The answer is B. Among the options available to a non-spouse beneficiary is receiving the payout over a 10-year period. The distributions may be taken as desired but must be completed within 10 years. Betsy, being a daughter and not a spouse, could not roll over the IRA into her own IRA, even though she is under 59 and a half. Inheritors of IRA do not incur the 10% penalty tax on withdrawals. Take note. Just as with the spouse continuing the IRA as the beneficiary, if the account were a Roth IRA and had not been opened for the 5-year minimum, any earnings distributed will be subject to ordinary income tax but not the 10% penalty. Disclaiming an IRA. Believe it or not, there are actually people who inherit IRAs who don't want the money. There are any number of reasons why, none of which will be tested, but what will be tested is what happens when the beneficiary disclaims the proceeds. A disclaimer is a refusal to accept a gift or inheritance. Perhaps it is easier to understand it like this. If you accept an item left to you by someone who has died, you are claiming that asset. If you refuse it, you are disclaiming it. In order for the disclaimer to be effective, it must be done within 9 months of death. It must be in writing, and of course, you cannot have taken any of the money. If the named beneficiary of an IRA disclaims all or part of the inherited IRA, the disclaimer has the effect of changing the beneficiary of the retirement plan. In general, the assets pass to the contingent beneficiaries. What if no contingent beneficiary has been named? Unless the IRA adoption document provides for it, the person disclaiming cannot decide where the money goes. It will follow the provisions of the deceased's will. Example. Joseph Miller passes away at the age of 72 and leaves his wife, Josephine, his traditional IRA with a value of $1,800,000. There are many other assets in the estate, and Mrs. Miller decides to disclaim the entire IRA. She would like to pass on the assets to her 3 grandchildren, none of whom are minors, in equal shares, with another share going to her favorite charity. Assuming the IRA adoption document permits the beneficiary to designate in this matter, the charity will receive $450,000 with no tax liability at all, and the 3 grandchildren will each receive $450,000 on which distributions may be stretched out over a maximum of 10 years. Knowledge Check 18.2. Question 1. Taxable withdrawals before age 59 and a half are subject to a 10% early withdrawal penalty in addition to the normal income tax unless they are due to Roman numeral 1. Death. Roman numeral 2. Disability. Roman numeral 3. Qualified education expenses for a nephew. Roman numeral 4. The purchase of a vacation home, but not to exceed $10,000 lifetime. A. 1 and 2. B. 1 and 3. C. 1, 2, and 3. D. 1, 2, and 4. The correct answer is A. There aren't many Roman numeral questions on the exam, probably because NASA realizes how easy they can be. After all, choice I is in every answer, and because most test takers can put disability together with death, I and I must be correct choices. Then, what about the other 2? The education expense allowance does not include nieces and nephews. It does include grandchildren. The $10,000 first-time purchase is of a primary residence, not a vacation home. Question 2. A taxpayer opened a Roth IRA 7 years ago. Last year, the individual opened a new Roth IRA at your brokerage firm. The individual is 60 years of age and liquidates $3,000 from the new Roth IRA. $1,000 of the withdrawal represents earnings in the account. The tax consequence of this withdrawal is A. No tax is due. B. Tax is due on the $1,000 from earnings. C. Tax plus the 10% penalty is due on the $1,000 from earnings. D. Tax is due on the entire $3,000 withdrawal. The correct answer is A. Withdrawals from a Roth IRA are tax-free when two conditions are met. The first is that the taxpayer must have a Roth IRA that is at least 5 years old. That condition is met here because the first Roth IRA was opened 7 years ago. The second condition is that the taxpayer must be at least 59.5 years of age. Ours is Lesson 18.3. Employer-Sponsored Retirement Plans. Learning Objective 18. C. Differentiate between the different types of employer-sponsored qualified retirement plans. In this lesson, we will be describing the various retirement plans offered by employers to their employees. We will be addressing plans offered for the self-employed, the different plans offered by corporations, and finally, plans designed for employees of tax-exempt organizations. KEO plans. KEO plans, technically called HR 10 plans and named after the congressman who introduced the bill, are qualified plans intended for self-employed individuals and owner-employees of unincorporated business concerns or professional practices. Included in the self-employed category are independent contractors, consultants, freelancers, and anyone else who files and pays self-employment Social Security taxes. The term owner-employee refers to sole proprietors. A corporation cannot use a KEO plan. Take note. Whenever the term qualified plan is used, it refers specifically to an employer-sponsored plan, such as a 401k plan, a pension plan, or a KEO plan, not an IRA, contributions. Contribution limits for a KEO plan are significantly higher than those for an IRA for those filing tax returns in 2021. As much as $58,000 may be contributed on behalf of a plan participant. Those who are eligible for a KEO plan may also maintain an IRA, but as described previously, if the earning limits are exceeded, the IRA contribution will not be deductible. If the business has employees, they must be covered at the same contribution percentage as the owner in order for the plan to be non-discriminatory. Test topic alert. Only earnings from self-employment count toward determining the maximum that may be contributed. For example, if a corporate employee had a part-time consulting job, only that income, not the corporate salary, could be included in the computation. Eligibility. Employee participation in a KEO plan is subject to these eligibility rules. Full-time employees are employees who receive compensation for at least 1,000 hours of work per year. Tenured employees are employees who have completed 1 or more years of continuous employment. Adult employees are employees 21 years of age and older, and there is no age limit as long as the individual is employed. Comparison of IRAs and KEO plans. KEO plans and IRAs are designed to encourage individuals to set aside funds for retirement income. Although both IRAs and KEOs are tax-advantaged, an IRA does not involve employer contributions and thus is not a plan qualified by ERISA. The principal similarities between KEOs and IRAs are listed in the following. Tax deferral of contributions to plans. Taxes are deferred on contributions until the individual receives distributions. Tax-sheltered income. Investment income and capital gains are not taxed until withdrawn, at which time they are subject to taxation at ordinary income rates. Contributions. Only cash may be contributed to a plan. In the event of a rollover or transfer, cash and securities from the transferring account can be deposited. Distributions. Distributions without penalty can begin as early as age 59.5. Penalties for early withdrawal. The individual pays income tax on the total amount withdrawn plus a 10% penalty. Early withdrawals without penalty are permitted in the event of death or disability. Payout options. Distributions may be in a lump sum or periodic payments. Beneficiary. Upon the plan holder's death, payments are made to a designated beneficiary or beneficiaries. Practice question. Which of the following may participate in a KEO plan? Roman numeral 1. Self-employed doctor. Roman numeral 2. Analyst who makes money giving speeches outside regular working hours. Roman numeral 3. Individual with a full-time job who also has income from freelancing. Roman numeral 4. Corporate executive who receives $5,000 in stock options from her corporation. A. 1 only. B. 1 and 2. C. 1, 2, and 3. D. 1, 2, 3, and 4. The answer is C. A person with self-employment income may deduct contributions to a KEO plan. KEO plans are not available to corporations or their employees. That would make choice C the correct answer. Corporate-sponsored retirement plans. Plans offered by corporations include pension plans, profit-sharing plans, and the highly popular 401k plans. The Employee Retirement Income Security Act of 1974, ERISA, is federal legislation that regulates the establishment and management of corporate pension or retirement plans, also known as private sector plans. All qualified corporate plans must be established under a trust agreement. A trustee is appointed for each plan and has a fiduciary responsibility for the plan and the beneficial owners, the plan holders. We'll cover ERISA in greater detail later in this unit in Lesson 18.5. Defined contribution and defined benefit plans. All qualified retirement plans fall into one of two categories. Those that offer no specific end result, but instead focus on current, tax-deductible contributions are defined contribution plans. Those that promise a specific retirement benefit, but do not specify the level of current contributions are defined benefit plans. It is important to distinguish between these two approaches. Take note. Although we will be including 2021 contribution limits, these are never tested on the exam because they change each year. As stated earlier in the course, they are simply to give students an idea of the difference between the amount that may be contributed here compared to an IRA. Defined contribution plans. Defined contribution plans include money purchase pension plans, as well as profit-sharing plans and 401k plans. As with other business plans, as compared to an IRA, the maximum employer contribution is currently $2021 $58,000. Defined contribution plan participants' funds accumulate until a future event, generally retirement, when the funds may be withdrawn. The ultimate account value depends on the total amount contributed, along with interest and capital gains from the plan investments. In this type of plan, the plan participant assumes the investment risk. The deduction for contributions to a defined contribution plan, such as a profit-sharing plan, including 401k or money purchase pension plan, cannot be more than 25% of the total payroll for the year to the eligible employees participating in the plan. Defined benefit plans. Defined benefit plans are designed to provide specific retirement benefits for participants, such as fixed monthly income. Regardless of investment performance, the promised benefit is paid under the contract terms. A defined benefit plan sponsor assumes the investment risk. It can happen that the portfolio performance is so good that, in certain years, the plan is fully funded without a contribution needed for that year. The benefit is usually determined by a formula that takes into account years of service and average salary for the last 5 years prior to retirement. Older, highly compensated employees are likely to have the largest annual contributions on their behalf. Because of the expenses and complexities involved, the plan's annual return must be signed by an actuary. 16% of workers had defined benefit plans in 2019, whereas in 1979, that number was 28%. Take note. Because of the actuarial assumptions and computations, the amount of the annual employer contribution has to be figured by an actuary. When the proper amount has been contributed, the plan is considered to be fully funded. If the year's portfolio performance exceeds the actuarial assumptions, the plan is overfunded and a smaller or possibly no contribution is necessary for the year. Unfortunately, many plans, including state employee plans, are underfunded. Contributory versus non-contributory plans. In a contributory plan, both the employer and employee make contributions to the account. In a non-contributory plan, only the employer makes the contributions. Probably the most common example of a contributory plan is the 401k plan, where the employee determines how much to contribute and the employer may match up to a certain percentage. Employer deductions. The employer can usually deduct, subject to limits, contributions made to a qualified plan. The deduction limit for those contributions to a qualified plan depends on the kind of plan in place. Test topic alert. Unlike an annuity payout or life insurance premium, contributions to a defined benefit plan are not affected by the participant's sex. Test topic alert. Employer contributions to defined benefit or defined contribution, money purchase, pension plans are mandatory. Although profit-sharing plans and 401k plans are technically defined contribution plans, they are not pension plans, and employer contributions are not mandatory. In all cases, allowable employer contributions are 100% deductible to the corporation. There is no tax obligation to the employee until withdrawal. Profit-sharing plans. A profit-sharing plan established by an employer allows employees to participate in the business's profits. The benefits may be paid directly to the employee or deferred into an account for future payment, such as retirement or a combination of both. This discussion concerns profit-sharing plans that defer benefits toward retirement. Profit-sharing plans need not have a predetermined contribution formula. Plans that do include such a formula generally express contributions as a fixed percentage of profits. In either event, to be qualified, a profit-sharing plan must have substantial and recurring contributions according to the Internal Revenue Code. Profit-sharing plans are popular because they offer employers the greatest amount of contribution flexibility. The ability to skip contributions during years of low profits appeals to corporations with unpredictable cash flows. They are also relatively easy to install, administer, and communicate to employees. 401k plans. In a 401k plan, an employee directs an employer to deduct a percentage of the employee's salary that will be a contribution to a retirement account. 401k plans permit an employer to make matching contributions up to a set percentage of the employee-directed contributions, making this a type of defined contribution plan. All contributions are made with pre-tax dollars. In effect, participating employees are reducing their salary by the amount of their contribution, and therefore, their W-2 will show the actual salary less the 401k contribution. However, even though income taxes are based on this lower amount, FACA, Social Security, taxes are levied against gross salary, not this reduced amount. In 2021, the maximum employee elective deferral is set at $19,500 with an additional catch-up contribution limit of $6,500. Test topic alert. An employer-sponsored 401k plan may be established with no required employer or employee contributions. As we will shortly learn, there is one case where employer contributions would be mandatory, but, for exam purposes, unless that case is specified, it is up to the employer to determine if it will incorporate matching contributions into the plan. Take note. When one includes the catch-up amount, the maximum combined employer and employee contribution in a defined contribution plan increases from $58,000 to $64,500 per year. Test topic alert. One of the benefits of investing through a 401k plan is that it takes advantage of dollar cost averaging, a technique described in Unit 21, which always results in a lower cost per share in a fluctuating market. Roth 401k plans. The Roth 401k is an option that may be added to an existing 401k plan. The Roth 401k option combines features of Roth IRAs and 401k retirement plans. Just as with a Roth IRA, these plans require after-tax contributions but allow tax-free withdrawals, provided the retiring person is at least 59.5 years old at the time of the withdrawal. Once again, paralleling the Roth IRA, the account must be at least 5 years old to take tax-free withdrawals. Like a regular 401k plan, the Roth 401k plan has employer matching contributions. However, the employer's match must be deposited into a regular 401k plan and be fully taxable upon withdrawal. Thus, the employee must have two accounts: a regular 401k and a Roth 401k. Employees may contribute to either account but may not transfer money between accounts once the money has been contributed. Unlike Roth IRAs, Roth 401k plans have no income limit restriction on who may participate. One may have both a Roth 401k plan and a Roth IRA, but the income limits would still apply to the Roth IRA. Unlike Roth IRAs, Roth 401k plans require withdrawals to begin no later than age 72, following the same rules that apply to all RMDs. Simple plans. Savings incentive match plans for employees, SIMPLEs, are retirement plans for a business with 100 or fewer employees who earned $5,000 or more during the preceding calendar year. In addition, the business cannot currently have another retirement plan in place. The plans are easy to set up and inexpensive to administer. The employee's contribution, up to $13,500 with a $3,000 catch-up provision, 2021, is pre-tax and may be matched by the employer using either of the following two options: a 2% non-elective employer contribution, where employees eligible to participate receive an employer contribution equal to 2% of their compensation, limited to $290,000 per year for 2021 and subject to cost of living adjustments for later years, regardless of whether they make their own contributions. A dollar-for-dollar match up to 3% of compensation, where only the participating employees who have elected to make contributions will receive an employer contribution, the matching contribution. For small businesses looking for a way to have an inexpensive retirement plan for their employees, the simple is the way to go. Take note. We've never heard of this being on the test, but just in case, you might need to know about a penalty tax levied under these plans that is unique. Unless qualifying for an exception from the 10% penalty tax, such as that offered with traditional IRAs over 59.5, death or disability, etc., withdrawals from a simple IRA within the first 2 years after beginning participation in the plan are subject to a penalty tax of 25%. It is easy to confuse the SEP IRA, covered at Learning Objective 18A, with the simple. The following chart will help you spot the differences. Comparison of plans. Tax status. Simple IRA, tax deferred. SEP IRA, tax deferred. Contributor. Simple IRA, employees and / or employer. SEP IR, employer. Contribution limit. Simple IRA, $13,500, $13,500 in 2019. Catch-up limit of $3,000. SEP IRA, 25% of an employee's salary or up to $58,000, $56,000 in 2019, whichever is less. Good for. Simple IRA, any size business. SEP IRA, businesses with less than 100 employees. Learning Objective 18. D. Identify the characteristics of a 403B plan. 403B plan. A 403B plan, also known as a tax-sheltered annuity plan, is a retirement plan for certain employees of public schools. Employees of certain IRS Code Section 501c3 tax-exempt organizations and certain ministers. A 403B plan allows employees to contribute some of their salary to the plan. The employer may also contribute to the plan for employees. 403B plans, also known as a tax-sheltered annuity plan, TSA, are qualified tax-deferred retirement plans for employees of public school systems, 403B employees, and tax-exempt organizations under IRS Code Section 501c3, such as churches and private nonprofit organizations, 501c3 employees. A 403B plan allows qualified employees to contribute some of their salary to the plan. The employer may also contribute to the plan for employees. Like other retirement plans, these are intended to encourage retirement savings. To ensure this objective, 403Bs, like IRAs and other retirement plans, are subject to tax penalties if savings are withdrawn before a participant reaches age 59.5. Tax advantages. The following tax advantages apply to 403B plans. Income exclusion. If an eligible employee elects to make annual contributions to a 403B, those contributions are excluded from the employee's gross income for that year. The amount of the contribution is not reported as income, resulting in lower current income taxes. Tax-deferred accumulation. Earnings in a 403B accumulate with no current taxation of earnings or gains and do not increase the participant's taxable income until the dollars are withdrawn at retirement, usually when that person is in a lower tax bracket. Investments. Historically, these plans were, and still are, referred to as tax-sheltered annuity plans, TSAs, because annuities were the only investment option. In 1974, a provision was made to permit the purchase of mutual funds as well, although it is estimated that more than 85% of all 403B money is invested in either fixed or variable annuities. Guaranteed Investment Contracts, GICs. Another option for 403B plans, as well as 401k plans, is the Guaranteed Investment Contract, almost always referred to by its initials, GIC. These are contracts issued by insurance companies that offer a guaranteed return of principal at a certain date in the future and come with a fixed rate of return that is generally a bit higher than that offered by comparable bank CDs. However, unlike CDs, GICs are not federally insured. Therefore, despite the inclusion of the word guaranteed in the title, GICs carry slightly more investment risk than CDs, and that is why their return is higher. Eligibility requirements. To be eligible to establish a 403B, an employer must qualify as a public educational 403(b) institution, tax-exempt 501(c)(3) organization or church organization, public educational 403(b). To qualify as a public educational institution, an organization must be state-supported, a political subdivision, or an agency of a state. Private school systems have a separate set of qualifying rules. State-run educational systems include elementary schools, secondary schools, colleges and universities, and medical schools. Individuals employed by the above school systems in the following job classifications may enroll in a 403(b) plan. These include teachers and other faculty members, administrators, managers, principals, supervisors, and other members of the administrative staff, counselors, clerical staff and maintenance workers, and individuals who perform services for the institution such as doctors or nurses. Tax-exempt 501(c)(3). As stated earlier, 501(c)(3) organizations are tax-exempt entities specifically cited in the IRC as eligible to establish 403(b)s for their employees. Typical 501(c)(3) organizations include private colleges and universities, trade schools, parochial schools, zoos and museums, research and scientific foundations, religious and charitable institutions, and private hospitals and medical schools. Take note: some 403(b) plans are subject to ERISA, while others are not. Two of the most important exclusions from ERISA coverage are governmental plans, for example, plans sponsored by a state, county, or municipality, or one of their agencies, schools, or instrumentalities, and church plans, unless the plan sponsor has voluntarily elected to have the plan covered by ERISA. Definition: employee. Only employees of qualified employers are eligible to participate in a 403(b) plan. Independent contractors are not eligible. It is the employer's responsibility to determine an individual's status or definition. Similar to other qualified plans, all 403(b)s, whether employer contribution or employee elective deferral, must be made available to each full-time employee who has both reached age 21 and completed 1 year of service. Plan requirements. A 403(b) plan must meet two requirements. The plan must be in writing and must be made through a plan instrument, a trust agreement, or both. The employer must remit plan contributions to an annuity contract, a mutual fund, or another approved investment. Contribution limits. An employer can make contributions to a 403(b) solely on behalf of the covered employee or in conjunction with an employee deferral. Salary reduction. 403(b) contributions are made by having the employee take a salary reduction. As such, the money is withdrawn prior to taxation. For 2021, the maximum is $19,500 with a $6,000 catch-up provision. Employer contributions. Employer contributions to a 403(b) are generally subject to the same maximums that apply to all defined contribution plans. The lesser of 100% of the participant's compensation, or $58,000 per year. Practice question. A retirement plan that allows the employee to make pre-tax contributions within certain limits provides for tax deferral of earnings and is available for employees of public school systems and certain tax-exempt organizations is A, a 403(b) plan, B, a 401(k) plan, C, an SEP IRA, D, a payroll deduction plan. The answer is A. The giveaway here is the public school employees. The 403(b) is their plan, as well as the plan offered to other employees of certain, but not all, tax-exempt organizations. Section 457 plans. Although technically a non-qualified, unfunded deferred compensation plan, because of the many similarities to qualified corporate plans, and because they may be offered to the same tax-exempt organizations as the 403(b) plan, we are including them here. A Section 457(b) plan is a deferred compensation plan set up under Section 457 of the Tax Code that may be used by employees of a state, political subdivision of a state, and any agency or instrumentality of a state. This plan may also be offered to employees of certain tax-exempt organizations, hospitals, charitable organizations, unions, and so forth, but not churches. In a 457 plan, employees can defer compensation, and the amount deferred is not reportable for tax purposes. Therefore, the employee receives a deduction each year for the amount. There are several important facts to know about 457 plans. These plans are not covered under ERISA. Non-governmental plans must be unfunded to qualify for tax benefits, while government plans must be funded. These plans are generally not required to follow the non-discrimination rules of other retirement plans. While any employee or independent contractor of a governmental entity can be a participant, tax-exempt organizations that are non-governmental must limit participation to management and highly compensated employee. Distributions from 457. Plans of non-governmental tax-exempt employees may not be rolled over into an IRA, but there is no 10% penalty for early withdrawal. It is possible to maintain both a 457 and a 403B or a 457 and a 401k and make maximum contributions to both $19,500 times 2 equals $39,000 in 2021. As a result, those 50 or older using the catch-up provision in each plan could actually contribute as much as $52,000. You could also have an IRA along with the 457. Loans from a 457B plan are available in governmental plans only, and only if the entity decides to include that feature in the plan. Furthermore, the requirements for unforeseen emergency withdrawals are much stricter than for hardship withdrawals under a 401k plan. Practice question. A basic difference between a Section 457 plan established on behalf of a governmental entity and one established by a private tax-exempt organization is that A. A governmental plan must hold its assets in trust or custodial accounts for the benefit of individual participants. B. A tax-exempt plan participant does not have to include plan distributions in his or her taxable income. C. A governmental plan cannot make a distribution before the participant attains age 72. D. A tax-exempt plan's distributions are not eligible for a favorable lump sum 10-year averaging treatment. The answer is A. A governmental Section 457 plan must be funded, that is, it must hold plan assets in trusts or custodial accounts for the benefit of individual participants. Conversely, a tax-exempt, non-governmental, Section 457 plan may not be funded. Learning Objective 18. E. Contrast qualified and non-qualified retirement plans. Up until now, we have discussed qualified plans and, because of its many similarities, the 457 plan. Corporations often elect to provide a non-qualified plan. Non-qualified means that the plan is not subject to the requirements of the Employee Retirement Income Security Act of 1974, ERISA. A non-qualified plan does not allow the employer a current tax deduction for contributions. Instead, the employer receives the tax deduction when the money is actually paid out to the employee. If the plan is currently funded, many employers wait until the time to pay and use current earnings. Depending on the way the plan is structured, earnings may or may not accumulate on a tax-deferred basis. That is an infrequently tested item. A non-qualified plan need not comply with non-discrimination rules that apply to qualified plans. The employer can make non-qualified benefits available to key employees and exclude others. Non-qualified plans are not subject to the same reporting and disclosure requirements as qualified plans. As mentioned, they are not covered by ERISA. However, non-qualified plans still must be in writing and communicated to the plan participants. Even though these plans are exempt from ERISA requirements, sponsors of non-qualified plans are fiduciaries and can be held liable for acting contrary to fiduciary standards. Taxation of contributions. The corporation cannot deduct non-qualified plan contributions made on behalf of participants until paid to the participant. However, if the non-qualified plan is properly designed, contributions are not taxable to the employee until the benefit is received. Contributions to non-qualified plans that have already been taxed make up the investor's cost base. When the investor withdraws money from the non-qualified plan, the cost base is not taxed. However, earnings are taxed when withdrawn. Types of non-qualified plans. 3 types of non-qualified plans are payroll deduction plans, deferred compensation plans, and supplemental executive retirement or retention plans. Payroll deduction plans. A payroll deduction plan involves a deduction from an employee's check on a weekly, monthly, or quarterly basis as authorized by the employee. This is the primary case where the money is deducted after taxes are paid and may be invested in investment vehicles at the employee's option. As mentioned above, when withdrawn, only the excess over the cost basis, those after-tax contributions, is subject to tax. The most common investments are employer stock or United States savings bonds. Deferred compensation plans. A non-qualified deferred compensation, NQDC, plan is a contractual agreement between a firm and an employee in which the employee agrees to defer receipt of current compensation in favor of a payout at retirement. The agreement underlying a deferred compensation plan usually includes the following: conditions and circumstances under which some or all of the benefits may be forfeited, such as if the employee moves to a competing firm. A statement to the effect that the employee is not entitled to any claim against the employer's assets until retirement, death, or disability. A disclaimer that the agreement may be void if the firm suffers a business failure or bankruptcy. Test topic alert. Because the employer can discriminate, one of the most common uses of deferred compensation plans is to provide benefits to retain key employees. Generally, an employee enjoys no benefits from a deferred compensation plan until retirement. If the business fails, the employee is a general creditor of the business with no guarantee that he will receive the deferred payment. Qualified plans versus non-qualified plans. Qualified plans. Contributions tax deductible. Plan approved by the IRS. Plan cannot discriminate. Subject to ERISA. Tax on accumulation is deferred. All withdrawals taxed. Plan is a trust. Non-qualified plans. Contributions not tax deductible. Plan does not need IRS approval. Plan can discriminate. Not subject to ERISA. Tax on accumulation is deferred. Excess over cost base taxed. Plan is not a trust. Practice question. Which of the following objectives would not be met by an employer's use of a non-qualified retirement plan? A. The employer desires current tax savings. B. The employer desires an alternative to the qualified plan because of the complexity of legislative changes. C. The employer needs to bring executive retirement benefits up to desired levels by adding a second tier of benefits on top of the qualified plan. D. The employer desires a plan in which benefits may legally discriminate in favor of highly compensated employees. The answer is A. Tax benefits on an NQDC plan only result when the employee receives payment, so choice A is correct. All of the other statements describe situations in which employers might benefit from establishing a non-qualified retirement plan. SARP. A supplemental executive retirement plan, SERP, provides benefits to executives over and above the benefits available from a qualified plan and is funded entirely with employer funds. The plan can be either completely unfunded, like an excess benefit plan, or informally funded. The plan rewards an executive's continued employment or encourages the early retirement of the executive. A SERP also may be established to protect the executive from involuntary termination if the company changes ownership by awarding her increased benefits from the plan. The R sometimes refers to retention because these plans do encourage key employees to remain until they qualify for the benefit. Knowledge Check 18.3. Question 1. A corporation has set up a qualified retirement plan for its employees. Which of the following plans requires mandatory contributions from the employer? Roman numeral 1. 401k plan. Roman numeral 2. Defined contribution pension plan. Roman numeral 3. Defined benefit pension plan. Roman numeral 4. Profit sharing plan. A. 1 and 3. B. 1 and 4. C. 2 and 3. D. 2 and 4. The correct answer is C. Employer contributions are mandatory for all pension plans. It is true that better than projected performance can lead to the actuaries reporting that no contribution is necessary for a specific year, but that just means the obligation has been met through performance. Profit-sharing plans and 401k plans allow the employer to determine how much, if anything, will be contributed each year. Question 2. Who of the following would not be eligible to contribute to a 403b plan? A. A nurse working in the local public school who also helps out in the local hospital on weekends. B. The maintenance supervisor in the local high school who does office cleanups on the weekends. C. A retired math teacher who works most evenings tutoring local high school students for the SAT exams. D. The principal of the local elementary school. The correct answer is C. The retired math teacher has self-employment income that could be used to fund a KEO plan, but this person is not eligible for the 403b plan because the income is not from the school system or other eligible employer. The school nurse, maintenance person, and principal are all employees of a school system and can participate in the plan. Do not read anything into this question that is not there. In other words, the question is not asking if money earned from the weekend work at the hospital, cleaning offices, or tutoring during the evenings is compensation that may be used for a 403(b) plan. It can't be. Question 3. Which of the following is designed to help a corporation retain high-value executives? A. SEPIRA. B. SERP. C. Simple Plan. D. TSA. The correct answer is B. This SERP, Supplemental Executive Retirement Plan, is sometimes called the Supplemental Executive Retention Plan. Its purpose is to go beyond the normal retirement plan with extra benefits for these executives. Because it is a non-qualified plan, discrimination is permitted. TSA is the general term used in the field to describe 403(b) plans, and corporations don't offer them. The contribution level on a simple is too low to retain the talent, and the company will need more than a SEPIRA. In fact, SERPs are always on top of an existing qualified plan. Lesson 18.4. Taxation of Qualified Plans. Learning Objective 18. F. Identify the tax treatment of distributions from qualified plans. If all of the funds were contributed by the employer, known as a non-contributory plan, the employee's tax basis, cost, is 0. If the employee contribution were pre-tax, the basis for that is 0 as well. Because everything above the cost is taxed at the employee's ordinary income rate at the time of distribution, in most cases, all funds received are fully taxable. Distributions from a 403(b) must follow the same rules as distributions from all qualified plans. Because the employee's 403(b) contributions are made with pre-tax dollars and all earnings were tax-deferred, any distribution is subject to ordinary income tax rates in the year it is received. A normal distribution can start at age 59 and a half. Premature distribution is subject to a 10% penalty tax, and the RMD rules apply as well. Hardship withdrawals. 401(k) plans are permitted to make hardship withdrawals available to participants facing serious and immediate financial difficulty. There are maximum limits. The amount withdrawn is not eligible for a rollover and therefore is taxable as ordinary income and possibly the 10% penalty. It differs from a 401(k) loan, which is not taxable as long as the repayment requirements of the IRS are met. 401(k) plan loans. Somewhat different from the hardship withdrawal is the ability to borrow from the 401(k). This has the advantage of not being treated as a distribution, so there is no tax. However, if certain IRS rules are not followed, it will be considered a premature distribution and taxed as such. The IRS maximum loan amount is 50% of the participant's vested share or $50,000, whichever is smaller. All loans must carry what the IRS considers to be a reasonable rate of interest. Specifically, the interest rate charged for a loan can't be more favorable than what the participant can get from a financial institution for a similarly secured loan. Other than if used for a home mortgage, the loan must be paid back on a regular schedule, usually through payroll deduction, in a period not to exceed 60 months. Practice question. Susan participates in a Section 401(k) plan at work that includes loan provisions. Susan has recently enrolled in college and has inquired about the possible consequences of borrowing from the plan to help pay for her education. As her financial planner, what is your advice to her? A. The loan will statutorily be treated as a taxable distribution from the plan. B. The loan must be repayable within 5 years at a reasonable rate of interest. C. The 401(k) plan needs to be rewritten as loans are only available from qualified plans. D. The loan is not being made for reasons of an unforeseeable emergency, and therefore is not possible. The answer is B. For a loan not to be treated as a taxable distribution for tax purposes, it must be repayable within 5 years at a reasonable rate of interest. The unforeseeable emergency requirements are found in a Section 457 plan. Net unrealized appreciation, NUA. Many employers enable employees to buy the stock or bonds of their company inside the 401(k) or other retirement plans. The distribution of employer securities is sometimes eligible for special treatment under the tax code. Those receiving a distribution of employer securities from a qualified retirement plan may be able to defer the tax on the net unrealized appreciation, NUA, in the securities. The NUA is the net increase in the securities value while they were in the plan's trust. If taken as a lump sum distribution, the participant has the option of deferring tax on all of the NUA. A lump sum distribution is defined as the disbursement of the entire vested account balance within one taxable year as the result of a triggering event. Triggering events are limited to separation from service, attainment of age 59 and a half, or death. In order to qualify for the NUA treatment, an employee must complete the entire distribution within the same calendar year. How does this work? Normally, the entire value of a distribution from a qualified plan is taxed as ordinary income. Even if rolled over into an IRA when ultimately distributed, the entire value will be taxed as ordinary income. However, when using the NUA approach, only the original cost basis, as supplied by the employer, is subject to tax. Any unrealized appreciation will be taxed as a long-term capital gain whenever sold. And to make things even sweeter, as long as it is held more than 12 months, any further appreciation is taxed as a long-term capital gain. Let's take a look at an example. Example: George has been an employee of KAPCO Manufacturing Company for 20 years. He is turning 65 this year and plans to retire. In his 401k plan, he has assets of $600,000, of which $250,000 is KAPCO stock with a cost basis of $100,000. At retirement, George should transfer the $350,000 that is not KAPCO stock into an IRA. That will defer taxes on that money. Then the $250,000 of KAPCO stock should be transferred into a regular, taxable brokerage account. In the year of retirement, George will have to report the $100,000 cost basis as ordinary income. However, the $150,000 in unrealized appreciation will receive the more favorable long-term capital gains rate when sold. If George holds onto the stock for another 5 years and it appreciates by another $50,000, then, upon sale, the entire $200,000 of gain is considered long-term. Summary of distribution rules from both qualified plans and IRAs. Even though we have previously discussed IRA withdrawals, it is worth repeating them here to compare and contrast them with distributions from qualified plans. Distributions from traditional IR, as must generally begin no later than April 1 of the year following the year in which the taxpayer attains age 72. In applying distribution rules, all traditional IRAs and SEPs are treated as a single account and must be liquidated at least to the extent of percentages specified on I or S tables. Qualified plans, however, are not aggregated. Distributions from one qualified plan are not affected by distributions from another. What that means is an individual with multiple IRAs computes the RMD from each, but can elect to distribute the amounts from each IRA or select the IRS from which to make the distribution. In the case of multiple qualified plans, the individual worked for more than one employer and did not roll over the earlier employer's plan. The required RMD must be taken from each plan. There is no combining as there is with IRAs. Early withdrawal penalties. In general, withdrawals from both IRAs and qualified plans are taxed as ordinary income. However, withdrawals from such arrangements occurring before owners turn age 59 and a half are subject to an additional 10% early withdrawal tax. Withdrawals from both escape that 10% tax when they are made on account of death or total disability, correcting excess contributions, or as a series of substantially equal payments over the life of the plan participant and beneficiary, if applicable. Only in the case of a qualified plan is the penalty avoided by using a Qualified Domestic Relations Order, Quadro. Qualified Domestic Relations Order, Quadro. As just stated, premature distributions that are taken pursuant to a Qualified Domestic Relations Order, or Quadro, are exempt from the 10% early withdrawal tax. That is, when the plan participant distributes a portion of the plan to a spouse or former spouse who is under 59 and a half years of age, the participant is not charged the 10% tax for an early withdrawal. A quadro is a judgment, decree, or order usually issued in the course of divorce proceedings for a retirement plan to pay child support, alimony, or marital property rights to a spouse, former spouse, child, or other dependent of a participant. The quadro must contain certain specific information, such as the plan participant and each alternate pay's name and last known mailing address, and the amount or percentage of the participant's benefits to be paid to each alternate pay. A spouse or former spouse who receives quadro benefits from a retirement plan reports the payments received as if they were a plan participant. That means if they are under 59 and a half, They are liable for the 10% early withdrawal tax. An individual may be able to roll over tax-free all or part of a distribution from a qualified retirement plan that they received under a quadro, but only if they are the employee's spouse or former spouse. In that case, they can roll it over just as if they were the employee receiving a plan distribution and choosing to roll it over. A quadro distribution that is paid to a child or other dependent is taxed to the plan participant and will incur the 10% early withdrawal tax if the recipient is under 59 and a half. A quadro applies only to assets in a qualified employer plan. It would not be applicable to an IRA or SSEP. Test topic alert. Although pre-age 59 and a half withdrawals from IRAs for education and a first-time home purchase escape the early withdrawal penalty, withdrawals from qualified plans for those purposes do not. The 10% tax will not apply on withdrawals from either of these before age 59 and a half, however, if the distribution is made to a beneficiary on or after the death of the employee/individual. The distribution is made because the employee/individual acquires a qualifying disability, or the distribution is made as a part of a series of substantially equal periodic payments under IRS Rule 72. Beginning after separation from service with the employer maintaining the plan before the payments begin, and made at least annually for the life or life expectancy of the employee/individual or the joint lives or life expectancies of the employee/individual and his designated beneficiary. Except in the case of death or disability, the payments under this exception must continue for at least 5 years or until the employee/individual reaches age 59 and a half, whichever is the longer period. This applies when the separation of service occurs once the employee has attained age 55. Take note. After a person begins taking distributions from an IRA under Rule 72, contributions, asset transfers, or rollovers are not permitted while receiving payments. Penalty tax on failure to make required minimum distributions. As with IRAs, other than a Roth IRA, failure to distribute the required amount from qualified plans generates a 50% penalty tax on the shortfall in addition to ordinary income taxation. However, as mentioned earlier, and of particular importance as employees are working to much later ages than in previous generations, there are no RMDs from a qualified plan while still employed by the sponsor of that plan, regardless of your age. Withholding on eligible rollover distributions from qualified plans. Distributions paid to an employee are subjected to a mandatory federal withholding of 20% if the distribution is an eligible rollover distribution. Eligible rollover distributions, those which can be rolled over or transferred without current taxation, do not include the following RMDs. A hardship distribution, substantially equal lifetime payments, HSAPP. A distribution of an excess contribution, or a loan that is treated as a deemed distribution. Take note. An employee may avoid the 20% withholding by having the distribution processed as a direct rollover to an eligible retirement plan. In a direct rollover, the distribution check is made payable to the trustee or custodian of the receiving retirement plan. 10% early distribution penalty exceptions by plan types. Traditional, Roth, and SEP IRAs. Death, qualified pension, profit sharing, and TSA 403B plans, 401k, and simple plans. Traditional, Roth, and SEP IRAs. Disability, qualified pension, profit sharing, and TSA 403B plans, 401k, and simple plans. Traditional, Roth, and SEP IRAs. Separation from service after reaching age 55. Qualified pension, profit sharing, and TSA 403B plans, 401k, and simple plans. Certain medical expenses. Qualified pension, profit sharing, and TSA 403B plans, 401k, and simple plans. Traditional, Roth, and SEP IRAs. HUDROs. Qualified pension, profit sharing, and TSA 403B plans, 401k, and simple plans. To reduce excess contributions or deferrals. Qualified pension, profit sharing, and TSA 403B plans, 401k, and simple plans. Traditional, Roth, and SEP IRAs. As substantially equal payments over life. Qualified pension, profit sharing, and TSA 403B plans, 401k, and simple plans. 401k, and simple plans. traditional, Roth, and SEP IRAs. First-time home purchase, traditional, Roth, and SEP IRAs. Higher education expenses, traditional, Roth, and SEP IRAs. Health insurance premiums while unemployed, traditional, Roth, and SEP IRAs. Summary of rollover and transfer rules, traditional, Roth, and SEP IRAs. Following is a summary of the rules that apply to moving money from one tax-deferred account to another. Here are the 3 key points. 1. Direct rollover in the event the qualified plan calls for a distribution upon separation from service. A request can be made to the plan administrator to send the payment directly to another retirement plan or to an IRA. In this case, there are no taxes withheld from the amount transferred, and no income is reported for tax purposes. 2. Trustee-to-trustee transfer if an investor wishes to change trustees for an IRA, such as moving the account to another firm or mutual fund group. Upon request, the trustee or custodian for the old IRA will make the payment directly to the trustee of the new IRA. In some cases, the IRA distribution may be made to the trustees of an employer-sponsored plan in this fashion. In either case, there are no taxes withheld from the amount transferred, and no income is reported for tax purposes. 3. 60-day rollover in the event the distribution from an IRA or qualified employer plan is paid directly to the participant. There is the option to deposit all or any part of it to another IRA or qualified plan within 60 calendar days. However, there will be a 20% withholding tax on this distribution from the qualified plan. Withholding is optional on the IRA distribution. That means in order to avoid any tax, the individual will have to find other funds to deposit to cover the withheld amount. Any portion of the distribution that is not rolled over will be subject to tax, and if under age 59 and a half, will be subject to the 10%, unless qualifying for one of the exemptions from the penalty tax. Knowledge Check 18.4. Question 1. Withdrawals from a traditional IR made by an owner aged 54 would be exempt from the 10% penalty in all the following circumstances except: A. When the taxpayer is disabled. B. When the withdrawal is done under a qualified domestic relations order quadro. C. To pay for certain medical expenses. D. The first-time purchase of a primary residence, $10,000 lifetime maximum. The correct answer is B. The quadro is applicable to qualified plans, not to an IRA. Death or disability evades the 10% penalty for those under 59 and a half. The same is true for certain medical expenses. The exam will not get into the specific details, and the first-time purchase of a primary residence. Question 2. A taxpayer is a participant in a 401k plan. The vested value in the account is $90,000. If the individual wishes to take out a loan, the maximum permitted amount is A. $9,000, B. $45,000, C. $50,000, D. $90,000. The correct answer is B. Assuming the plan permits loans, the IRS limits them to a maximum of the lesser of 50% of the vested value, or $50,000. In this case, 50% of $90,000 is less than $50,000. Question 3. Which of the following parties may be an alternate pay pursuant to a qualified domestic relations order quadro? Roman numeral 1. An aunt or uncle of the plan participant. Roman numeral 2. A spouse or former spouse. Roman numeral 3. A child. Roman numeral 4. An individual who is legally a dependent of the plan participant. A. 1, 2, 3, and 4. B. 2, 3, and 4. C. 2 and 3. D. 1 and 4. The correct answer is B. For purposes of the quadro provisions, an alternate pay cannot be anyone other than a spouse, former spouse, child, or other dependent of a participant. That leaves out aunts and uncles, cousins, and siblings unless something in the question indicates that they are dependents of the plan participant. Lesson 18.5, ERISA. Learning Objective 18. G. Identify the purpose of the Employee Retirement Income Security Act of 1974 and its primary features, including the fiduciary obligations under the Uniform Prudent Investor Act. ERISA. ERISA guidelines for the regulation of retirement plans include the following. Eligibility. If a company offers a retirement plan, all employees must be covered if they are 21 years old or older, have 1 year of service, and work 1,000 hours per year. The Secure Act added a provision for permanent part-time employees covered under a 401k plan. These are individuals who worked at least 500 hours per year for the previous 3 consecutive years. Funding. Funds contributed to the plan must be segregated from other corporate assets. The plan's trustees have a fiduciary responsibility to invest prudently and manage funds in a way that represents the best interests of all participants. Vesting. Employees must be entitled to their entire retirement benefit amounts within a certain time, even if they no longer work for the employer. Communication. The retirement plan must be in writing, and employees must be kept informed of plan benefits, availability, account status, and vesting procedure no less frequently than annually. Take note. ERISA is often referred to as the Pension Reform Act, but it regulates almost all types of employee benefit plans and personal retirement plans. ERISA regulations apply to private sector, corporate, or private tax-exempt entities, plans only. Plans for federal or state government workers, public sector plans, are not subject to ERISA. Fiduciary responsibility under ERISA. Because most retirement plans were set up under trust agreements, when it became time for ERISA to address fiduciary responsibilities of plan trustees, there was a long history of trust law to fall back on. It all began with the prudent man rule. That legal standard was established in 1830 by a Massachusetts court decision, Harvard College v. Amory, 9 Pick. 26 Mass. 446, 461, 1830. All that is required of a trustee to invest is that he shall conduct himself faithfully and exercise sound discretion. He is to observe how men of prudence, discretion, and intelligence manage their own affairs, not in regard to speculation, but in regard to the permanent disposition of their funds, considering the probable income as well as the probable safety of the capital to be invested. Although it was possible to place common stock in a trust portfolio, the emphasis seemed to be on taking defensive positions that, while preserving capital, did expose the portfolio to inflation risk. It was clear that some updating was necessary. Beginning with the dynamic growth of the stock markets in the late 1960s, the investment practices of fiduciaries experienced significant change. As a result, the Uniform Prudent Investor Act, OPIO, was adopted in 1994 as an attempt to update trust investment laws in recognition of those many changes. One of the major influences on this legislation was the growing acceptance of modern portfolio theory. The OPIO, now used in almost every state, makes 5 fundamental alterations in the former criteria for prudent investing. Those changes are as follows. The standard of prudence is applied to any investment as part of the total portfolio, rather than to individual investments. In this context, the term portfolio means all of the trust's or estate's assets. The trade-off in all investments between risk and return is identified as the fiduciary's primary consideration. All categorical restrictions on types of investments have been removed. The trustee can invest in anything that plays an appropriate role in achieving the risk/return objectives of the trust and meets the other requirements of prudent investing. The well-accepted requirement that fiduciaries diversify their investments has been integrated into the definition of prudent investing. The much-criticized former rule forbidding the trustee to delegate investment functions has been reversed. Delegation is now permitted, subject to safeguards. With greater numbers of trustees delegating investment decisions to investment advisors, NASA has determined that you must know how the OPIO affects your role. Here are some thoughts that will help you on the exam. A trustee must invest and manage trust assets as a prudent investor would by considering the purposes, terms, distribution requirements, and other circumstances of the trust. In a trustee's investment and management decisions about individual assets must be evaluated not in isolation, but in the context of the total portfolio and as a part of an overall investment strategy with risk and return objectives that are reasonably suited to the trust. Among circumstances that a trustee must consider in investing and managing trust assets are any of the following that are relevant to the trust or its beneficiaries. General economic conditions, the possible effect of inflation or deflation, the expected tax consequences of investment decisions or strategies, the role that each asset plays within the total portfolio, including financial assets, tangible and intangible personal property, and real property, the expected total return from income and the appreciation of capital, other resources of the beneficiaries, needs for liquidity, regularity of income, and preservation or appreciation of capital, and an asset's special relationship or special value, if any, to the purposes of the trust or to one or more of the beneficiaries. A trustee who has special skills or expertise, or who is named trustee in reliance upon the trustee's representation that the trustee has special skills or expertise, has a duty to use those special skills or expertise. This particular item led to the most stringent standard, that of the prudent expert for one acting as a professional money manager. For those without special skills or expertise, a trustee may delegate investment and management functions as long as the trustee exercises reasonable care, skill, and caution in selecting the advisor, establishing the scope and terms of the delegation, consistent with the purposes and terms of the trust, and periodically reviewing the advisor's actions to monitor the advisor's performance and compliance with the terms of the delegation. However, something that cannot be delegated is the amount and timing of distributions. If it is for a trust, the trust document usually spells out those provisions, and, in the case of a qualified retirement plan, the plan document accomplishes the same purpose. A trustee who complies with all of the above is not liable to the beneficiaries or the trust for the decisions or actions of the advisor to whom the function was delegated. In performing a delegated function, the advisor owes a duty to the trust to exercise reasonable care to comply with the terms of the delegation. Practice question. Which of the following would best describe a prudent investor? A. A person in a fiduciary capacity who invests in a prudent manner. B. A trustee who invests with reasonable care, skill, and caution. C. An investment advisor representative handling a discretionary account. D. The custodian for a minor under the Uniform Transfers to Minors Act. The answer is B. Although all of these may have a fiduciary responsibility, the definition, as expressed in the Uniform Prudent Investor Act of 1994, requires reasonable care, skill, and caution. Section 404 of ERISA. Specifically, there are a number of regulations that apply directly to retirement plan fiduciaries. The details are spelled out in ERISA Section 404. Under Section 404 of ERISA, every person who acts as a fiduciary for an employee benefit plan must perform his responsibilities in accordance with the plan document specifications. Under ERISA, trustees cannot delegate fiduciary duties, but they can delegate investment management responsibilities to a qualified investment manager. Test topic alert. Although the OPO permits the delegation of portfolio management decisions, trustees cannot delegate certain fiduciary duties, such as determining the amount and timing of distributions. Fiduciary responsibilities to the plan are explicit. With respect to the plan, fiduciaries must act solely in the interest of plan participants and beneficiaries, for the exclusive purpose of providing benefits to participants and their beneficiaries and defraying reasonable plan expenses, with the care, skill, prudence, and diligence under the circumstances then prevailing that a prudent professional would use, known as the prudent expert rule, to diversify investments to minimize the risk of large losses, unless doing so is clearly not prudent under the circumstances, and in accordance with the governing plan documents unless they are not consistent with ERISA. Under ERISA provisions, the fiduciary must be as prudent as the average expert, not the average person. To act with care, skill, prudence, and caution, the fiduciary must also diversify plan assets, make investment decisions under the prudent expert standard, monitor investment performance, control investment expenses, and not engage in prohibited transactions. Take note. A plan participant or beneficiary who controls his or her specific plan account is not a fiduciary. Test topic alert. You may be required to know that transaction cost is not a determining factor in security selection. That is, when the fiduciary is deciding what security will fit the needs of the portfolio, the amount of commission involved in the purchase is not considered when determining if that security is an appropriate addition. Investment policy statement. Although it is not specifically mandated under ERISA, it is strongly suggested that each employee benefit plan have an investment policy statement, preferably in writing, that serves as a guideline for the plan's fiduciary regarding funding and investment management decisions. Investment policy statements address the specific needs of the plan. For employee benefit plans that use outside investment managers, such as mutual funds, the fiduciary must ensure that the investment alternatives available to plan members are consistent with the policy statement. A typical investment policy statement, IPS, will include investment objectives for the plan, determination for meeting future cash flow needs, investment philosophy, including asset allocation style, investment selection criteria, but not the specific securities themselves, and methods for monitoring procedures and performance. Test topic alert. The IPS will not include specific security selection. Prohibited investments under ERISA. It is important to differentiate between prohibited investments and prohibited transactions. Similar to IRAs, qualified plans cannot invest in art, antiques, gems, coins, collectibles, or alcoholic beverages. They can invest in precious metals, such as gold and silver coins minted by the U.S. Treasury, only if they meet various federal requirements. ERISA also limits how much some plans can invest in the employer's stock. Although not specifically prohibited under ERISA, the exam will never find writing uncovered calls in a retirement plan to be a prudent decision. Prohibited transactions by the plan fiduciary. ERISA allows for a wide range of investments and investment practices, but a plan fiduciary is strictly prohibited from any conflicts of interest, such as self-dealing dealing with plan assets in his own interest or for his own account, acting in a transaction involving the plan on behalf of a party with interests adverse to the plan, and receiving any compensation for his personal account from any party dealing with the plan in connection with plan transactions. Test topic alert. Under Section 407 of ERISA, a plan may not acquire any security or real or personal property of the employer if immediately after such acquisition the aggregate fair market value of employer securities and employer real property held by the plan exceeds 10% of the fair market value of the assets of the plan. Party in interest. ERISA has a rather broad definition of the term party in interest, but it basically includes anyone who can have an impact on an employee benefit plan, including those who render advice to the plan. It is not an overstatement to say that all transactions involving parties in interest to an ERISA-covered plan are prohibited unless there is an exemption for them. Test topic alert. Anyone in the position of trustee over the assets of a qualified plan may not use the plan assets to make loans to the employer, even if failure to do so could lead to the company suffering a financial failure. Safe harbor provisions of Section 404(c). Several times we have mentioned the requirement for the plan fiduciary to diversify the plan's investments. There is a particular part of ERISA, Section 404s, dealing with 401k plans that provides a safe harbor from liability for the trustee if certain conditions are met. Under ERISA Section 404s, a fiduciary is not liable for losses to the plan resulting from the participant's selection of investment in his or her own account, provided the participant exercised control over the investment and the plan met the detailed requirements of a Department of Labor regulation, that is, the 404(c) regulation. There are three basic conditions of this regulation: investment selection, investment control, communicating required information. Let's look at these individually. Investment selection. A 404(c) plan participant must be able to materially affect portfolio return potential and risk level, choose between at least 3 investment alternatives, and diversify the investment to minimize the risk of large losses. The practical effect of this is that it would be highly unlikely for the plan to meet the requirements by limiting the available choices to highly speculative funds, such as junk bond funds and highly aggressive growth funds. Test topic alert. The trustee of a 401k would be able to reduce her ERISA fiduciary exposure and meet the safe harbor provisions of 404s if the plan offered a broad index fund, a medium-term government bond fund, and a cash equivalent fund. It isn't the number of funds that counts, it is the different asset classes available. For example, if the plan offered 10 investment options instead of 3, but they were all of the same asset class, such as 10 equity funds or 10 bond funds, that would not comply with 404(c). Investment control. Investment control is defined as allowing employees the opportunity to exercise independent control over the assets in their account by letting them make their own choices among the investment options companies have selected, at least 3. Informing employees that they can change their investment allocations at least quarterly. A growing number of plans allow employees to make plan changes daily. And even though the employees maintain investment control, the plan fiduciary is not relieved of the responsibility to monitor the performance of the investment alternatives being offered and replace them when necessary. Communicating required information. Communicating required information means making certain information available upon request, such as prospectuses and financial statements or reports relating to the investment options, Included must be information such as annual operating expenses and portfolio composition. A statement that the plan is intended to constitute an ERISA Section 404C plan and that plan fiduciaries may be relieved of liability for investment losses. A description of the risk and return characteristics of each of the investment alternatives available under the plan. An explanation of how to give investment instructions, and allowing real-time access to employee accounts either by telephone or the internet. Test topic alert. Although we have made extensive reference to control in the previous pages, that must be taken in context. Participants in a 401k do have a choice of investments, but that choice is limited to the package included in the employer's plan. Participants in a 403b plan have even fewer choices. Annuities are the primary investment asset in those plans. If investment choice is the criteria, then the greatest control is with an IRA. See the earlier discussion on IRA investments. Practice question. To comply with the safe harbor requirements of Section 404 of ERISA, the trustee of a 401k plan must Roman numeral 1. Offer plan participants at least 10 different investment alternatives. Roman numeral 2. Allow plan participants to exercise control over their investments. Roman numeral 3. Allow plan participants to change their investment options no less frequently than monthly. Roman numeral 4. Provide plan participants with information relating to the risks and performance of each investment alternative offered. A. 1 and 3. B. 1 and 4. C. 2 and 3. D. 2 and 4. The answer is D. To comply with the safe harbor provisions of ERISA's Section 404, the plan trustee must allow each participant control over their investments and furnish them with full performance and risk information. Choice D contains both of these. The rule only mandates a minimum of 3 alternatives and quarterly changes. Summary Plan Description, SPD. Sometimes referred to as the Summary Plan document, one of the most important documents participants are entitled to receive automatically when becoming a participant of an ERISA-covered retirement plan or a beneficiary receiving benefits under such a plan is a summary of the plan, called the Summary Plan Description, SPD. Under regulations of the U.S. Department of Labor, DLL, the plan administrator is legally obligated to provide to participants, free of charge, the SPD. The Summary Plan Description is an important document that tells participants what the plan provides and how it operates. It provides information on when an employee can begin to participate in the plan, how service and benefits are calculated, when benefits become vested, when and in what form benefits are paid, and how to file a claim for benefits. Unlike the investment policy statement, it does not deal with the investment characteristics of the plan. Top-heavy plan. Because all qualified plans must be non-discriminatory, the IRS has defined a top-heavy 401k plan as one in which a disproportionate amount of the benefit goes to key employees. The plan must be tested on an annual basis to ensure that it complies with the regulations. On the exam, you may be asked to define a top-heavy plan and will have to choose between key employees and highly compensated employees. The easiest way to remember is to match the K in 401k with the word key. Safe Harbor 401k plan. Several years after the top-heavy rules were written, relief was offered in the form of the Safe Harbor 401k. A plan does not have to undergo annual top-heavy testing if set up properly. There are 2 basic choices for setting up a Safe Harbor plan. The employer will either match employee contributions or use a non-elective formula. The employees don't have to contribute of eligible employee compensation to satisfy IRS requirements. If a matching formula is elected, in either case, all employer contributions are immediately vested. The base formula is 100% of elective deferrals up to 3% of compensation and then 50% of elective deferrals on the next 2% of compensation. This means the maximum match is 4%, 100% times 3% plus 50% times 2% equals 3% plus 1%. Or, the employer may elect the non-elective formula minimum of 3% of all eligible participants' compensation. Under this formula, all eligible employees would receive this non-elective contribution, whether making salary reduction contributions or not. Knowledge Check 18.5. Question 1. Complying with the Safe Harbor provisions of ERISA Section 404C requires meeting 3 specific conditions. Which of the following is not one of those 3? A. Investment control. B. Investment performance. C. Investment selection. D. Communicating required information. The correct answer is B. The Section 404C, Safe Harbor, places limits on the responsibility of certain plan fiduciaries when the required conditions are met. There is no standard of investment performance. Plan participants must have the ability to make investment decisions in their account control. There must be at least 3 different types of investments to choose from selection. Certain information, such as accessibility to participant accounts by phone or online, is also a requirement. Question 2. A significant portion of ERISA deals with fiduciary responsibility. Which of the following would be considered a prohibited transaction? A. The fiduciary selling 1,000 shares of a personally owned stock to the plan. B. The purchase of art or antiques for the plan. C. Investing more than 50% of the plan's assets in the company's stock. D. Using plan assets to build a collection of rare automobiles. The correct answer is A. Be careful. There is a difference between a prohibited transaction, the subject of this question, and a prohibited investment. Self-dealing by the plan fiduciary, such as buying securities from or selling securities to the plan, is a prohibited transaction. The other choices here represent investments that are prohibited. Normally, the decision of the plan fiduciary to own company stock in the company's ERISA-qualified plan is limited to 10% of the plan's total assets. Lesson 18.6. Education Funding Programs. Learning Objective 18. H. Compare the differences between the 2 major types of education funding programs. The examination will deal with 2 different types of programs designed to offer tax benefits when saving for education. We will begin with the Coverdell ESA and then move on to the Section 529 plan. Coverdell Education Savings Accounts, ESAs. The Taxpayer Relief Act of 1997 also created education IRAs. In 2002, these were renamed Coverdell ESAs. ESAs allow after-tax contributions for student beneficiaries. Contributions must be made in cash and must be made on or before the date on which the beneficiary attains age 18 unless the beneficiary is a special needs beneficiary, an individual who, because of a physical, mental, or emotional condition, requires additional time to complete their education. Coverdell ESAs fund educational expenses of a designated beneficiary by allowing after-tax, non-deductible contributions to accumulate on a tax-deferred basis. When distributions are made from a Coverdell ESA, the earnings portion of the distribution is excluded from income when it is used to pay qualified education expenses. Withdrawn earnings are taxed to the recipient, beneficiary, and subject to a 10% tax penalty when they are not used to pay qualified education expenses. Take note. If the money is not used by a beneficiary's 30th birthday, except for a special needs beneficiary, it must be distributed, and the earnings are subject to ordinary income taxes and a 10% penalty. ESA contributions. Under current law, the maximum annual contribution limit to a Coverdell ESA is $2,000 per beneficiary. Because this number is considered permanent, it can and does appear on the exam. In addition to qualified higher education expenses, post-secondary education, the account can also be used for elementary and secondary education expenses and for public, private, or religious schools. The contribution to a Coverdell ESA may be limited depending on the amount of a GI and filing status. Allowable contribution. Full contribution of $2,000 at a GI of and below. Single filers, $95,000. Joint filers, $190,000. Partial phase-out begins at single filers, $95,001. Joint filers, $190,001. No contributions may be made at a GI of and above. Single filers, $110,000. Joint filers, $220,000. Take note. There is nothing to prevent more than one individual from contributing to a Coverdell ESA. The annual limit applies to each beneficiary. Parents and grandparents can contribute to a single account as long as the $2,000 limit per child is not exceeded in any given year. Other changes made since the original education IRA include provisions that allow contributions to continue past age 18 for beneficiaries with special needs, extending the period during which corrective withdrawals can be made to avoid the early distribution and excess contribution penalties, and allowing Coverdell ESA contributions for any year to be made up to April 15 of the following year, just like contributions to your IRA. Test topic alert. Here are some key test points about Coverdell ESAs. Contributions can be made by parents and other adults. The total for one child is still $2,000. Contribution limit is $2,000 per year per child until the child's 18th birthday. Contributions are not tax deductible, but all earnings are tax deferred. Distributions are tax-free if they are taken before age 30 and used for eligible education expenses. If the accumulated value in the account is not used by age 30, the funds must be distributed and subject to income tax and a 10% penalty on the earnings or rolled over into a different Coverdell ESA for another family member. Their definition of family is extremely broad and, in addition to the obvious, includes cousins, aunts and uncles, and even in-laws. Practice question. The maximum amount that may be invested in a Coverdell ESA in 1 year is A. $500 per parent, B. $2,000 per child, C. $500 per couple, D. $2,000 per couple. The answer is B. Only $2,000 may be invested in each child's ESA per year. If a couple has 3 children, they may contribute $6,000 in total or $2,000 per child per year. Take note. A special needs beneficiary has different rules. Contributions may be made after age 18 and withdrawals may be delayed past age 30. Section 529 Plans. Section 529 plans, legally known as Qualified Tuition Programs, QTPs, are state-operated investment plans that were designed to give families a way to save money for college with substantial tax benefits. With the passage of the Tax Cuts and Jobs Act of 2017, these plans extended the qualification that K-12 schooling as well. That change will be covered separately. There are 2 basic types of 529 plans: prepaid tuition plans and college savings plans. Prepaid tuition plans. Prepaid tuition plans generally allow college savers to prepay for tuition at participating colleges and universities, and, in some cases, room and board can be prepaid as well. Most prepaid tuition plans are sponsored by state governments and have residency requirements. The basic concept is that if you pay for the tuition at today's rates, the child will be able to attend in the future, regardless of how much higher the tuition is. College savings plans. College savings plans generally permit the contributor, known as the account holder, to establish an account for a student, the beneficiary, for the purpose of paying the beneficiary's qualified college expenses. The typical plan offers a number of investment options, including stock mutual funds, bond mutual funds, and money market funds. A very popular option is the age-based portfolio that automatically shifts toward more conservative investments as the beneficiary gets closer to college age. Withdrawals from college savings plans can generally be used at any college or university, regardless of the state carrying the plan or the state of residence. Differences between the 2 QTPs. The following chart outlines some of the major differences between prepaid tuition plans and college savings plans. Prepaid tuition plan locks in tuition prices at eligible public and private colleges and universities. College savings plan, no lock on college costs. Prepaid tuition plan, all plans cover tuition and mandatory fees only. Some plans allow families to purchase a room and board option or use excess tuition credits for other qualified expenses. College savings plan covers all qualified higher education expenses, including the following: tuition, room and board, mandatory fees and books, computers, etc. if required. Prepaid tuition plan, most plans set lump sum and installment payments prior to purchase based on age of beneficiary and number of years of college tuition purchased. College savings plan, many plans have contribution limits in excess of $250,000. Prepaid tuition plan, many state plans guaranteed or backed by state. College savings plan, no state guarantee. Most investment options are subject to market risk. Your investment may make no profit or even decline in value. Prepaid tuition plan, most plans have age grade limits for beneficiary. College savings plan, no age limits. Open to adults and children. Prepaid tuition plan, most state plans require either owner or beneficiary of plan to be a state resident. College savings plan, no residency requirement. However, non-residents may only be able to purchase some plans through financial advisors or brokers. Prepaid tuition plan, most plans have limited enrollment period. College savings plan, enrollment open all year. Source: Smart Saving for College, FINRA. Practice question. One of your clients is a successful professional couple with earnings in excess of $500,000 per year. They are interested in providing a funding source for post-secondary education for their grandchildren, which would be appropriate to discuss with them. A. The Coverdell ESA. B. The Section 529 Plan. C. Both the Coverdell ESA and the Section 529 Plan. D. Neither the Coverdell ESA nor the Section 529 Plan. The answer is B. Although both plans will help them with their objective, their earnings are above the Coverdell ESI limits, so choice B is the best answer. Tax treatment of 529 plans. A major factor in investing in a 529 plan is tax benefits. Although contributions are made with after-tax money, earnings in 529 plans are not subject to federal tax, and in most cases, state tax, so long as withdrawals are for eligible college expenses, such as tuition and room and board, and even a computer. However, money representing earnings that is withdrawn from a 529 plan for ineligible expenses will be subject to income tax and an additional 10% federal tax penalty. Unlike the IRS, many states offer deductions or credits against state income tax for investing in a 529 plan. But eligibility for these benefits is generally limited to participants in a 529 plan sponsored by your state of residence. Withdrawal restrictions. Both plans place restrictions on withdrawals. With limited exceptions, you can only withdraw money that you invest in a 529 plan for eligible college expenses without incurring taxes and penalties. However, you can roll over any unused funds to a member of the beneficiary's family without incurring any tax liability as long as the rollover is completed within 60 days of the distribution. Immediate family includes the following: son, daughter, stepchild, foster child, adopted child, or a descendant of any of them. Brother, sister, stepbrother, or stepsister. Father or mother or ancestor of either. Stepfather or stepmother. Son or daughter of a brother or sister. Brother or sister of the father or mother. Son-in-law, daughter-in-law, father-in-law, mother-in-law, brother-in-law, or sister-in-law. The spouse of any individual listed above. First cousin. Test topic alert. The earnings portion of a non-qualified distribution is taxable to the individual who receives the payment, either the account owner or the designated beneficiary. If the payment is not made to the designated beneficiary or to an eligible educational institution for the benefit of the designated beneficiary, it will be deemed to have been made to the account owner. Test topic alert. What if you don't like the 529 plan you are invested in? Can you make a change? Federal tax law allows a tax-free rollover of any or all of a 529 account from the current 529 plan to a different 529 plan, but only once in any 12-month period unless there is a change in beneficiary. Just as with an IRA, if the proceeds are distributed, they must be reinvested in the new plan within 60 days. Therefore, assets in the QTP may be moved from the plan of one state to the plan of another no more frequently than once per 12 months. Test topic alert. As of the date of this question, there are more than 400 institutions of higher learning located outside of the United States where Section 529 plans and Coverdell ESAs may be used to pay qualified expenses. The expense for room and board residence cost qualifies only to the extent that it isn't more than the greater of the following two amounts. 1. The allowance for room and board as determined by the eligible educational institution that was included in the cost of attendance for federal financial aid purposes for a particular academic period and living arrangement of the student. Or 2. The actual amount charged if the student is residing in housing owned or operated by the eligible educational institution. Impact on financial eligibility. Investing in a 529 plan, or Coverdell ESA, will generally impact a student's eligibility to participate in need-based financial aid. Both types of plans are treated as parental assets in the calculation of the expected family contribution toward college costs, regardless of whether the owner is the parent or the student. This computation is done on the FAFSA form, free application for federal student aid. Having money in a 529 plan is a better deal than if they were non-529 assets of the student, because parental assets are assessed on the FAFSA at a maximum 5.64% rate in determining the student's expected family contribution, EFC, rather than the 20% rate on non-529, or ESA, assets owned by the student, such as those in a UTMA account. These rates will not be tested, but the concept may be. Contributions to a 529 plan. Any adult can open a 529 plan for a future college student. The donor does not have to be related to the student. With a 529 plan, the donor can invest a small or substantial lump sum or make periodic payments. When the student is ready for college, the donor withdraws the amount needed to pay for qualified education expenses, for example, tuition, room and board, and books. Contributions are made with after-tax dollars, but qualified withdrawals are exempt from federal taxation. As stated above, taxation varies from state to state. If any tax is due on withdrawal, it is the responsibility of the student, not the donor. A donor, typically a parent or grandparent, may contribute a maximum of $80,000, $160,000 if married, in a single year for each Section 529 plan beneficiary without gift tax consequences. This represents a 5-year advance on the 2022 $16,000 per recipient annual gift tax exclusion. The donor of the 529 plan assets retains control of most 529 accounts and may take the money back at any time, although a 10% penalty tax may apply. Take note. Although it probably won't be tested, for those who bunch the annual gift exclusion allowing 5 years' worth at one time, this is not limited to one time per beneficiary. If started with a 1-year-old grandchild, the grandparents can do this again when the child is 6, 5 years have elapsed, and then again at 11, and so forth, as long as the total contribution does not exceed the state's limit. It surely would be nice to have grandparents like that, wouldn't it? Offering circular. These plans are considered municipal fund securities, and, under the rules of the Municipal Securities Rulemaking Board, MSRB, require delivery of an official statement, sometimes called an offering circular, but never referred to as a prospectus on the exam. Investment options for 529 plans. In general, these plans offer several different portfolio options, ranging from aggressive, for cases, these portfolios are registered mutual funds. In others, they are separately managed accounts containing stocks and or bonds. Some portfolios include bank-insured CDs, and some of the states offer managed fixed income pools. Test topic alert. However, U.S. savings bonds are not available as investment options in Section 529 plans. Test topic alert. One significant difference between investments in an ESA and in a 529 is that the ESA functions like a self-directed IRA. That is, the investments are chosen at the discretion of the individual managing the account. In the case of the 529, you are limited to the choices offered by the plan. Effective TCJA 2017. The rule permits K-12 withdrawals as qualified expenses for attendance at a public, private, or religious elementary or secondary school. The definition of qualified expenses for K-12 is $10,000 per student annually for tuition only. Effective the Setting Every Community Up for Retirement Enhancement, Secure Act. Qualified expenses include payment of interest or repayment of principal on qualified student loans with a lifetime limit per beneficiary of $10,000. Take note. Key points to remember about Section 529 plans include the following. The dollar amount of allowable contribution varies from state to state and may be as high as $500,000. Assets in the account remain under the donor's control even after the student is of legal age. There are no income limitations on donors making contributions to a 529 plan. Similar to Coverdell ESAs, these can be used for educational expenses incurred below the post-secondary level after high school, but with expense limitations. There are no age restrictions, that is, if at any age an individual desires to go back to school, a 529 plan may be used. Earnings are exempt from federal taxes, as are withdrawals if they go toward qualified post-secondary educational expenses. Most states hire experienced investment management companies to manage their accounts. In almost all cases, residents do not pay state income tax on qualified withdrawals from home state plans. In a majority of the states with an income tax, residents are afforded an income tax deduction or credit for a portion of their contribution. If funds are withdrawn for purposes other than education, earnings are subject to a 10% penalty as well as federal income tax. States may assess their own penalties. The tax is the obligation of the distributee, student/beneficiary. A child can be a beneficiary of an ESA and a 529. Because of their legal status as municipal fund securities, it is required that an official statement or offering circular is delivered when opening a 529 plan account. Practice question. While in your office, you see that your firm is going to be holding a training session on municipal fund securities. You wish to attend because you are interested in being able to speak intelligently to your clients about A, the difference between go bonds and revenue bonds, B, the difference between using mutual funds or UITs to invest in municipal bonds, C, Section 529 plans, D, Section 457 plans. The answer is C. The Securities and Exchange Commission has stated that certain Section 529 college savings plans established by states or local governmental entities are municipal fund securities. Accordingly, the purchase and sale of state-sponsored Section 529 plans are governed by the rules of the Municipal Securities Rulemaking Board, MSRB. Knowledge Check 18.6. Question 1. All of the following are characteristics of Section 529 savings plans except A. Contributions are deductible on the donor's federal tax return. B. Contributions may be state tax deductible. C. Contributions grow tax deferred. D. Withdrawals are tax-free if used for qualified education expenses. The correct answer is A. Contributions to 529 savings plans are not federally tax deductible. Some states do offer a deduction or a tax credit for investing in the state's plan. Question 2. Two of the most popular methods for saving for education are the Coverdell ESA and the Section 529 plan. Although there are many similarities, there are some significant differences between the two. One of those differences is that the Section 529 plan A allows the funds to be used for any K through 12 expense, while the ESA considers tuition to be the only qualified expense. B has a federally imposed maximum annual contribution, while the ESA's limit is determined by each state. C places a limit on the age by which the funds may be used, while the ESA permits the funds to be used by a beneficiary of any age. D does not place a limit on the earnings of the donor, while the ESA does place such a limit. The correct answer is D. The Coverdell ESA begins to limit the amount of contribution once earnings reach $190,000, filing jointly. Half of that for a single filer. On the other hand, contributions to a Section 529 plan may be without limitation on the donor's income. The other choices are all reversed. That is, the 529 plan is limited to tuition, up to $10,000, as a K through 12 expense, and the federal limit on an ESA is $2,000 annually with a requirement that the funds be used by age 30, excluding special needs beneficiaries. Lesson 18.7, Custodial Accounts and Health Savings Plans. Learning Objective 18. I. Contrast UGMA and UTMA accounts. Long before there were education IRAs and Section 529 plans, a favored way of saving for a child's education, or anything else for that matter, was by the use of a custodial account under the Uniform Gift to Minors Act. In a custodial account, the custodian for the beneficial owner enters all trades. UGMA and UTMA accounts require an adult or a trustee to act as custodian for a minor, the beneficial owner. Any kind of security or cash may be gifted to the account without limitation. The Uniform Law Commissioners adopted the Uniform Gift to Minors Act, UGMA, in 1956, the same year as the Uniform Securities Act. The primary focus then was to provide a convenient way to make gifts of money and securities to minors. Later, it became clear that transfers to Minors Act, UTMA, in 1986. UTMA expands the types of property you can transfer to a minor and provides that you can make other types of transfers besides gifts. Nearly all states have adopted UTMA, but people still tend to refer to UGMA out of habit. For exam purposes, it doesn't matter which law is in effect in your state, because the essential principles of both acts are the same. Opening a UGMA-UTMA account. UGMA-UTMA account applications must contain the custodian's name, minor's name, and Social Security number, and the state in which the UGMA-UTMA is registered. Test topic alert. The minor's Social Security number is used on the account. Custodian. Securities in a UGMA-UTMA account are managed by a custodian until the minor reaches the age of majority or, in the case of a UTMA, the age determined by the specific state. The custodian has full control over the minor's account and can buy or sell securities, exercise rights or warrants, and liquidate, trade, or hold securities. The custodian also may use the property in the account in any way the custodian deems proper for the minor's support, education, maintenance, general use, or benefit. However, the account is not normally used to pay expenses associated with raising a child, such as the 3 basic needs of food, clothing, and shelter. Fiduciary responsibility. A UGMA/UTMA custodian assumes fiduciary responsibilities in managing a minor's account. Restrictions are placed on improper handling of investments in a UGMA/UTMA. The most important limitations follow. UGMAs/UTMAs may be opened and managed as cash accounts only. A custodian may never purchase securities on margin or pledge them as collateral for a loan. A custodian must reinvest all cash proceeds, dividends, and interest within a reasonable period of time. Cash proceeds may be held in an interest-bearing custodial account for a reasonable period. Investment decisions must consider a minor's age and the custodial relationship. Examples of inappropriate investments are commodity futures, naked options, and high-risk securities. Options may not be bought in a custodial account because no evidence of ownership is issued to an options buyer. Covered call writing is normally allowed. Stock subscription rights or warrants must be either exercised or sold. A custodian may be reimbursed for any reasonable expenses incurred in managing the account. Compensation may be paid to the custodian unless the custodian is also the donor. Donating securities. When a person makes a gift of securities to a minor under the UGMA/UTMA laws, that person is the securities donor. A gift under UGMA/UTMA conveys an indefeasible title, that is, the donor may not take back the gift, nor may the minor return the gift until the minor has reached the age of majority. Once a gift is donated, the donor gives up all rights to the property. When the minor reaches the specified age, the property in the account is transferred into the minor's name. UGMA/UTMA rules. Securities professionals should know the following UGMA/UTMA custodial account rules. All gifts are irrevocable. Gifts may be in the form of cash or fully paid securities. An account may have only one custodian and one minor or beneficial owner. A donor of securities can act as custodian or appoint someone to do so. Unless acting as a custodian, parents have no legal control over a UGMA/UTMA account or the securities in it. A minor can be the beneficiary of more than one account, and a person may serve as custodian for more than one UGMA/UTMA, provided each account benefits only one minor. The minor has the right to sue the custodian for improper actions. Take note. Although an investment advisor representative is not responsible for determining whether an appointment is valid or a custodian's activities are appropriate, he should always be sensitive to the appearance of unethical behavior. Practice question. If a customer would like to open a custodial UGMA or UTMA account for his nephew, a minor, the uncle can A. Open the account, provided the proper trust arrangements are filed first. B. Open the account and name himself custodian. C. Open the account, but he needs a legal document evidencing the nephew's parents' prior approval of the account. D. Be custodian for the account only if he is also the minor's legal guardian. The answer is B. The donor may name himself the custodian of a UGMA or UTMA account. No documentation of custodial status is required to open these accounts, and the custodian is not required to be the minor's legal guardian. Registration of UGMA/UTMA securities. Any securities in a UGMA/UTMA account are generally registered in the custodian's name for the benefit of the minor and cannot be solely in the minor's name. So that transfers may be accomplished more expeditiously, securities may be held by custodians in street name. Example. In an account where Marilyn Johns, the donor, has appointed her daughter's aunt, Barbara Wood, as custodian for the account of her minor daughter, Alexis, the account and the certificates would read Barbara Wood as custodian for Alexis Johns, or a variation of this form. When the minor reaches the age of transfer, all of the securities in the account are registered in her name. However, that change in registration is not automatic. The new adult must initiate the transfer. Death of the minor or custodian. If the beneficiary of a UGMA/UTMA dies, the securities in the account pass to the minor's estate, not to the parents or the custodian. If the custodian dies or resigns, either a court of law or the donor must appoint a new custodian. Unique features of the Uniform Transfers to Minors Act (UTMA) account. Although UTMA and UGMA accounts share many characteristics, there are a few important differences. First, although UGMA accounts may not hold real estate, real property, certain partnership interests, and other types of intangible property, UTMA accounts may. Thus, UTMA accounts offer greater investment choice. In many states, UTMA account assets are not required to be transferred upon the age of majority of the beneficial owner, the child. In many UTMA states, the custodian may delay transferring the UTMA assets to the beneficial owner until he reaches age 21 or 25, depending on the particular state statute. Practice question. One of the reasons you might suggest that a client with an 8-year-old child open a UTMA account rather than a UGMA is that the UTMA offers A. Better tax advantages. B. More investment flexibility. C. More investment control to the parent. D. Greater flexibility in the appointment of a custodian. The answer is B. There are 2 testable UTMA advantages. 1. The money does not have to automatically transfer to the child. Once the age of majority is reached, it can be delayed, depending on the state, until as long as age 25. And 2. The range of investments permitted under a UTMA is much larger, giving the custodian greater flexibility in building the portfolio, which makes B the best choice. There is a problem with this question, although not one recognized by NASA. You can't select between a UTMA and a UGMA. Clients can only use what is available in their state of residence. As of the print date, there is only one state remaining that has UGMA on their books. All of the rest, plus Washington, D.C. use UTMA. Taxation. The minor's Social Security number appears on a UGMA-UTMA account, and the minor must file an annual income tax return and pay taxes on any earned income produced by the UGMA-UTMA account as would any other taxpayer. However, in the case of unearned income, such as from dividends and interest, until the minor reaches age 19 or the individual is a full-time student under 24, that unearned income in excess of $2,300 is taxed at the parent's marginal tax rate. This is commonly referred to as the kiddie tax. Although the minor is the account's beneficiary and is responsible for any and all taxes on the account, in most states it is the custodian's responsibility to see that the taxes are paid from the account. FAFSA and custodial accounts. In our discussion of educational funding programs, it was mentioned that money in Coverdell ESAs and Section 529 plans is only counted at a 5.64% rate when determining the family's financial contribution toward college. Assets held in a custodial account, UTMA or UVMA, are counted at a 20% rate, a true disadvantage when compared to the other plans. Learning Objective 18. J. Recall when health savings accounts, HSAs, may be used. Health savings accounts, HSAs. A health savings account, HSA, is a tax-exempt trust or custodial account that individuals can set up with a qualified HSA trustee to pay or reimburse certain medical expenses they incur. Benefits of an AHAS. You can claim a tax deduction for contributions you or someone other than your employer make to your HSA even if you do not itemize your deductions on Form 1040. Contributions to your HSA made by your employer, including contributions made through a cafeteria plan, may be excluded from your gross income. The contributions remain in your account until you use them. The interest or other earnings on the assets in the account are tax-free. Distributions may be tax-free if you pay qualified medical expenses. An HSA is portable. It stays with you if you change employers or leave the workforce. Eligibility for an HAS. To be an eligible individual and qualify for an HSA, you must meet the following requirements. You must be covered under a high-deductible health plan, HDHP, on the first day of the month. That means you are considered to be an eligible individual for the entire year if you are an eligible individual on the first day of the last month of your tax year, December 1 for most taxpayers. You have no other health coverage except what is permitted under the rules. You cannot be claimed as a dependent on someone else's tax return. Each spouse who is an eligible individual who wants an HSA must open a separate HSA. You cannot have a joint HSA. An HDHP has a higher annual deductible than typical health plans, and a maximum limit on the sum of the annual deductible and out-of-pocket medical expenses that you must pay for covered expenses. Out-of-pocket expenses include copayments and other amounts but do not include premiums. Contributions to an HSA. Any eligible individual can contribute to an HSA. For an employee's HSA, the employee's employer, or both may contribute to the employee's HSA in the same year. For an HSA established by a self-employed or unemployed individual, the individual can contribute. Family members or any other person may also make contributions on behalf of an eligible individual. Contributions to an HSA must be made in cash, but the law permits investments to be made into stocks, bonds, and mutual funds. Contributions of stock or property are not allowed. There is a limit on the amount that may be contributed, but because it is a number that changes each year, it will not be tested. The only facts that could be important are that the contribution for those with family coverage is higher, logically, than that for self-only coverage, and that the amount the individual may contribute is reduced by any amounts contributed by the employer. One number that does not seem to change annually is one that we learned earlier in this unit. Just as with IRAs, a catch-up contribution of an additional $1,000 is permitted, but in this case, the participant must be at least age 55. Take note. Do not confuse an HSA with an FSA, flexible spending account. The FSA holds money deducted from the employee's pay and remains with the company. It is not investable, and if you don't use it, you lose it. Qualified expenses. Besides the cost of medical care, there are some insurance premiums that are considered qualified expenses. You can't treat insurance premiums as qualified medical expenses unless the premiums are for any of the following. Long-term care insurance. Health care continuation coverage, such as coverage under COBRA. Health care coverage while receiving unemployment compensation under federal or state law. Medicare and other health care coverage if you are 65 or older, other than premiums for a Medicare supplemental policy, such as Medigap. Knowledge Check 18.7. Question 1. One of your customers has a 14-year-old child with a high level of interest in investing. The child's special passion is real estate. What would you suggest that would probably be the best type of account to open for the child? A. Coverdell ESA. B. Joint account with right of survivorship, JTWROS. C. Uniform Gifts to Minors Act, UVMA. D. Uniform Transfer to Minors Act, UTMA. The correct answer is D. The UTMA account has far greater investment flexibility than the UGMA. Included would be various real estate investments that could not be made in a UGMA. The JTWROS account cannot be opened with a minor, and the Coverdell is for education savings. Question 2. It is not uncommon to find individuals working full-time well after normal retirement age. You have a 79-year-old client who still puts in a 40-hour work week. The employing company offers an HSA to those employees who qualify. If this is your customer, one thing to note that likely could affect eligibility is A. The individual is claimed as a dependent on their grandchild's tax return. B. The individual is covered under Medicare. C. The individual has selected a high-deductible health plan provided by the employer. D. The individual is over 72 years of age. The correct answer is B. One of the disqualifiers from HSA eligibility is having Medicare coverage. It would not be unusual for this individual to have taken out Medicare coverage when first eligible. Being claimed as a dependent on someone else's tax return is also a disqualifier. It is possible but unlikely that anyone working a 40-hour week could be claimed as a dependent by their grandchild. On the exam, do not choose the answer that stretches the imagination. Age has nothing to do with eligibility, and the HDHP is a requirement.
Unit 19. Types of Investment Risks. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 19A. Identify the different systematic risks. Learning Objective 19B. Identify the different unsystematic risks. Learning Objective 19C. Identify opportunity cost. Learning Objective 19D. Recall the sequence of priority of claims in the event of a corporate liquidation. Your exam will include approximately 6 questions from the topics covered in Unit 19. Introduction. The concepts discussed in this unit are types of risk that both businesses and investors bear. Though not a comprehensive list, they are among the most common. Although we routinely use the term risk, we often have difficulty defining it precisely. In finance, risk is defined as the uncertainty that an investment will earn its expected rate of return. There are two basic categories of risk: systematic and unsystematic. We will address both of them and their subcategories one at a time. Lesson 19.1. Investments are not without risk. Learning Objective 19. A. Identify the different systematic risks. Systematic risk is the risk in the return of an investment that is associated with the macroeconomic factors that affect all risky assets. Stated another way, systematic risk is the risk that changes in the overall economy will have an adverse effect on individual securities regardless of the company's circumstances. It is generally caused by factors that affect all businesses, such as war, global security threats, or inflation. Primary examples would include market risk, interest rate risk, and purchasing power risk, each of which will be dealt with separately. You might also see this referred to as non-diversifiable risk because, as we'll learn, systematic risk cannot be avoided through diversification. Market risk. The first example of systematic risk that generally comes to mind is market risk. When the market tanks, virtually all securities lose value. This is a classic example of a non-diversifiable risk because regardless of the number of different stocks in your portfolio, when you encounter a stock market such as we had in the first half of 2022, reported by the Wall Street Journal as the worst performance for the S&P 500 since 1970, chances are most of those assets will have declined in price. In the next unit, we will discuss correlation. One way to protect against market risk is to have some negatively correlated securities in your portfolio. Those tend to go up when the others go down. Take note. Market risk is measured by a securities beta, coming up in Lesson 20.4. Example: should a war break out between two major oil-producing countries, the stock market can decline dramatically. The stocks of individual companies would likely decline as well, regardless of whether the war directly affected their businesses. Take note. Market risk cannot be diversified away. In Unit 21, we will discuss several strategies that might be used to protect portfolios against this risk. Interest rate risk. Interest rates fluctuate in the market all the time. If market conditions or the Federal Reserve push interest rates higher, the market price of fixed income securities, bonds, and preferred stock will be affected. When interest rates rise, the market price of bonds falls. That is why this is a systematic risk. This risk is sometimes referred to as the market risk for bonds. Rising interest rates can be bearish for some common stock prices as well, particularly those of highly leveraged companies such as public utilities. Having a diversified portfolio of bonds won't help, because an increase in interest rates will cause all bonds to decline in price. In Unit 21, we'll discuss 3 strategies that may be used to reduce interest rate risk. Take note. Interest rate risk is intrinsic to all types of fixed income investments, such as debt securities and preferred stock, whether from an emerging market issuer or a AAA issuer. It is the risk that a security's value will fluctuate as a result of a change in market interest rates. This is known as the inverse relationship between interest rates and the market price of a fixed income security. That is, when interest rates move in one direction, the price of those securities moves in the opposite direction. Specifically, when interest rates increase, the market price of fixed income securities declines. And when interest rates decline, the market price of fixed income securities increases. Example: if the Federal Reserve increases interest rates dramatically, the market price of all bonds, regardless of credit quality, will decline. Reinvestment risk. A variation of interest rate risk is reinvestment risk. There is reinvestment risk as to interest and reinvestment risk as to principal. An investor receiving a periodic cash flow from an investment, such as interest on a debt security, may be unable to reinvest the income at the same rate as the security itself is paying. For example, if an investor purchased a bond with a 10% coupon, and several years later comparable securities were only paying 7%, the investor would not be able to compound the investment at the original rate. Zero-coupon bonds avoid this risk because there is nothing to reinvest. This risk also occurs at maturity. If the fixed income investor was enjoying a 10% return on the above bond when it matured, the investor would only be able to reinvest the principal in a 7% security. That is one of the advantages of purchasing bonds with a longer term. To maturity, you're assured the fixed return for that length. Inflation risk Purchasing power risk. This is another systematic risk. Inflation reduces the buying power of a dollar, or whatever currency is used where you live. A modest amount of inflation is inherent in a healthy, growing economy, but uncontrolled inflation causes uncertainty among individual investors, as well as corporate managers attempting to evaluate potential returns from projects. Treasury inflation protection securities, TIPS, are one investment vehicle designed to protect against inflation risk. Fixed income securities, such as bonds and preferred stock, are the most vulnerable to this risk. Common stock is historically the least susceptible. In Unit 5 of this course, we learn that tangible assets, such as real estate and precious metals like gold, are also good inflation hedges. Example. As we stated, purchasing power risk is a systematic risk, meaning that diversifying your portfolio is of little or no help. Let's assume that an individual nearing retirement took $1 million and, seeking income with safety, invested $100,000 into each of 10 different corporate bonds, all maturing in 20 years. For sure, this diversification does give protection against financial risk. If one of the bonds defaults due to bankruptcy of the issuer, the other 9 should still pay off. However, if the cost of living rises 20 years from now, when each of those bonds pays back the $100,000 principal, the investor will have $1 million, but how much will that $1 million purchase compared to what it would have 20 years earlier? Exchange rate or currency risk. Purchasers of foreign securities, whether through direct ownership or ADRs, face the uncertainty that the value of either the foreign currency or the domestic currency will fluctuate. For example, let's say that the British pound is up about 5% against the US dollar in the past 12 months. As a result, someone who invested 1 year ago in the stock of a company domiciled in Great Britain will find that even if the stock has remained level or slightly lower on its local market, in terms of dollars, the value has increased. On the other hand, if your funds are in domestic cash or cash equivalents, you have little, if any, exposure to currency or exchange rate risk. Test topic alert. On an individual level, the exam may even ask you about exchange rates and vacationers. For example, you take a trip to country A and purchase a dinner on your credit card for 200 units of the local currency. Then, on the final night of your stay, you go to the same restaurant, order the same meal, and once again, the bill is for 200 units. When you get home, you check your credit card statement and see that you were billed $100 for the first meal and $110 for the second. What happened? The value of the foreign currency rose against the US dollar. From 50 cents, $100 divided by 200. To 55 cents, $110 divided by 200. Even though no prices changed in the foreign country, you encountered currency risk. Learning Objective 19. B. Identify the different unsystematic risks. Unlike systematic risk, which is non-diversifiable, unsystematic risks can be reduced through diversification. They are risks that are unique to the specific industry or business enterprise, and would include things such as labor union strikes, lawsuits, and product failure. These are sometimes called non-systematic risks. We will cover the most testable examples below. Take note. Several of these risks were covered in Learning Objective 5G. You might want to review them. Business risk. This is an operating risk, generally caused by poor management decisions, for example, Edsel Nicoke, or more recently, RIM failing to pay attention to the success of the iPhone. Remember when everybody had to have a BlackBerry? At best, earnings are lowered. At worst, the company goes out of business and common stockholders probably lose their entire investment. Financial risk. Often confused with business risk, it is similar. Financial risk relates primarily to those companies that use debt financing, leverage. An inability to meet those debt obligations could lead to bankruptcy and, once again, total loss for the stockholders. For that reason, this is sometimes called credit risk or default risk. Test topic alert. Unsystematic risk can be minimized through portfolio diversification. For example, a client long 1,000 shares of XYZ, selling those shares and investing the proceeds into an S&P index fund eliminates or greatly reduces business risk, but not market risk. In similar fashion, owning a diversified portfolio of bonds, such as is offered in a bond fund, offers protection against financial risk. Test topic alert. Business risk is highest for investors whose portfolios contain stock in only one issuer or in lower-rated bonds. Regulatory risk. A sudden change in the regulatory climate can have a dramatic effect on the performance or risk of a business and entire business sectors. Overreaching bureaucrats and court judgments that change the rules a business must comply with can devastate individual companies and industries almost overnight. A very common example of this is rulings by the EPA, Environmental Protection Agency, which can sometimes play havoc with the oil and gas industry. Legislative risk. It is common to lump together regulatory and legislative risk, but there is a difference. Whereas regulatory risk comes from a change in regulations, legislative risk results from a change in the law, and because there is frequently a political agenda behind legislation, this risk is sometimes referred to as political risk, although most consider political risk to be of its own making. A governmental agency, state or federal, may pass certain regulations, but only a legislature can pass a law. Changes to the tax code are the most obvious legislative risks. Political risk. It might seem like we are splitting hairs here, but each of these, although potentially interrelated, does have a different basis in the source of the risk. In the case of political risk, most attribute this to potential instability in the political underpinnings of the country. Think of a coup. This is particularly true in emerging economies, but, as history has shown, political insurrections can occur even in highly developed societies. Please note that many, but not the folks who author the exam questions, consider this to be a systematic risk. Sovereign risk. Sovereign risk ratings capture the risk of a country defaulting on its commercial debt obligations. Headlines were made several years ago when the credit rating of the United States was reduced from AAA. At the time of this printing, the United States was back up to AAA. That is an example of the perceived increased sovereign risk that existed at the time. More recent examples with Greece point out that even countries can have difficulty paying their obligations. Country risk. Country risk monitors the political and economic stability of countries. Country risk is the total risk of investing in the obligations of that country and includes political, financial, and sovereign risk. Example. Investments that could be affected by regulatory changes include so-called green industries, and those that tend to pollute, oil and gas exploration, airlines, and pharmaceutical manufacturers. The most common regulatory risk comes from governmental agency attempts to control or influence product prices, or the competitive structure of a particular industry, through the passage and enforcement of regulations. Example. An example of legislative risk is how the domestic boat-building business in the United States was nearly wiped out in the early 1990s after the government instituted a luxury tax for yacht purchases. Example. An example of political risk was the actions of the Chavez government in Venezuela several years ago, where nationalization took place in many industries from cement to supermarkets. Those investors in what were previously privately owned, not government, businesses saw much, if not all, of their investment lost. Liquidity risk. Liquidity measures the speed or ease of converting an investment into cash without causing a price disruption. Liquidity risk is the risk that when an investor wishes to dispose of an investment, no one will be willing to buy it, or that a very large purchase or sale would not be possible at the current price. Although there is technically a difference, for exam purposes, you may also refer to this as marketability risk. Example. The Treasury bill market is a highly liquid market because investors can sell a Treasury bill within seconds at the quoted prices. Real estate investments, however, can take months or years to sell if you want to get close to your asking price. The longer it takes to convert an investment into cash without having a fire sale, the greater the liquidity risk. Take note. Listed stocks and mutual funds have virtually no liquidity risk. Thinly traded stocks, many municipal bonds, and most tangible assets have a greater degree of inability to liquidate rapidly at your price. Learning Objective 19. C. Identify opportunity cost. Opportunity cost. Opportunity cost is the foregone return, or the return given up, on an alternative investment. In economic terms, opportunity cost is defined as the highest valued alternative that must be sacrificed as a result of choosing among alternatives. More simply, one can invest in short-term Treasury bills, incurring virtually no risk. That is the risk-free alternative that can be earned by basically doing nothing. Any return that deviates from the risk-free return represents your opportunity gained or lost. Example. Assume the 91-day Treasury bill is currently yielding 6%. An investor decides to purchase a stock with an expected return of 11%. If that stock actually returns 2%, the opportunity cost is 4%, 6%, 2%, because that is the rate that the investor gave up risk-free to assume the risk of investing in the alternative choice. Test topic alert. You should know that the primary systematic risks are the following, represented by the mnemonic PRION: purchasing power, inflation, reinvestment, interest rate, market, exchange rate, currency. Also, there are 6 primary unsystematic risks: business, financial, credit default, legislative, liquidity, marketability, political, and regulatory. Practice question. All of the following risks are considered diversifiable except A. Default risk, B. Liquidity risk, C. Purchasing power risk, D. Sovereign risk. The answer to C. Purchasing power risk, also known as inflation risk, is a systematic risk and as such is one that cannot generally be lessened through diversification. Knowledge check 19.1. Question 1. Of the many different types of risk faced by investors in securities, the systematic risk that first comes to mind for most is A. Inflation risk, B. Interest rate risk, C. Market risk, D. Purchasing power risk. The correct answer is C. Although all of these are examples of systematic risk, it is market risk that stands out in the minds of most investors. Question 2. If a sovereign government enacted legislation that prohibited the sale of a certain product, companies who manufacture that product would likely see the price of their stock drop. This is an example of A. Business risk, B. Credit risk, C. Legislative risk, D. Sovereign risk. The correct answer is C. There are actually times on the exam where the question tells you the answer. That is the case here. Legislation that has an adverse effect on an investment is, obviously, legislative risk. Oftentimes, students don't believe a question like that could possibly be on the exam, and they select something else and miss the question. What's wrong with sovereign risk? That is the risk that the government will falter on its obligations and has nothing to do with the discussion here. Question 3. When an investor is faced with several choices, each with different levels of risk, the decision as to which to purchase opens the investor to A. Behavioral modification, B. Call risk, C. Decision risk, D. Opportunity cost. The correct answer is D. Opportunity cost. In reality, opportunity risk arises when an investor forgoes one investment in favor of the other. If the investment with the higher risk is selected, but does not outperform the one with lower risk, the investor has lost the opportunity to receive a greater return with less risk. In many cases, opportunity cost compares the risky investment to the risk-free investment. The 91-day or 13-week U.S. Treasury bill. Having just finished a previous question where a key word in the question was the answer, you might have thought that decision risk was a gimme. However, that is simply a made-up term. Lesson 19.2. Liquidation priority. Learning objective 19. D. Recall the sequence of priority of claims in the event of a corporate liquidation. Liquidation priority. As discussed previously in Unit 7, a corporation's capital structure is the way it raises its capital. Think of it like the building blocks of the company. All corporations build the base, as it were, with common stock. They may or may not issue preferred stock. If they wish to employ leverage, they will borrow money by issuing debt securities. Those securities may be issued with collateral, such as a mortgage bond or merely on the general credit of the issuer, a debenture. In terms of looking at risks, it is critical to understand where the investor's position is in the event of a bankruptcy. When examining the capital structure of a corporation, it is important to know the liquidation priority. Secured creditors, for example, mortgage bonds, equipment trust certificates, collateral trust bonds. These may be called senior debt or even senior notes on the exam. Unsecured creditors, for example, general creditors, including debenture holders, subordinated debt holders, preferred stockholders, common stockholders. Regardless of how low on the totem pole a debt security is, such as a subordinated debenture, it still has priority in terms of payment of interest and principal ahead of any equity security. Look for a question asking, in essence, in the event of a corporate liquidation, who comes first? A senior prior line preferred stock or a junior unsecured subordinated debenture. Now, you may not see all of those adjectives, but no matter what, a debt security always has priority over an equity security. Test topic alert. If an exam question includes taxes and wages, those would have the highest priority of the unsecured creditors, but would be behind those who are secured. Knowledge check 19.2. Question 1. Which of the following securities is considered the most senior? A. Common stock. B. Senior line prior preferred stock. C. Subordinated debenture. D. Treasury stock. The correct answer is C. Regardless of how many adjectives are in front of the preferred stock, equities are always junior to debt. This is true even when the debt is a subordinated debenture. This debt is subordinate, comes behind all other debt of the issuer, but as a debt, it comes ahead of any equity security. Treasury stock is not issued by the U.S. Treasury. You cannot buy stock in America, regardless of what the ads for savings bonds say. Question 2. Due to unfavorable business conditions, a corporation whose common and preferred stock are traded on the New York Stock Exchange is forced to seek protection from its creditors. Who of the following is most likely to receive back the largest portion of their investment in the company's securities? A. Holders of bonds collateralized by a mortgage on the company's real property. B. Holders of the largest block of stock in the company. C. Senior management of the company. D. The bankruptcy lawyers. The correct answer is A. Seeking protection from creditors is a nice way to say filing for bankruptcy. Sure, the lawyers will get their money, but they aren't investors in the company, so they don't count in this question. Holders of secured debt, such as a mortgage bond, are in the senior position and generally will receive a return of a substantial portion, if not all, of their investment.
Unit 20, Analytical Methods. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 20A, describe the different time value concepts, including use of the Rule of 72 to determine the return on an investment. Learning Objective 20B, evaluate the effect of a bond's duration on its market price. Learning Objective 20C, describe how discounted cash flow is used to estimate the value of an investment. Learning Objective 20D, select the proper measure of central tendency when presented with a set of variables. Learning Objective 20E, identify alpha and beta. Learning Objective 20F, recall how standard deviation relates to volatility. Learning Objective 20 recognize the relationship between correlation and diversification. Learning Objective 20H, calculate liquidity and valuation ratios of common stock. Your exam will include approximately 7 questions from the topics covered in Unit 20. Introduction. Analytical methods primarily involve mathematical concepts in an attempt to assist in making better investment decisions. Because the testing center only permits the use of a simple 4-function calculator, any computations you will be asked to perform will be relatively straightforward. In general, it will be more important to understand the concept than do the computation. Lesson 20.1, Time Value of Money. Learning Objective 20. Describe the different time value concepts, including use of the Rule of 72 to determine the return on an investment. There is no question that investing is a numbers business. In Unit 7, we discussed financial statements as a tool for evaluating a company, and those are almost entirely number-oriented. In this unit, we'll go further by looking at both the overall market and examine some of the tools that quantitative analysts, known as quants in the industry, use to assist them in making investment decisions. The first place to start is understanding that time is money. Time value of money. We've all heard the famous saying, time is money. The concept certainly applies to investments. For example, if a person promises to pay a certain sum 10 years from now, what is it worth to have the money today so that the investor will have use of it over the next 10 years instead of having to wait? If the investor could earn 10% on the money, compounded annually, having about $38.55 today would be equivalent in value to receiving $100 in 10 years. That is known as the present value of a future sum. The second view of time value relates to computing the amount necessary to be invested today, using an assumed rate of return, so that it will have a defined amount in the future. Using the above case, if the investor were to invest $38.55 today and earn 10% compounded annually, he would have $100 in 10 years. We call that the future value computation. Take note. Although this can be proven in less than 10 seconds using a financial calculator, you may have to do a compound return computation on the exam, but won't have the benefit of such a fancy tool. Using the basic 4-function calculator issued at the testing center, you would take the initial $38.55 and multiply that by 110% and continue to do that for a total of 10 times. We'll just get you started to show you what it looks like. $38.55 times 110% equals 42.405 times 110% equals 46.6455 times 110% equals $51.31, and so forth. 7 more times will get to you approximately 100. This is the same concept we will show you with the TIPS bond in Unit 22. Future value. Future value is the formal term that indicates what an amount invested today at a given rate will be worth at some period in the future. The future value of a dollar invested today depends on the rate of return it earns, R, and number of years over which it is invested, N. The equation to calculate the FV of an investment is expressed as FV equals PV times 1 plus R to the nth power. Example. In these two examples, we will demonstrate how these values are calculated. However, you will not be required to know the formula or how to do these computations. Assuming we invest $11,348.54 today and expect to earn 12% compounded annually for 5 years, what will it be worth then? Its future value is calculated using the above formula as follows. FV equals $11,348.54. The PV times 1.125 equals $20,000. The future value expressed here reflects a compound rate of return on the original $11,348.54 invested. The compound return assumes that the interest earned, 12% in this case, in a given period, 5 years, is reinvested at the identical rate for the number of years in which it is invested. Take note. To find PV, you must already know the FV. To find FV, you must already know the PV. Present value. Present value is the formal term for value today of the future cash flows of an investment, discounted at a specified interest rate to determine the present worth of those future cash flows. Intuitively, investors recognize that a dollar in hand is worth more than a dollar in the future. The difference between the value today and sometime in the future is a function of the time elapsed and the rate of interest earned. The formula used to calculate present value is as follows. PV equals FV divided by 1 plus R to the nth power. In the formula above, PV stands for the present value, FV stands for the future value, R is the interest rate, and N is the number of time periods the money is compounded. This formula says that the present value, PV, of an investment equals the investment's future value, FV, discounted at divided by an interest rate over a time period specified by N. The factor, 1 plus REN, is known as the discount factor. Example. What is the present value of $20,000 that will be received 5 years, and from today? If the investor requires a 12% return, R, for the $20,000, the value of that $20,000 today, PV, to be received in 5 years is calculated as follows. PV equals FV divided by 1 plus 0.12 to the 5th power equals $20,000 divided by 1.7623416 equals $11,348.54. The $20,000 to be received in 5 years discounted by the required 12% interest rate is worth $11,348.54 today. As stated with future value, you will not have to know this formula or perform this calculation. You will be expected to understand the concept of the time value of money. Test topic alert. When computing present value or future value, we are using an estimated rate of return. What happens if the actual return is different from the estimated? If our actual return is less, we don't make out as well. That means that the present value, the required initial deposit, is going to be higher than we computed. On the other hand, if the actual return was higher than the present value, we did better than we thought. The present value, the amount we would have had to deposit, is less. The same logic holds true for future value. If the actual return is higher than projected, the future value will be higher. We made more on our money than we thought we would. Logically, if the actual return is lower, our future value winds up lower. Practice question. Present value is a computation that is frequently used to determine the amount of a deposit needed now to meet a future need, such as college education. If an investor uses an expected return of 8%, but the actual return over the period is 10%, the future value will be A. Lower than anticipated. B. higher than anticipated. C, the same as anticipated. D, too varying to tell. The answer is B. Present value is the amount deposited to meet a future goal based on an expected rate of return. If the return is higher than expected, the ending result will be greater, a good thing. Rule of 72. The Rule of 72 is a shortcut method for determining the number of years it takes for an investment to double in value, assuming compounded earnings. To find the number of years for an investment to double, simply divide the number 72 by the interest rate the investment pays. For example, an investment of $2,000 earning 6% will double in 12 years. 72 divided by 6 equals 12. Here is another example of the Rule of 72. A savings account with $1,000 in it bearing 4% compounded per year in interest would double. The account would be worth $2,000 in 18 years. 72 divided by 4 equals 18. Example. Suppose an investment of $1,000 was worth $4,000 in 16 years. Under the Rule of 72, what is the compounded earnings rate? You figure this by realizing that the account has quadrupled, that means it has doubled twice. So if it took 16 years to double twice, it takes 8 years to double one time. Dividing 72 by 8 tells us that our account must be earning 9%. The Rule of 72 also works in reverse. That is, if you know the number of years you have, you can compute the required earnings rate to double by once again using 72 as the numerator and this time the number of years as the denominator. For example, if you have 9 years before your child is going to enter college, what will you have to earn in order for a deposit made today to double? Simply divide 72 by 9, and the result is that an 8% earnings rate will have your money double. Example. An advisory client's oldest child is 8 years old. With an expected college entry at age 18, a need of $200,000, and a projected earning rate of 7.2%. What is the present value needed to accomplish the client's goal? Using the Rule of 72, we divide 72 by the 10 years before the money is needed. Child's age is 8 and college starts at 18. And see that money will double if the earnings rate is 7.2%. That matches the projected rate, so any deposit today, the present value, will double by the time the funds are needed. A deposit of $100,000 today will be worth $200,000 in 10 years. Is this a guarantee? Of course not, but using the Rule of 72 is a quick and easy way to approximate the funds needed for a future event. Net present value, NPV. Net present value, NPV, is the difference between an investment's present value and its contemporaneous cost, current market value, or CMV. A positive NPV of $10 means that an investment selling for $100 must have a discounted present value, PV, of $110 for an NPV of $10. Note that the difference between the CMV, $100, and the PV of the investment's future returns, $110, equals the NPV, $10. If the PV is $90, there is a negative NPV of $10 because the price is above the present value. Take note. NPV is expressed in dollar amounts and not as a rate of return. An investment advisor could use the NPV concept to evaluate a client's investment in any investment vehicle with a projected income stream. The advisor would project the cash flows from the investment and then discount them to their present value at the investor's required rate of return. If the NPV is positive, the investment is a worthwhile addition to the investor's portfolio. Example. This concept is very important on the exam, at least 2 or 3 questions worth. So let's try to make it as simple as possible. Don't worry about how we got the following numbers that won't be tested. What will be tested is understanding what they mean. Several years ago, the XYZ Corporation issued a bond with a nominal yield, interest rate, of 5% per year. The bond matures in exactly 20 years. As of the date of this example, comparable bonds are being issued with nominal rates of 4%. In this type of computation, the required rate of return equals the current market rate, which is 4%. Using a financial calculator, which, as stated before, you won't have at the test center, the present value, PV, of this bond, using these assumptions, is $1,136.78. I hope you are not surprised that this bond's expected value is above the $1,000. After all, we learned in Unit 2 that when interest rates decline, the price of outstanding bonds increases. Now, here is where we get to the critical test question. If this bond is currently available from your broker-dealer for $1,100, what is its NPV? The answer is $36.78 because NPV is computed by subtracting the market price from the PV, $1,136.78 less $1,100. In this case, we have a positive NPV, and that means we're able to buy the bond for less than what it is theoretically worth. If, on the other hand, the bond was available for $1,150, it would have an NPV of negative $13.22 or a negative NPV, and so would not be one you would likely purchase. Internal rate of return, IRR. The internal rate of return, IRR, is the discount rate, R, that makes the future value of an investment equal to its present value. The IRR can be thought of as the R in the present and future value calculations. The IRR is difficult to calculate directly. It must be determined by a trial and error process called iteration. IRR takes into consideration the time value of money. IRR is not practical for common stock due to uneven cash flow and no maturity date or price. Take note. The IRR calculation can be used to determine whether an investment meets the investor's required rate of return. If an investor requires an investment return of 10% and the IRR for a proposed investment is 12%, the investor will view that investment as attractive because it returns a higher rate than the investor's required rate. Test topic alert. NPV and IRR are far and away the most difficult mathematical concepts you'll encounter on this exam. These are most important points to remember. Internal rate of return, IRR, is the method of computing long-term returns that takes into consideration time value of money. The yield to maturity of a bond reflects its IRR. The investment is a good one if it has a positive NPV. Stay away if the NPV is negative. NPV is generally considered more important than IRR. When an investment's IRR is equal to the discount rate, sometimes called the required rate of return, the NPV equals 0. In an efficient market, Unit 21, bonds should be priced so that their NPV is 0. The quickest way to identify IRR versus NPV is that IRR is always expressed as a percentage, while NPV never is. It is usually shown as a dollar amount. So one is a rate, percent, while the other is a value, dollars. Example. Let's go back to that NPV example to show you how IRR fits in. We established that the required rate of return was one that equaled the market rate of 4%. If the XYZ bond in our question was available from the broker-dealer at a price of $1,136.78, then its PV and the market would be the same, giving us an NPV of 0. At that price, the bond's yield to maturity and the internal rate of return are equal to the market rate of 4%. We are going to elaborate further on this in the next lesson, when we show how this is a discounted cash flow, DCF, computation, and you might want to come back here after that. Knowledge Check 20.1. Question 1. One of your clients recently came into an inheritance. Initially, some of the money was used to pay off credit card debt. Now, with the sum of the remainder, this client wants your help in determining how much should be invested today so that funds for college education will be available in 14 years. The most appropriate calculation to assist this client is A. Future value, B. Internal rate of return, C. Net present value, D. Present value. The correct answer is D. The giveaway clue in the question is the word now. Now is in the present, and when we know what we'd like to have in the future, 14 years from now, the present value calculation shows us the required lump sum deposit. NPV is used to determine if a security is priced correctly, and IRR is commonly used to report past performance. Question 2. A 46-year-old investor has $100,000 to invest today and would like it to be worth $400,000 when they retire at age 70. Using the rule of 72, what annual rate of return must the account generate for this goal to be achieved? A. 3%, B. 4%, C. 6%, D. 8%. The correct answer is C. The first step is determining how many years we have before retirement. Subtracting the current 46 from the target age of 70 equals 24 years. The rule of 72 tells us the percentage return needed for a deposit made today to double. The goal of $400,000 is 4 times the initial sum of $100,000. That means the deposit must double twice. Therefore, the first doubling must take place in 12 years. Dividing 72 by 12 years results in a required return of 6%. If we have $200,000 in 12 years and continue to earn 6%, that will double in the next 12 years, giving us $400,000 in 24 years. Lesson 20.2. Duration and Discounted Cash Flow. Learning Objective 20. B. Evaluate the effect of a bond's duration on its market price. In the financial industry, the term duration is used to measure the sensitivity of a debt security when faced with changes in interest rates. The longer the duration, the greater the market price movement, and vice versa. It is a complicated computation, but to try to simplify things, it is basically a measurement of the time it takes for the cash flow, interest payments, to repay the invested principal. That being the case, in general, the higher the coupon rate, the shorter the duration, while the lower the coupon, the longer the duration. Just remember that there are two components to the computation: the interest rate and the maturity date. If the maturity dates are about the same, the difference between a 20-year maturity and a 22-year one is almost insignificant. Then the bond paying the highest coupon rate will always have the shortest duration, and that with the lowest coupon, the longest duration. However, if the coupon rates are approximately the same, then the bond that will mature first will have the shortest duration, and the one that will mature last will have the longest duration. The way to compute the duration, calculation not tested, is to take the present value of a bond's future cash flows, interest and repayment of principal, weighted by length of time to receipt and divided by the bond's current market value. We're talking about that same present value covered in the previous lesson. There we learned that when a bond's coupon rate was higher than the current market rate, the bond's present value was greater than the face amount, and it should sell at a premium. Here, the effect of that higher present value results in a shorter duration and less market volatility. Take note. One way to keep things straight is to think about the coupon bond. With no periodic interest payments, that's why it's called zero coupon. The duration of a zero coupon bond will always equal its length to maturity. In other words, if we're trying to compute how long it will take for the income payments to return your principal without any interest payments, you can't expect to get your money back until the maturity date. If that is the case with a zero coupon bond, then as we find bonds paying interest, the more they're paying every 6 months, the quicker the payback. Test topic alert. The general characteristics of duration follow. The lower the coupon rate, the longer a bond's duration. The higher the coupon rate, the shorter the duration. The longer a bond's maturity, the longer the bond's duration. For coupon bonds, duration is always less than the bond's maturity. Duration for a zero coupon bond is always equal to its maturity. On a percentage basis, the longer a bond's duration, the more its value will change for a 1% change in interest rates. The shorter the duration, the less it will change. Test topic alert. If you were managing a portfolio of bonds and expected interest rates to decline, bond prices would rise. You would lengthen the average duration of the portfolio. On the other hand, if you were of the opinion that interest rates were going to rise, bond prices would decline. You would want to shorten the average duration. You might be asked for the average duration of a group of bonds or a bond portfolio. The correct computation is too complicated for the 4-function calculator you are given, but you'll get the correct answer if you just find the average of the durations given. For example, the average duration of a portfolio whose individual bonds have durations of 3, 5, 7, and 17 years is 8 years. 3 plus 5 plus 7 plus 17 equals 32 divided by 4 equals 8. Take note. The duration of a bond with coupon payments is always shorter than the maturity of the bond. By the same token, the duration of a zero coupon bond is equal to its maturity. Take note. A 5-year zero coupon bond has a duration of 5 because it takes 5 years to make the money back. The buyer gets a single payment, par, and maturity 5 years after purchase. Practice question. Being concerned about price volatility, a bond investor wishes to compute the duration of a bond being considered for her portfolio. Which of the following is not a necessary component of that calculation? A. Coupon rate. B. Current market price. C. Rating of the bond. D. Time until maturity. The answer is C. Although it is true that lower-rated bonds tend to have greater price volatility than high-rated ones, the rating has nothing to do with the calculation of the bond's duration. So our exception here is choice C. Duration is simply the weighted average of the cash flows an investor will receive over time discounted to the bond's present value. Those cash flows come from the coupon and the return of the par value at maturity. If you took geometry in school, you learned that curves could be convex, bulging to the outside, or concave, curving to the inside. It's been over 65 years, but I still remember the key to the difference by the statement, "You can hide in a cave." Now, what does that have to do with our discussion? Convexity is the measurement of the curve that results when plotting a bond's price movements in response to changes in interest rates. It is a more accurate representation than duration of what will happen to a bond's price as interest rates change, especially when the changes are great. Should you have a question about convexity on your exam, here's what you have to know. Duration is a linear, straight-line measurement, while convexity follows a curve. Comparing two bonds, the one with a higher convexity will show a greater price increase when yields fall and a smaller decrease when yields rise. That is a good thing. If we find two bonds with the same duration, the one with the higher convexity offers greater interest rate risk protection. Test topic alert. If you should be asked, which of the following is the most useful in determining the price volatility of a bond to a significant change in interest rates? The correct choice is convexity. Learning Objective 20. C. Describe how discounted cash flow is used to estimate the value of an investment. One way of assessing the value of a fixed income security is by looking at the future expected free cash flow, the interest payments plus the eventual return of the principal, and discounting it to arrive at a present value. In its simplest iteration, this is nothing more than taking all the money you are scheduled to receive over a given future period and adjusting that for the time value of money. The concept is used as well in some equity projections, such as the dividend discount and dividend growth models described previously. Therefore, in order to compute the future value of the cash flow from a bond, you would have to know the principal amount, coupon rate, and number of interest payments. Take note. The higher the discounted cash flow, DCF, the more valuable the investment. Example. There will be no computations regarding discounted cash flow, but there is a common example that may help you understand the concept better. We all wish we could be a winner of those huge Powerball or Mega Millions jackpots. Winners have the choice of receiving a series of payments over a number of years, about 29 currently, or taking the money in cash. If they take the cash, they'll receive around 72% of the announced total prize. Why is there a difference? The cash represents the present value of those future payments, and that is why you get less by taking it now instead of over time. In fact, years ago, when interest rates were higher than they are at the time of this printing, the lump sum payment was only about 60% of the prize. That is because the higher the market interest rates, the higher the discount rate. This is the same concept used in valuing a bond using DCF. When you buy a bond, you are expecting semi-annual interest payments, cash flow, until the maturity date. When you compare those interest rates to the current market rates, the discount rate in the equation, you get an idea of the fair value of the bond. To better help you understand, take a look at this question. Practice question. A client interested in fixed income is viewing different bonds with the same rating and a coupon of 6%. Using the discounted cash flow method, which bond should have the highest market value? A. 5-year maturity when the discount rate is 4%. B. 5-year maturity when the discount rate is 8%. C. 10-year maturity when the discount rate is 4%. D. 10-year maturity when the discount rate is 8%. The answer is C. Remember, the discount rate is just another way of stating the current interest rate in the marketplace. If the discount rate is higher than the coupon rate, the present value, the expected market price, will be below par. Conversely, if the discount rate is lower than the coupon rate, the present value will be above the par value. Now, there is nothing new for you here when the current interest rate in the marketplace, that is what the discount rate represents, is less than the coupon, the bond price is higher. As interest rates go down, bond prices go up. And if the current market interest rate is higher than the coupon rate, the bond's price will be lower. When interest rates increase, bond prices fall. That would narrow the choices to the two 4% bonds. That is, a bond with a 6% coupon should sell at a premium when current interest rates are at 4%. When interest rates are at 8%, the 6% bond should be selling at a discount. Then, as we just learned with duration, when interest rates change, the longer the time to maturity, the greater the effect on the market price of a bond. Practice question. An analyst would use the discounted cash flow method in an attempt to find the A. Fair value of a security. B. The current market price of a security. C. The current rate of return of a security. D. The cash flow from operations. The answer is A. DCF uses the present value of future cash flows based on a specified discount, interest, rate to evaluate the price that a security should be selling for in the market. If the current market price of the security is less than this value, it has a positive net present value, NPV, and should be a good investment. The opposite is true if there is a negative NPV. The market price is higher than that computed under the DCF method. Example. Here is something that may help. The current rate of interest, the discount rate, on new AA-rated bonds with a 20-year maturity is 4%. If you have an older AA bond with 20 years until it matures and a coupon of 6%, how does all of this apply? If the yield to maturity, YTM, on your bond is 4.4%, it has a positive NPV. Its yield is above the market rate of 4%, so this bond is selling at a price below its present value. If the ITM on your bond is 3.6%, it has a negative NPV. Its yield is below the market rate of 4%, so this bond is selling at a price above its present value. If the ITM on your bond is 4%, it has a 0 NPV. Its yield is equal to the market rate of 4%, so this bond is selling at its present value. One more point should be made on this topic. You might see the following statement as the definition of a bond's yield to maturity. The yield to maturity is the discount rate that equates the present value of the bond's future cash flows until maturity to its price. Unlike the other debt securities we discussed, trying to project your client's cash flow on a portfolio of mortgage-backed securities has its challenges. Although they do have default risk other than GNNAs, as do other debt securities, the specific risk due to the possible, some would say likely, prepayments complicates the computation. Test topic alert. When doing cash flow analysis on a mortgage-backed pass-through security, you would want to know the average maturities. You might want to go back and review the discussion of present value in Lesson 20.1. Knowledge Check 20.2. Question 1. Given that each of the following bonds is of the same quality and has the same maturity as the others, which has the longest duration? A. BC5s. B. DEF6. C. GHI7s. D. JKL0. The correct answer is D. Any bond paying interest will have a duration shorter than its maturity. On the other hand, because the zero coupon bond makes no payment until maturity, it has the longest duration. Regarding the other choices, when the maturities are the same or very close, the higher the coupon rate, the shorter the duration. That would have the 7s with the shortest duration, followed by the 6 and then the 5s. Question 2. With current market interest rates at 5%, when will a bond have a positive NPV? A. When its yield to maturity is more than 5%. B. When its yield to maturity is exactly 5%. C. When its yield to maturity is less than 5%. D. When the discount rate is higher than 5%. The correct answer is A. First of all, the discount rate is the current market interest rate, so it cannot be higher than itself. One would expect that with current market rates at 5%, properly priced bonds, those with a 0 NPV, would yield that same 5%. If the bond is yielding more than the discount rate, the investor is receiving added value, and that means the NPV is positive. Lesson 20.3. Measures of Central Tendency. Learning Objective 20. D. Select the proper measure of central tendency when presented with a set of variables. There are a number of other numerical tools used that do not involve time value. Following are those most likely to appear on your exam. Measures of central tendency. We are going to continue this section on quantitative measurements with a discussion dealing with the method of determining how one might approach figuring the logical outcome of a securities investment. Central tendency is usually defined as the center or middle of a distribution. There are many measures of central tendency. Let's take a look at some of them. Mean or arithmetic mean. When we use the word average, this is what we are really speaking about. Of all the different measures, this is the one most commonly used to measure central tendency. You've been computing this for years. All you do is take the sum of the variables and divide by the number of occurrences. For example, if a stock returned 5%, then 8%, then 9%, and then 2%, the mean would be 6%, 5 plus 8 plus 9 plus 2 equals 24 divided by 4 equals 6. Even though it is the most used, probably because it is so simple to do, the mean may not be an appropriate measure of central tendency for skewed distributions. The term mean by itself will always refer to the arithmetic mean. Geometric mean. This one takes some math skills and is, therefore, rarely used and probably won't be a correct choice on the exam and certainly not something you'll have to compute. The geometric mean of any given set of numbers, n, is obtained by multiplying all of them together and then taking the nth root of them. For example, over the past 5 years, a stock has annual returns of 10%, 5%, 15%, 8%, and 12%. Its geometric mean is 9.36%. This is computed by multiplying 10 times 5 times 15 times 8 times 12, which equals 72,000, and finding the fifth root. This is not to be confused with the more commonly used arithmetic mean, which in this case is 10 plus 5 plus 15 plus 8 plus 12 equals 50 divided by 5 equals 10%. Test topic alert. When comparing the arithmetic mean to the geometric mean, the arithmetic mean will always be higher, unless all of the numbers being used are the same. For example, figuring the mean of 6, 6, and 6, in which case they will be equal. The reason is because the geometric mean uses imputed compounding. Median. The median is a midpoint of a distribution, that is, there are as many variables below as there are above. To find the median of a number of returns, list them in order and then find the number in the middle. For example, the median of 11, 7, 4, 13, and 8 is 8 to 4, 7, 8, 11, and 13. If the number of variables is even, then take the average of the middle two. If we use the numbers given above for the mean, 2, 5, 8, and 9, the average of the middle two is 6.5 to 5 plus 8 equals 13 divided by 2 equals 6.5. Note that the median is not the same number as the mean. The median is often more appropriate than the mean in skewed distributions or in situations with variables that fall far outside the normal range, outliers. Definition. Skewed distributions. In a normal distribution, the mean and median are the same, nothing is skewed. This rarely happens. Most commonly, distributions of returns are skewed either to the left, the mean is higher than the median, or to the right, the mean is lower than the median. Mode. The mode is determined much differently than the prior two. Mode measures the most common value in a distribution of numbers. For example, the mode of 2, 2, 2, 6, 7, 7, and 9 is 2. The mode is likely to be quite unlike the mean or median. For example, using the numbers just shown, the mean is 5 to 35 divided by 7, and the median is 6. Range and mid-range. Range is the difference between the highest and lowest returns in the sample being viewed. When there are many values at either extreme of the range, the results tend to be skewed in that direction. The simplest way to do this is to reorder the data set from smallest to largest and then subtract the first element from the last element. Some look at the mid-range value, which, as the name implies, is the number that is exactly in the middle of the range. That is calculated by adding the highest number to the lowest number and dividing by 2. For example, if we look at the numbers we use to determine the median above, we reorder the numbers 4, 7, 8, 11, and 13. This makes the range 9 to 13 minus 4, and the mid-range is 8.5, close to but not the same as the median. How do we solve for the mid-range? Add the lowest number and the highest number in the series and divide by 2. 4 plus 13 equals 17 divided by 2 equals 8.5. Using our mode example, the range is 7 to 9 minus 2. And the mid-range is 5.5 to 2 plus 9 equals 11 divided by 2 equals 5.5. Example. Over the past 7 years, a security has produced annual returns of 10%, 4%, negative 5%, 10%, 12%, negative 2%, and 6%. In this example, the mean return, the average, is 5%. Adding these 7 returns totals 35%, and dividing by 7 results in an average of 5%. The median return, the one with as many returns above as below, is 6%. The mode, the return with the most occurrences, is 10%, and the range, the difference between the lowest and highest returns, is 17%, negative 5% to 12%. Practice question. An investor is looking at the past performance of a security over the past 3 years. In year 1, it returned 10%, in year 2, it returned 15%, and in year 3, it returned negative 4%. This computes to an average rate of return of 7%. This would be properly referred to as the A arithmetic mean. B internal rate of return. C median return. D range. The answer is A. When a true average return is shown, that is the arithmetic mean. The median return, the number in the middle of the group of 3, is 10%, and the range is 19%, negative 4 to 15. Test topic alert. You may have a question that shows 4 portfolios listing the mean, the median, and the mode for each one. The question will ask, which one had some investments that significantly outperformed the average of the other investments? The answer will be the one with the highest mean. To show how that works, let's say that you have 7 securities in the portfolio with the following returns. A. 5%, B. 5%, C. 8%, D. 10%, E. 12%, F. 40%, and G. 60%. The mode, the number that appears the most frequently, is 5%. The median, the number with the same number of returns above and below it, is 10%, and the mean, the average of the 7 returns, is 20%, 140 divided by 7. The 2 outliers, F at 40% and G at 60%, cause the mean, average, to be significantly higher than the mode or the median because those 2 perform significantly better than the other 5 holdings. Knowledge Check 20.3. Question 1. An investor reviewing annual returns of a mutual fund for the past 5 years notes that they have ranged from a high of 24% to a low of negative 2%. That would mean a mid-range of A. 11%, B. 12%, C. 13%. D. Without knowing the other 3 returns, the mid-range cannot be calculated. The correct answer is C. The mid-range of any set of numbers is the midpoint between the highest and lowest value. In our question, the spread between the high and the low is 26, negative 2 to positive 24. Half of 26 is 13, which is the mid-range. Question 2. When viewing past returns of a security, an outlier would cause the greatest distortion to A. the mean, B. the median, C. the mode, D. all of these equally. The correct answer is A. An outlier, a value that is extremely high or low when compared to the other values, would impact the average, the mean, more than any of the others. The mode wouldn't be affected, and the median would likely have little change. Lesson 20.4. Measurements of return and volatility. Learning Objective 20. E. Identify alpha and beta. Beta coefficient. Beta and beta coefficient mean the same thing. In the securities industry, coefficient is ordinarily dropped for purposes of convenience. Beta is used to measure the variability between a particular stock's or portfolio's movement and that of the market in general. A stock with a beta of 1 will tend to have a market risk similar to that of the market as a whole. Most frequently, beta is measured against the Standard & Poor's 500 Composite Index. A stock with a beta of 1.50 will be considerably more volatile than the market. A stock with a beta of 0.7 will be much less volatile than the market. Although most assets have a positive beta, it is possible to find some with a negative beta. Assets with a negative beta can be an important component when diversifying a portfolio. For example, if beta is negative 1.2, a 10% up move in the market's return will cause the stock return to decline by 12%. On the other hand, if the general market were to suffer a decline, a stock with a negative beta would generally show positive returns. Know that conservative clients need securities with low positive betas, whereas aggressive clients will find betas in excess of 1 to be quite suitable. In the previous unit, we mentioned that beta is a measurement of systematic risk, specifically market risk. Take note. If the S&P 500 rises or falls by 10%, a stock with a beta of 1 rises or falls by about 10%, a stock with a beta of 1.5 rises or falls by about 15%, and a stock with a beta of 0.75 rises or falls by about 7.5%. Practice question. Adding investments with a negative beta to a well-diversified portfolio that currently has a beta of +1 will A. Cause the expected performance of the portfolio to improve in declining markets. B. Cause the expected performance of the portfolio to decline in declining markets. C. cause the portfolio to experience more volatility in times of a rising market? D. Cause the portfolio to experience more volatility in times of a declining market? The answer is A. A negative beta means that the investment will move in an opposite direction from the overall market. Therefore, if the market is declining, then the asset should increase in value, thereby increasing the expected performance of the portfolio. Alpha. For portfolio managers, good news is when they can say that they have generated positive alpha. Basically, that means that their investment performance is better than what would have been anticipated, given the risk in terms of volatility that was taken. The expected return is usually determined using the capital asset pricing model, Kaplan, which will be covered in Unit 21. That generally means the manager has been adept at security selection and timing. You may be asked to compute how much alpha was generated for a particular stock or portfolio based on the amount of risk taken. Alpha can be positive, negative, or zero. If the alpha is negative, then the portfolio is underperforming the market. If higher, the portfolio is outperforming the market, and the manager is doing a good job. Although the general calculation refers to the market, a deeper view compares the performance to the specific benchmark that is most similar to the portfolio. For example, a large cap fund manager would use the S&P 500, not the Russell 2000 small cap index, return as the market return in the alpha calculation. The most common formula for computing alpha goes like this: actual portfolio return minus risk-free rate, minus portfolio beta times market return less the risk-free rate. In essence, what is being done is comparing performance after eliminating the risk-free rate. This is one item it's easier to understand if we show you the numbers. Definition: risk-free rate. The risk-free rate used on the exam will always be the 91-day or 13-week U.S. Treasury bill. Because their price movements are not generally related to the stock market, those T-bills are said to have a beta of 0. Example: portfolio return 10%, risk-free rate 2%, market return rate 8%, beta 1.2. The computation of alpha would be 10% minus 2% equals 8%. Then 1.2 times 8 minus 2, which is 1.2 times 6 equals 7.2. Plug that into the formula, which gives us 8 minus 7.2, or an alpha of 0.8, positive alpha. Practice question. Portfolio return 10%, risk-free rate 2%, market return rate 8%, beta 0.8. 10% minus 2% minus 0.8 times 6 equals 8 minus 4.8 equals positive alpha of 3.2. Let's review for a moment. Both portfolios earned the same 10%, but the second one did it with a much lower beta. We would not have expected that portfolio to do as well as the one with the higher beta. Remember, more risk, more reward. The fact that it did means the portfolio managers did a great job. Test topic alert. It is possible on the exam that you will have an alpha computation where the RF, risk-free return, is not given. In that case, the computation is the same, but without the RF being subtracted from both the actual return and the market return. For example, in our first case, the computation would be 10% minus 1.2 times 8%, or 10% minus 9.6%, for an alpha of 0.4. Learning Objective 20. Recall how standard deviation relates to volatility. Standard deviation. Standard deviation is a measure of the volatility of an investment's projected returns, computed by using historical performance data. Standard deviation is a statistical term that measures the amount of variability or dispersion around an average. The larger this dispersion or variability is, the higher the standard deviation. The higher the standard deviation, the larger the security's returns are expected to deviate from its average return, and, hence, the greater the risk. Example. This simple example should give you a basic understanding of the concept behind using standard deviation as a tool to predict price volatility. Let's compare the returns generated by the common stock of two unrelated companies over the past 3 years. 2012. Company A, 8%. Company B, negative 4%. 2013. Company A, 12%. Company B, 25%. 2014. Company A, 10%. Company B, 9%. For an investor who held shares in Company A for those 3 years, the mean return on investment was 10%. This is calculated, just like any other average, by adding together the 3 annual returns, 8 plus 12 plus 10 equals 30, and dividing that by 3. For an investor who held shares in Company B for those 3 years, the mean return on investment was exactly the same. 10%, 25 plus 9 minus 4 equals 30 divided by 3. However, which one of the shares had a greater dispersion or variance from the mean? Clearly, Company B's. You will not have to compute it, but you should be able to see from this that Company B would have a much higher standard deviation. Its returns have deviated far greater from the average than Company A. If you were asked on your exam to choose which of these two would be more suitable for the conservative investor, the one who likes to sleep well at night, you'd better pick Company A, the one with the lower standard deviation. Standard deviation is expressed in terms of percentage. It is generally accepted that a security will vary within 1 standard deviation about 68% of the time, within 2 standard deviations about 95% of the time, and within 3 standard deviations about 99% of the time. A standard deviation of 7.5 means that the return of a stock for a given period may vary by 7.5% above or below its predicted return about 2/3 of the time, within 15% about 95% of the time, and within 22.5% about 99% of the time. Example: a security has an expected return of 12% and a standard deviation of 5%. Investing in a security with an expected 12% return, an investor can expect returns to range within 7% to 17% about 68% of the time and within 2% to 22% about 95% of the time. Take note: an investor can use standard deviation to compare the volatility between investments. Simply put, the higher the standard deviation, the greater the volatility, and the reverse. Example: if an investor had a choice between an investment that historically returned 12% with a standard deviation of 6% and another investment that also returned 12% but had a standard deviation of 10%, the investor would probably choose the first one. In effect, he would expect to receive an equal return in the future return with less risk. Beta versus standard deviation. Beta is a volatility measure of a security compared with the overall market, measuring only systematic market risk. Standard deviation is a volatility measure of a security compared with its expected performance and includes both systematic and unsystematic risk. Another way to put that is that standard deviation measures the total risk of a security or portfolio. After studying the next unit, you might want to reread this because you will have a better understanding of these 2 types of risk. Knowledge Check 20.4. Question 1. Solve for alpha given the following information: portfolio return 9%, risk-free rate 2%, market return rate 8%, and beta 1.2. A, negative 0.6. B, negative 0.2. C, positive 0.2. D, positive 1.8. The correct answer is B. The solution is the actual portfolio return, 9%, minus the risk-free rate, 2%, which is 7%. Then we multiply the beta, 1.2, times the market return of 8% minus the 2% RF rate. Putting together all of the numbers we have, 9% minus 2%, less 1.2 times 6, equals 7 minus 7.2 equals alpha of negative 0.2. This portfolio underperformed. For the additional risk taken, it should have returned at least 9.2%. Question 2. Using modern portfolio theory, one of your customers calculates the expected return of a stock at 15%. When explaining this to you, the customer asks you how much variation should be expected from this investment the majority of the time. You respond that 95% of the time, the return should be within the range of a low of negative 7% and a high of 37%. This information was determined based on this stock having a standard deviation of A, 7%, B, 11%, C, 15%, D, 22%. The correct answer is B. A security will range within 2 standard deviations of its expected return 95% of the time. Given an expected return of 15%, a high end of the range of 37% means a deviation of 22% to the upside. A return at the low end of the range of negative 7% is a deviation of 22% to the downside. With a 95% expectation of 2 standard deviations being plus or minus 22%, the standard deviation of this stock is half of that, or 11%. Lesson 20.5. The effects of correlation on a portfolio's return. Learning Objective 20. G. Recognize the relationship between correlation and diversification. Correlation means that securities move in the same direction. A strong or perfect correlation means two securities prices move in a perfect positive linear relationship with each other. Example: two securities are correlated if one security's price rises by 5% and the other security's price then rises by 5%, or if one declines by 4% and the other also declines by 4%. The correlation coefficient is a number that ranges from -1 to +1. Securities that are perfectly correlated have a correlation coefficient of +1. Securities whose price movements are unrelated to each other have a correlation coefficient of 0. If prices move in perfectly opposite directions, they are negatively correlated or have a correlation coefficient of -1. Generally speaking, correlation coefficients of 0.8 and up are considered to be a very high correlation. As previously mentioned in Lesson 17.3, one of the risks in investing in index funds is tracking error. When the correlation is no longer close to 1, the fund's performance is unlikely to match the benchmark. It could be better or worse, it just is unlikely to match. Diversification. Throughout this course, we have praised the benefits of diversification. Whether the discussion was about pooled investment vehicles, such as mutual funds and REITs or alternative investments, spreading the risk among a number of different holdings, especially with different market characteristics, is a proven way of reducing unsystematic risk. There are several ways to diversify a portfolio. One of them, typically used in mutual funds, is to own a number of different securities. For example, a growth fund would be highly concentrated in common stock in companies and industries that have the potential for greater than average future growth. In this case, most of the securities in the portfolio will be highly correlated. They'll tend to move in the same direction. Another way is to diversify by owning different types of assets. We have mentioned the topic of asset allocation previously and will delve further into it in the next unit. By investing in assets with a low or negative correlation, the investor benefits further from diversification because when there is a down market for equities, those assets with a negative correlation will have a tendency to provide positive returns. Take note. Index funds attempt to achieve perfect correlation, +1, with the index they are mirroring, for example, the Standard & Poor's 500. The goal of an index fund manager is to come as close as possible to matching the performance of the underlying index. It is not a goal to exceed the performance, but only to match it. An index fund may not perfectly track its index. For example, a fund may only invest in a sampling of the securities in the market index, in which case the fund's performance may be less likely to match the index. This is known as tracking error. Test topic alert. One of the best ways to increase the diversification of a portfolio is to include investments with a negative correlation. The logic is that those negatively correlated assets will go up when the rest of the portfolio is going down. One of the best examples of a negatively correlated asset is an investment in gold stocks. Bonds frequently have a negative correlation as well, which is one of the reasons for creating a balanced allocation. Practice question. Take a look at this example. One of your clients has a portfolio that has a correlation of 91 with the overall market. A stock with which correlation coefficient would most likely offer the greatest diversification to this client. A 0.91, B 0.51, C 0.01, D -0.51. The answer is D. Remember, the best way to diversify is to include securities with a negative correlation, and the only one here that meets that requirement is choice D. Knowledge Check 20.5. Question 1. Which of the following statements is most accurate? A. The higher the correlation, the more diversified the portfolio. B. The lower the correlation, the more diversified the portfolio. C. When the correlation coefficient is 0, the portfolio is at its maximum diversification. D. Correlation is primarily used for individual investments rather than portfolios. The correct answer is A. One of the best ways to diversify a portfolio is to add investments with a negative correlation to the rest of the assets. A zero correlation means there is no predictable relationship between these assets and the rest of the portfolio. As should be clear from this explanation, correlation is used for portfolio diversification one does not diversify an individual asset. Question 2. An investor holds a portfolio in stocks that generally react in similar fashion to economic events. When seeking to add securities to the portfolio that will follow the same path, it would be logical to select which of the following stocks. A B, C, correlation negative 0.82. B, D, E, F, correlation negative 0.25. C, G, H, I, correlation positive 0.25. D, J, K, L, correlation positive 0.82. The correct answer is D. Following the same path means a high correlation. This investor is not looking to diversify the portfolio. For that, the best choices would be the negative correlation stock. Lesson 20.6, Financial Statement Calculations. Learning Objective 20. Calculate liquidity and valuation ratios of common stock. Using the balance sheet. One of the key tools in fundamental analysis is the corporation's financial statements. We have viewed the balance sheet and income statement in Unit 7 and now are going to focus on the most testable calculations derived from those documents. We will begin with the 3 ratios that evaluate liquidity as determined by examining the company's balance sheet. Working capital. Working capital is the amount of capital or cash a company has available. Working capital is a measure of a firm's liquidity, which is its ability to quickly turn assets into cash to meet its short-term obligations. The formula for working capital is current assets less current liabilities equals working capital. Factors that increase working capital include increases in cash from the sale of securities, long-term debt or equity, profits from the business operations, and the sale of non-current assets, such as equipment no longer in use. Factors that decrease working capital include increasing current liabilities, such as declaring cash dividends, paying off long-term debt at maturity, or, if called, earlier, and net operating losses. Current ratio. Knowing the amount of working capital is useful, but it becomes an even better indicator when paired together with the current ratio. This computation uses the same 2 items, current assets and current liabilities, but expresses them as a ratio of one to the other. Simply divide the current assets by the current liabilities, and the higher the ratio, the more liquid the company is. Quick asset ratio, acid test ratio. Sometimes it is important for the analyst to use an even stricter test of a company's ability to meet its short-term obligations. As such, pass the acid test. The quick asset ratio uses the company's quick assets instead of all of the current assets. Quick assets are current assets minus the inventory. Then divide these quick assets by the current liabilities to arrive at the quick ratio. Take note. Liquidity measures a company's ability to pay the expenses associated with running the business. Example. As with most arithmetic, there are 2 ways to get to the correct answer. The standard formula for the quick asset ratio is the following. Current assets minus inventory divided by current liabilities. The same result is achieved by adding together all of the current assets except the inventory and then dividing by the current liabilities. Here are 2 additional computations relying on the balance sheet. Debt-to-equity ratio. The best way to measure the amount of financial leverage being employed by the company is by calculating the debt-to-equity ratio. It is really a misnomer. It should be called the debt-to-total capitalization ratio because that is what it is. For example, using the numbers in the capitalization table below, we see that the total capital employed in the business is $90 million. Of that, $50 million is long-term debt. So, we want to know how much of the $90 million total is represented by debt capital. The answer is simple, $50 million of the $90 million, or 55.55%. That is the debt-to-equity ratio. Capitalization table. Long-term debt, $50 million. 4% preferred stock, 1 million shares at $20 par value, $20 million. Common stock, 1 million shares at $1 par value, $1 million. Capital surplus, common stock issue price at $4 per share, $4 million. Retained earnings, $15 million. Total equity capital, $40 million. Total capitalization, long-term debt plus equity, $90 million. Book value per share. A fundamental analyst is described as one who focuses on the company's books. Therefore, one of the key numbers computed is the book value per share. In the case of a corporation, This is basically the liquidation value of the enterprise. That is, let's assume we sold all of our assets, paid back everyone we owe, and then split what was left among the stockholders. But remember, before we can hand over anything to the common shareholders, we must take care of any outstanding preferred stock. So, from the funds that are left after we pay off all of the liabilities, we give the preferred shareholders back their par, or stated, value, and the rest belongs to the common stockholders. But there is one more thing. In the case of liquidation, some of the assets on our books might not really be worth what we're carrying them at. In particular, those that are known as intangible assets, goodwill, patents, trademarks, copyrights, etc. That is why the analyst uses only the tangible assets, computed by subtracting those intangibles from the total assets. Expressed as a formula, book value per share is tangible assets less liabilities less par value of preferred divided by shares of common stock outstanding equals book value per share. Test topic alert. Book value reflects the theoretical liquidating value of the company, not its intrinsic value. Fixed assets are shown at actual cost, the original purchase price, minus the accumulated depreciation. Their actual value may be higher or lower. Using the income statement. There are a number of important ratios that can be computed using information from the income statement. We'll take a look at several of them. Earnings per share, EPS. Among the most widely used statistics, EPS measures the value of a company's earnings for each common share. EPS equals earnings available to common divided by number of shares outstanding. Earnings available to common are the remaining earnings after the preferred dividend has been paid. Earnings per share relates to common stock only. Preferred stockholders have no claims to earnings beyond the stipulated preferred stock dividends. Simplified income statement. Net revenues, sales, $10 million. Less cost of goods sold, including $500,000 of depreciation, $5,500,000. Equals gross profit or margin, $4,500,000. Less other operating expenses, rent, utilities, $500,000. Equals operating profit, EBIT, $4 million. Less interest expense, $750,000. Equals income after interest expense, pre-tax income, $3,250,000. Less income tax, $1 million. Equals net income, $2,250,000. Preferred dividend, 1 million shares at 80 cents, $800,000. Earnings available for common, $1,450,000. Earnings per share, 1 million common shares outstanding, $1.45. Dividends per share, $1, $1 million. Credited to retained earnings, $450,000. Earnings per share after dilution. EPS after dilution assumes that all convertible securities, such as warrants and convertible bonds and preferred stock, have been converted into the common. Because of tax adjustments, the calculations for figuring EPS after dilution can be complicated and will not be tested. Current yield, dividend yield. A common stock's current yield expresses the annual dividend payout as a percentage of the current stock price. Current yield equals annual dividends per common share divided by market value per common share. Example. LM Incorporation pays a quarterly dividend on its common stock of 50 cents per share. If the current market price of LM in common stock is $80 per share, what is the current yield? The first step is to recognize that quarterly dividends of 50 cents total $2 annually. Then, we plug the numbers into the formula. $2 equals 0.025 or 2.5% current yield. One way to remember this is that we are computing the return on $80.00 your investment. So take the return, $2, and put it on your investment, $80. Dividend payout ratio. The dividend payout ratio measures the proportion of earnings paid to stockholders as dividends. In general, older, well-established companies pay out larger percentages of earnings as dividends. Utilities as a group have an especially high payout ratio. Growth companies normally have the lowest ratios because they reinvest their earnings in the businesses. Companies on the way up hope to reward stockholders with gains in the stock value rather than with high dividend income. Example. Using the simple income statement above, we see that the company paid dividends of $1 per share out of the earnings of $1.45 per share. That is a ratio of approximately 68.97%. Simply, the computation is dividends paid over divided by earnings made. It can be shown as total dividends and total net income in our income statement that would be $1 million divided by $1.45 million, or as dividends per share and earnings per share, $1 divided by $1.45. It is the same 68.97% either way. Market price-related ratios. Price to earnings, PE ratio. The widely used price to earnings, PE, ratio provides investors with a rough idea of the relationship between the prices of different common stocks compared with the earnings that accrue to one share of stock. PE ratio equals current market price of common share divided by earnings per share, EPS. Example. In our income statement, we see that the earnings per share are $1.45. If the stock's current market price is $29, what is the PE ratio? Simply take the price, $29, and place it on the earnings, $1.45, and that computes to 20. So, we say the PE ratio is 20 to 1. In general, the exam will be looking for the trailing PE ratio, which means the earnings used are the actual results for the past 12 months. Some analysts use the forward PE ratio, that is, using the projected earnings for the coming 12 months. Growth companies usually have higher PE ratios than do cyclical companies. Investors are willing to pay more per dollar of current earnings if a company's future earnings are expected to be dramatically higher than earnings for stocks that rise and fall with business cycles. Companies subject to cyclical fluctuations generally sell at lower PE ratios. Declining industries sell at still lower PE ratios. Investors should be aware of extremely high or extremely low PE ratios. Speculative stocks often sell at one extreme or the other. If a stock's market price and PE ratio are known, the earnings per share can be calculated as follows. EPS equals current market price of common stock divided by PE ratio. Example. If the price of the stock is $29 and that is 20 times the earnings must be $29 divided by 20 or $1.45 per share. Take note. A company's stock trades for $30 per share and has earnings of $1.50 per share. It has a PE multiple of $20 to $30 divided by 1.5 equals 20. If the average PE of the company's industry is 11, this stock is high-priced. If the average PE is 35, this company is low-priced. Test topic alert. Some fundamental analysts feel that the company's sales to earnings ratio is more valuable than the PE ratio because different accounting methods can impact earnings much more than sales. Price to book ratio. The price to book ratio reflects the market price of the common stock relative to its book value per share. It is the current market price divided by the book value per share. As stated previously, the balance sheet is used to calculate book value. The book value is the theoretical value of a company, stated in dollars per share, in the event of liquidation, and bears no relationship to the stock's current trading price. When calculating book value, fixed assets are shown at their cost less accumulated depreciation. That is, a drill press that had an original cost of $100,000 but has been depreciated by $40,000 would be counted as $60,000 when calculating the company's book value. This ratio is particularly useful when evaluating companies with inconsistent or negative earnings. Take note. A quick rundown of the most testable points about ratios follows. Book value is the company's theoretical liquidation value expressed on a per-share basis. Growth companies have higher PE ratios than do cyclical or defensive companies. Earnings per share relates only to common stock. It assumes preferred dividends were paid. Practice question. RMBN common stock is currently selling for $60, which gives the stock a PE ratio of 20 to 1. Based on that information, the earnings per share are A, $2, B, $3, C, $5, D, $2. The answer is B. This is simply telling us that the price of $60 is 20 times the earnings. That would make the earnings 60 divided by 20 or $3. Knowledge check 20.6. Question 1. A fundamental analyst comparing a corporation's current assets to its current liabilities is viewing the company's A, net worth, B, net income, C, working capital, D, leverage ratio. The correct answer is C. The formula for working capital is current assets minus current liabilities. Net worth is all of the assets minus all of the liabilities. Net income is the revenues minus all of the expenses and taxes. The leverage ratio is the percentage of long-term debt to the total capital, equity plus long-term debt. Question 2. The balance sheet of DEF Corporation shows that included in its $15 million in current assets is $4 million in cash and $2 million in accounts receivable. If DEF's current liabilities are $4 million, the quick asset ratio is A. 1.0 to 1, B. 1.5 to 1, C. 2.5 to 1, D. 3.0 to 1. The correct answer is B. We aren't told what the inventory is, but we are given the other current assets. So we can add together the $4 million in cash to the $2 million in receivables, resulting in $6 million divided by the $4 million in current liabilities for a 1.5 to 1 answer. It wasn't necessary for the question to tell us the inventory. We didn't have to subtract it because we never included it in the first place.
Unit 21. Portfolio Management Styles, Strategies, and Techniques. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 21A. Discriminate between the major asset classes used in an asset allocation program. Learning Objective 21B. Identify the risk reduction benefits of diversification. Learning Objective 21C. Describe the difference between active and passive management styles. Learning Objective 21D. Evaluate the methods used to determine the value of equity securities. Learning Objective 21E. Contrast the different portfolio management strategies, styles, and techniques. Learning Objective 21F. Compare the 3 techniques for minimizing interest rate risk. Learning Objective 21G. Identify the components of the capital market theory. Learning Objective 21H. Calculate the expected return using the security market line. Learning Objective 21I. Identify the 3 forms of the efficient market hypothesis. Learning Objective 21J. Illustrate how dollar cost averaging results in lowering an investor's average cost per share. Learning Objective 21K. Describe the use of put and call options to hedge positions. Your exam will include approximately 9 questions from the topics covered in Unit 21. Introduction. Portfolio managers use a range of investment styles and strategies. Although each style attempts to generate superior investment returns and reduce investment risks, no single style is suited to every investor. Often, an investment advisor's role is to guide clients toward a mutual fund or private money manager that is consistent with the client's objectives and temperament. The unit will conclude with a look at some of the techniques used by the various styles and strategies discussed. Lesson 21.1. Asset Allocation. Learning Objective 21A. Discriminate between the major asset classes used in an asset allocation program. The theory of asset allocation. Asset allocation, more accurately but rarely stated, asset class allocation, refers to the spreading of portfolio funds among different asset classes with different risk and return characteristics based on the Investment Policy Statement, IPS. Proponents of asset allocation feel that the mix of assets within a portfolio, rather than individual stock selection or marketing timing, is the primary factor underlying the variability of returns in portfolio performance. There are 3 major types, each with subclasses, of asset classes. Stock equities with subclasses based on market capitalization, value versus growth, and foreign equity. Bonds, debt, with subclasses based on maturity, intermediate versus long-term, and issuer, treasury versus corporate versus non-U.S. issuers. Cash or cash equivalents, focusing mainly on the standard risk-free investment and the 91-day, 13-week treasury bill, but also including other short-term money market instruments. Proper asset allocation takes into consideration the investor's desire for preservation of capital, income, capital growth, or a combination of all of these. In some instances, tangible assets, such as real estate, usually in the form of REITs, precious metals and other commodities, and certain collectibles, think fine art, are part of the asset allocation because these types of assets tend to reduce inflation risk. Increasingly, institutional investors, and some very high net worth individuals, due to the high cost of entry, are using such alternative investment asset classes as ETNs, private equity, and venture capital. It is important to understand that asset allocation is not simply spreading the money around helter-skelter to different asset classes. There is a process as described in the following question. Practice question. Which of the following best describes the steps of the asset allocation process? A. Determine the objectives and constraints, create the IPS, determine the asset allocation, allocate capital, monitor and evaluate. B. Determine the objectives and constraints, determine the asset allocation, allocate the capital, create the IPS, monitor and evaluate. C. Determine the objectives and constraints, perform asset allocation, create the IPS, monitor and rebalance. D. Determine the objectives and constraints, determine capital market expectations, create the IPS, perform asset allocation, monitor and evaluate. The answer is A. Steps in the asset allocation process are: Step 1. Determine the objectives and constraints of the asset owner. Step 2. Create the investment policy statement, IPS. Step 3. Determine the asset allocation based on the IPS. Step 4. Allocate capital. Step 5. Monitor and evaluate investments. Learning Objective 21B. Identify the risk reduction benefits of diversification. The term diversification has been used many times already in this manual. The term is a common one in our everyday life, not restricted to investing. As a technique in portfolio management, portfolio diversification, committing to an array of separate investments, reduces unsystematic risk, such as business risk, and enhances returns. The securities in a diversified portfolio are selected, in part, because they do not tend to move up or down in relation to each other. When some go down, the loss is offset by those that rise. That is the concept we covered with the correlation coefficient. This kind of diversification is enhanced by the addition of foreign securities to a portfolio, because they are usually not highly correlated with domestic equity. There are many ways to classify investment and financial products. The investment pyramid, shown below for example, categorizes products according to their risk and return potential. Another way is to group similar products into specific classes. These classes are generally defined as the following: cash and cash equivalents, passbook savings and checking accounts, money market funds, certificates of deposit T-bills. Fixed income investments, corporate bonds, municipal bonds, treasury bonds, bond funds, mortgage-backed securities. Equities, preferred and common stocks of all kinds, growth and income appreciation, stock mutual funds. Hard assets, real estate, collectibles, precious metals and stones. Each of these asset classes as a whole responds differently to different types of risk. Therefore, diversifying or allocating investment resources among these classes is a proven way to reduce risk overall, dampen volatility, and improve the performance of one's portfolio. Fixed income products, for example, are a hedge against deflation. Equities are a hedge against inflation. To minimize market risk, one could diversify among all four asset categories, with additional diversification within the equities category. To minimize interest rate risk, one could diversify within the fixed income category by staggering bond maturity dates. To minimize business risk, one could allocate among the four categories and purchase mutual funds. To reduce liquidity risk, one would keep a sufficient portion of assets in cash or cash equivalent assets. Risk-return pyramid. A triangle where as you rise there's increasing risk of loss of principal and increasing potential for capital appreciation. As you go down the triangle, there's increasing risk of loss of purchasing power and increasing safety of principal. There are 7 rows. The bottom row, row 1, includes FDIC-insured checking and savings accounts, Treasury bills, notes and bonds, insurance-based investments, U.S. savings bonds, and FDIC-insured certificates of deposit. Row 2 includes high-grade municipal bonds, money market accounts, and high-grade corporate bonds. Row 3 includes balanced mutual funds, high-grade preferred stock, and high-grade convertible securities. Row 4 includes high-grade common stock and growth mutual funds. Row 5 includes limited partnerships, real estate, and options. Row 6 includes speculative common stocks and bonds and gold, silver, and collectibles. Row 7 is commodities and futures. Example: simply adding more securities to a portfolio does not necessarily reduce portfolio volatility. For example, if the beta of a portfolio was 1.1, adding which of the following stocks would most likely increase the overall portfolio volatility? Stock A, beta 1.5. Stock B, beta 1.1. Stock C, beta 1.0. Stock D, beta 0.7. The addition of a security with a beta higher, stock A, than that of the current portfolio will increase overall portfolio volatility. Diversification is not a synonym for asset allocation. For example, an aggressive young professional may invest almost exclusively in common stock. That would be a single asset class. But within that asset class of common stock, the portfolio might consist of the shares of a dozen or more different companies in varied industries. Knowledge Check 21.1. Question 1. A portfolio manager of an asset allocation fund would be least likely to invest in A. To common stock, B. Debentures, C. Raw land, D. U.S. Treasury bills. The correct answer is C. The primary asset classes for asset allocation purposes are equity, debt, and cash, or cash equivalents. In addition, many consider real estate to be an asset allocation class. However, fund managers usually invest in that asset through liquid investments, such as REITs, not raw land. Question 2. Professional investment managers believe that a well-diversified portfolio offers protection from which of the following risks? A. Business risk, B. Interest rate risk, C. Market risk, D. Purchasing power risk. The correct answer is A. Diversifiable risks are those unsystematic risks we covered in Unit 19. By investing in a number of different companies and industries, the business risk of the failure of one of them is minimized. It is the old saying, don't put all of your eggs in one basket. Interest rate, market, and purchasing power risks are all systematic risks and are considered non-diversifiable. For example, regardless of how well a bond portfolio is diversified, it will be affected by changes in interest rates and the inflation rate. Lesson 21.2. Active and Passive Portfolio Management Styles. Learning Objective 21C. Describe the difference between active and passive management styles. Asset allocation styles. The two most common forms of asset allocation are tactical and strategic. You may see the terms active and passive management referring to these two. Tactical asset allocation. Tactical asset allocation refers to short-term portfolio adjustments that adjust the portfolio mix between asset classes in consideration of current market conditions and investor sentiment. Example: if the stock market is expected to do well over the near term, a portfolio manager may allocate greater portions of a portfolio to stocks. If the market is expected to decline, the portfolio manager may allocate greater portions of the portfolio entirely to bonds and cash. This is done in an attempt to create positive alpha for the portfolio. An active tactical portfolio manager, using a particular stock selection approach, typically buys and sells individual securities. Active management relies on the manager's stock picking and market timing ability to outperform market indexes. Market timing is the strategy of making buy or sell decisions, generally regarding stocks, by attempting to predict future price movements. Usually the focus is on timing the overall market, rather than a specific security. Example: an active portfolio manager may position the portfolio in stocks within a few market sectors, such as pharmaceuticals and technology, frequently trading in and out of the stocks. An active manager may change the sector focus to capitalize on relative performance of different sectors during different stages of the business cycle. The goal is to successfully time the market. The term used to describe this process is sector rotating, sometimes called sector or segment rotation. Different sectors of the economy are stronger at different points in the economic cycle. Each industry sector follows its cycle as dictated by the stage of the economy. Portfolio managers attempt to buy into the next sector that is about to experience a move up. When an industry sector reaches the peak of its move as defined by the business cycle, it is time to start to sell the sector. Test topic alert. One way to remember that tactical is active is by thinking of the word like this: tactical, where the act reminds you that it is active portfolio management. Strategic asset allocation. Strategic asset allocation refers to the proportion of various types of investments composing a long-term investment portfolio. A passive portfolio manager believes that no particular management style will consistently outperform market averages, and therefore constructs a portfolio that mirrors a market index, such as the S&P 500. In many cases, rather than construct a portfolio, those following this style will simply recommend index funds and /or ETFs. Passive portfolio management seeks low-cost means of generating consistent long-term returns with minimal turnover. When a portfolio is passively managed, it can happen that one asset class or even a single security can rise or decline in such a manner as to cause the portfolio to no longer mirror the targeted index or portfolio balance. When that happens, the manager will rebalance the portfolio. We'll demonstrate how in the next learning objective. Example. A standard asset allocation model suggests subtracting a person's age from 100 to determine the percentage of the portfolio to be invested in stocks. According to this method, a 30-year-old would be 70% invested in stocks and 30% in bonds and cash. A 70-year-old would be 30% invested in stocks with the remainder in bonds and cash. Test topic alert. You may be asked about the relative commission expense when comparing active and passive management. It should be obvious that the more active the portfolio, the greater role commissions will play in determining overall portfolio performance. That is one reason why this style is more appropriate than strategic allocation for wrap fee accounts. Rebalancing. A passive portfolio is rebalanced to bring the asset mix back to the target allocations. If the stock market should perform better than expected, the client's proportion of stocks to bonds would be out of balance. So, on some timely basis, perhaps quarterly but not less than annually, stocks would be sold and bonds would be purchased, or funds would be placed in cash, to bring the proportions back to the desired levels. Example. Using the 70% equity 30% debt model described above, the investor's initial investment of $100,000 is split $70,000 into equity securities and $30,000 into debt securities. Let's say the account is to be rebalanced semi-annually. Because of a bull market in stocks, 6 months later, the account value is $120,000. Analysis of the account indicates that the value of the equities is now $90,000, whereas the bonds have remained stable at $30,000. To rebalance, that is, to bring the account back to the 70-30 ratio, it will be necessary to sell $6,000 of the equity and invest those funds into debt. That will make the account $84,000 equity and $36,000 debt, our desired 70-30 ratio. The effect of this is that stocks are sold in a rising market and purchased in a falling market, following the old adage of buy low and sell high. Now, we try one. Practice question. A conservative client's portfolio is designed to have a 60-40 ratio of debt to equity securities. The initial investment was $250,000. 1 year later, the value of the portfolio is $260,000, with $90,000 of that represented by the equity portion. If the portfolio is rebalanced annually, this would require A. Selling $14,000 of debt and buying $14,000 of equity. B. Selling $14,000 of equity and buying $14,000 of debt. C. Selling $6,000 of debt and buying $4,000 of equity. D. Buying $10,000 of equity and selling $10,000 of debt. The answer is A. A 60-40 ratio will require the debt represent $156,000, 60% of $260,000, and equity represent the balance, $104,000. Thus, this portfolio will be rebalanced by selling $14,000 of debt and purchasing $14,000 of equity. Choice A. Constant ratio plan. An investment plan that attempts to maintain the type of relationship shown in our example between debt and equity securities, or other asset classes, is sometimes called a constant ratio plan. Periodically, the account is rebalanced to bring it back to the desired ratio. Constant dollar plan. This is another form of rebalancing. Under this investment plan, the goal is to maintain a constant dollar amount in stocks, moving money in and out of a money market fund when necessary. Using the last example, if the investor had a goal of a constant dollar amount of $70,000 in stock, the other $30,000 would be placed into a money market fund. When the stock value rose to $90,000, $20,000 would be liquidated and placed into the money market account. At this point, the account would have the desired $70,000 in stock and now have $50,000 in money markets. If the stock value should drop to $55,000, the money market fund would be tapped for $15,000 to get back to the $70,000 constant dollar amount. Knowledge Check 21.2. Question 1. Which of the following statements is correct regarding a portfolio manager employing a tactical style? A. The commission expense will likely be higher than one employing a passive style. B. The portfolio will be rebalanced more often than would be the case with a passive style. C. The manager is looking to create a positive beta. D. The portfolio will contain a high percentage of index ETFs. The correct answer is A. A tactical portfolio management style is an active one with frequent trading. As such, commissions will be a larger portion of the operating expenses than would be the case with a passive strategy. Rebalancing is an integral part of passive management. The very nature of tactical management makes rebalancing unnecessary. Tactical asset managers are looking to create positive alpha, not beta, and it is the passive manager who invests in indexes through ETFs and or index funds. Question 2. A senior client's IRA $500,000 portfolio is 30/70 equity/debt mix. 6 months later, the portfolio balance is $520,000, of which $170,000 is equity. If the investment advisor recommends semi-annual rebalancing, the client will A. Sell $14,000 of the equity and use the proceeds to purchase $14,000 of debt. B. Sell $14,000 of the debt and use the proceeds to purchase $14,000 of equity. C. Stay put because selling now would realize a capital gain. D. Sell $20,000 of equity and leave the debt unchanged to return to the original 30/70 mix at $500,000. The correct answer is A. Rebalancing involves getting the account back to its original percentage mix, not original market value. The proper allocation of the current value of $520,000 would be $156,000 equity and $364,000 debt. With the equity above 30%, the rebalancing is done by selling $14,000 of the equity and using the proceeds to purchase $14,000 of debt. In an IRA, taxation is deferred until withdrawal. Lesson 21.3. Popular Management Strategies and Techniques. Learning Objective 21D. Evaluate the methods used to determine the value of equity securities. The two approaches most commonly used to select investments are fundamental and technical analysis. Both fundamental and technical analysts attempt to forecast prices or values of securities in markets. Fundamental analysis. Fundamental analysts evaluate broad-based economic trends, current business conditions within an industry, and the quality of a particular corporation's business, finances, and management. Technical analysts attempt to predict the direction of prices on the basis of charts reflecting priced and trading volume patterns of specific securities, without regard to the issuer's profitability. We will begin our discussion with fundamental analysis. Fundamental analysis is the study of the business prospects of an individual company within the context of its industry and the overall economy. They do this by examining the company in detail, including the financial statements and company management. We could compare this to an individual receiving a full physical examination that, in addition to all kinds of tests, would include a detailed family medical history. With a company, the financial statement analysis is like the blood tests, x-rays, stress tests, and so forth, and the evaluation of the company's management is like the medical history. One of the ways these analysts attempt to determine the value of common stock is through the use of dividend models. Dividend models. Some analysts believe that the value of a stock can be determined based upon current or anticipated dividends. The models work best for the company with dividends that are paid with regularity, so it is more popular with larger, well-established organizations than smaller companies with irregular dividend distributions. Two models used are the dividend discount model and the dividend growth model. Dividend discount model. This model states that the fair current market value of a stock should be equal to the present value of all future dividends. There are several methods to use, such as assuming constant or variable dividends, but the concept is still the same. We take the investor's expected future returns, the dividends, and then discount that amount to compute the present value. It is not necessary to know the formula for the exam. However, it can be calculated by dividing the annual dividend by the expected return, sometimes referred to as the required rate of return. For example, if a stock pays a $1.20 dividend and the required rate of return in the marketplace is 6%, the stock should be worth $20, 120 divided by 0.06. If it is priced above that, it might be overvalued. If less, it might be undervalued. This tool may also be used to value preferred stock. Let's take a look at the following example. Example. If you have a $100 par, 6% preferred stock and the required rate of return is 8%, what should the current market price of the stock be? You might encounter a question similar to this on the exam, and you solve it by dividing the $6 dividend, 6% of the $100 par, by the 8% required rate of return. $6 divided by 0.08 equals $75. In other words, if this preferred stock is selling for $75 per share, the $6 annual dividend will produce an 8% return on your investment. Dividend growth model. This model assumes that the amount of the annual dividend will grow at a constant rate. Because projections of future growth can be hazy, this model is best used in conjunction with other forecasting tools. It is not necessary to know the formula for the exam. However, it should be obvious that the computed value will be higher when dividends are expected to grow rather than remain the same. Test topic alert. If you are asked on the exam, which model computes a higher current stock price? It should be common sense that the answer that factors in growth is the correct one. Remember, you will never have to do this computation on the test. Practice question. Among the popular methods of valuing equity securities is the dividend growth model. One could expect to see an analyst using this to value any of these except A. Common stock, B. ADRs, representing common stock in a foreign company, C. Preferred stock, D. None of these are exceptions. The answer is C. In order to use the dividend growth model, there must be a possibility of dividend growth. Because preferred stock dividends are fixed, this tool would not make any sense. Technical analysis. While fundamental analysis looks at the company, technical analysis looks at the market. A fundamental analyst attempts to measure the business or financial risk inherent in investing in a particular security, whereas technical analysis is used by an analyst to measure the market risk assumed when investing in a particular security. You have to know the goal of technical analysis and several of the more popular technical systems. Technical analysis is a method of attempting to predict stock price trends over the near term, generally 4 to 6 weeks. The prediction is based on current stock price trends and the relationship of the present trend to prior trends. These trends are measured through charts of price movements. Therefore, it would be correct to say that a technician uses charts to attempt to predict future price movements in an effort to reduce timing risk. In using these charts of price movements, a technician also uses the trading volume of the stock in an attempt to validate the trends. That is, increasing volume when a stock's price is rising is a bullish sign, and increasing volume when the stock's price is declining is a bearish sign. Let's start by defining some key terms. Take note. A technical analyst charts a stock's price and volume over a period of time. Test topic alert. Remember that the market price of a security, the number that is being charted, is based on supply and demand. Trend lines. In an effort to see where the price of stock may be going, the technician charts where it has been. She attempts to determine from her chart what the trend has been by drawing a trend line. A popular saying is, the trend is your friend. Support and resistance. Chartists believe that one can understand more about a stock by studying its chart. Two of the most important conclusions drawn from a chart are the support levels and resistance levels. The support level is that price where the stock price bottoms. In other words, once it gets that low, there becomes an imbalance between buyers and sellers. More investors seek to buy than sell, and the price begins to rise. The opposite is the resistance level, where the stock's price reaches a high enough level where there are now more sellers than buyers and the stock no longer rises in price. Just think of the English definitions of the terms, and they make sense. That is, support is where you stop falling and resistance is where you can't go any higher. Breakout. When the price movement penetrates the support level or the resistance level, it is known as a breakout. The analyst believes that once a breakout has been confirmed, there will be rapid price movement in the direction of the break until a new support or resistance level is established. The technician believes that if a breakout through resistance can be spotted, it represents a good buying opportunity for those quick enough to take advantage. Conversely, a breakout through the support level would represent a good opportunity for short sellers able to move quickly. Moving averages. To avoid the volatility frequently present in stock price trends, analysts will use the moving average. A moving average attempts to modify the fluctuations of stock prices into a smooth trend. The distortions are reduced to a minimum. For example, to plot a 13-week moving average on a particular stock, take the Friday closing price for each of the previous 13 weeks, add them together, and divide by 13. That number will be the average closing price for the last 13 weeks, and that number is plotted. The next week, you would add the new closing price for that week and delete the closing price for the first week used 14 weeks ago. This average would be plotted on the same chart as the actual current price movement of the stock. Changes in the trend of the stock being plotted are identified not by a change in the direction of the moving average, but by the price of the security crossing over the moving average. If the stock price moved below the moving average, it is usually a signal of a change from a rising market to a declining market. The reverse is also true. Technical market theories. Technical analysts follow various theories regarding market trends. Short interest theory. Short interest refers to the number of shares that have been sold short. Because short positions must be repurchased eventually, some analysts believe that short interest reflects mandatory demand that creates a support level for stock prices. High short interest is a bullish indicator, and low short interest is a bearish indicator. Odd lot theory. Typically, small investors engage in odd lot trading, which is transactions of fewer than 100 shares. Odd lot theorists believe that small investors invariably buy and sell at the wrong times. When odd lot traders buy, odd lot analysts are bearish. When odd lot traders sell, odd lot analysts are bullish. Advanced decline theory. The number of issues closing up or down on a specific day reflects market breadth. The number of advances and declines can be a significant indication of the market's relative strength. When declines outnumber advances by a large amount, the market is bearish even if it closed higher. In bull markets, advances substantially outnumber declines. Technical analysts plot daily advances and declines on a graph to produce an advanced decline line that gives them an indication of market breadth trends. Practice question. In the assessment of a company's stock, a technical analyst takes into consideration all of the following except A. Earnings, B. Market price, C. Price trends, D. Volume. The answer is A. A market technician, technical analyst, deals primarily with timing of activity and market trends, while a fundamental analyst centers on a particular industry or company within an industry and its earnings, choice A, relative health, and market potential. Practice question. Proponents of which of the following technical theories assume that small investors are usually wrong? A. Advance/decline, B. Moving averages, C. Odd lot, D. Short interest. The answer is C. Odd lots are usually traded by small investors. Some analysts believe small investors are generally wrong, making choice C correct. Learning Objective 21E. Contrast the different portfolio management strategies, styles, and techniques. Management styles and techniques. There are a number of different styles and techniques used by money managers. For the most part, these can be considered subsets of either active or passive management, or both. Buy and hold. A buy and hold manager rarely trades in the portfolio. This results in lower transaction costs and capital gains, which are invariably taxed at the lower long-term rate, Unit 15. A low expense ratio in a mutual fund often may reflect a buy-and-hold approach. This is the classic passive strategy used by investors for many years, and is probably the easiest of all to implement and follow. With this strategy, there is always the question, when do I sell? As with most investment strategies, there are varying opinions. On an individual investor level, one of the most common reasons for unloading a position is a change in objectives. This is certainly true as one ages, or if one has a windfall, such as an inheritance. Of course, if there is a personal financial need, the asset will be sold to provide the necessary funds. Portfolio managers using this style may sell when the stock's fundamentals have weakened, such as a sharp decrease in earnings, or there is a change in the competitive arena. Think of what digital cameras did to Kodak. Another case would be when the company's price-to-earnings (PE) ratio has reached levels well above those for its competitors. Test topic alert. Maybe you've owned a car that was, so to speak, a lemon. That generally means that you had high maintenance costs. Well, one point to know about the buy and hold style is that it is just the opposite, it is low maintenance. Indexing. Investment portfolios constructed to mirror the components of a particular stock index, such as the S&P 500, will normally perform in line with the index. Because such portfolios are not actively managed, the costs of managing the portfolio are relatively low. With less frequent portfolio turnover, these funds have lower transaction costs and tend to be more tax efficient. Because most professional money managers are unable to consistently outperform market indexes, indexed mutual fund portfolios are a popular vehicle for investors. With the advent of index funds and ETFs, this has become a very popular passive strategy. Growth versus value. One of the longest-running arguments in investment analysis is, which is more successful, the growth style or the value style? The father of value investing was Benjamin Graham, and his text Security Analysis, co-authored with David Dodd, is still widely read today. The exam won't ask you about Graham and Dodd, but will want you to know the essential features of both styles. Growth style. Portfolio managers using the growth style of portfolio management focus on stocks of companies whose earnings are growing faster than most other stocks and are expected to continue to do so. Because rapid growth in earnings is often priced into the stocks, growth investment managers are likely to buy stocks that are at the high end of their 52-week price range. Therefore, in the eyes of some, they might be buying stocks that are overvalued. Because this adds an element of business risk, it is common for growth managers to include some negatively correlated assets to their portfolios. Test topic alert. Growth managers are looking for earnings momentum. Value. Portfolio managers using the value style of management concentrate on undervalued or out-of-favor securities whose price is low relative to the company's earnings or book value, and whose earnings prospects are believed to be unattractive by investors and securities analysts. In fact, sometimes value managers think they can find a bargain with companies that are currently operating at a loss, no earnings, hence no P/E ratio. Value investment managers seek to buy undervalued securities before the company reports positive earnings surprises. Their primary source of information is the company's financial statements. Value investment managers are more likely to buy stocks that are at the bottom of their 52-week price range. Test topic alert. In addition to the pricing models expressed above, growth managers expect to see high P/E ratios, price-to-earnings ratios, or high price-to-book ratios with little or no dividends. On the other hand, value managers expect to see low P/E ratios or low price-to-book ratios and dividends offering a reasonable yield. Another sign of a value stock is a large cash surplus, sometimes referred to as a rainy day fund. Example: a BCO is a metal processor for parts used in the automotive industry. Earnings per share have grown by a compounded rate of 8% per year for the past 15 years, but are somewhat susceptible to downturns in the economy. The stock has paid a quarterly dividend that has increased 5 times in the past 10 years, and the current market price of the stock is 6 times the earnings. Conservatively managed, the company owns assets in cash that exceed the market value of its common stock. A BC would be attractive to value investors because its intrinsic value is higher than its market value. It appears to pay liberal dividends, and it is selling for a low earnings multiple. Other portfolio management styles. In addition to those already described, there are several other styles you should be familiar with. Contrarian. A contrarian is an investment manager who takes positions opposite that of other managers or in opposition to general market beliefs. In essence, these managers buy when everyone else is selling and sell when everyone else is buying. Income versus capital appreciation. At first glance, this might appear to be a rehashing of growth versus value, and although there are some similarities, you should be aware of what each of these styles represents. Capital appreciation can take several forms, from moderate to aggressive. Although growth stocks will frequently be found in these portfolios, the hunt for appreciation will also involve options and slasher futures, special situation stocks, potential takeover or merger candidates, futures, IPOs, and day trading. When recommending a manager using this style, it is critical to determine where on the risk scale, from lower to moderate to speculative, this manager's philosophy is. Then, and only then, can you attempt to match it with your clients. As the term implies, the income style focuses on generating portfolio income. When dividends on common stock offer better income opportunities than interest on debt securities, the portfolio will be overweighted in that direction. Frequently, the search for income will lead the portfolio manager to foreign securities and slash or high-yield bonds. When recommending a manager using this style, it is important to evaluate the risks being taken to provide income. For the most part, an income style relies heavily on debt securities. Market capitalization. Another portfolio management style is using market capitalization to influence security selection. A company's market capitalization, usually referred to as market cap, is the product of the number of outstanding shares and the current market price per share. For example, if a corporation has 100 million shares of common stock outstanding and the market price per share is $50, the market cap is $5 billion. Although the boundaries are imprecise, micro-cap companies are generally those with a market capitalization of less than $300 million. Small-cap companies are generally those with a market capitalization of between $300 million and $2 billion. Mid-cap companies are those with $2 billion to $10 billion, and large-cap companies are those with more than $10 billion. It is generally assumed that small companies with a short history, small product line, and limited financial resources represent a larger degree of risk in an economic downturn. As revenues, product diversification, and financial worth increase, the relative risk the company carries in a weak economy diminishes. In Unit 22, we will match each level to its appropriate benchmark index. Test topic alert. Look out for numbers written in long form. For example, where would you categorize a stock with a market capitalization of $5 billion? Were you able to fight through all of those zeros to see that this is $5 billion and is a mid-cap security? Take note. In a strong economy, small, fast-moving companies with a concentrated product line in a fast-growing sector can dramatically outperform larger, more bureaucratic companies. Monte Carlo simulations. Stochastic modeling is a method of financial analysis that attempts to forecast how investment returns on different asset classes vary over time by using thousands of simulations to produce probability distributions for various outcomes. The term stochastic comes from the Greek word meaning to aim or guess. When an investment advisor is called upon to provide advice on developing a plan for a client's funds to last throughout what might be a 30-year or even longer retirement, all the advisor can do is make an educated guess. A popular form of stochastic modeling that uses computer-generated distributions is the Monte Carlo simulation, MCS. This simulation is an analytic and risk management tool widely used in finance. MCS incorporates computer programming to generate thousands of different probabilities. Consider the uncertainty in retirement planning. Small changes in the projected rate of return will make a dramatic difference in the outcome. Life expectancy is also another important variable that may be incorrectly approximated. MCS uses a random number generator to provide an output with specific probabilities of outcomes. The simulation provides insight into the range of outcomes and provides the user, the investor or advisor, with both best-case and worst-case scenarios. Advantages. MCS can clearly display trade-offs of risk and return. The paths can be ranked from best to worst to assess the probability of any given outcome. A clearer understanding of short-term and long-term risk can be gained. For example, reducing the holdings of risky stock would reduce the short-term variability of the portfolio, but increase the long-term risk of running out of money. MCS can better model the real probability process where return over time depends not only on the starting value of the period but also on the additions or withdrawals to the portfolio at each future period. Points along the timeline can be considered to answer questions such as the following. Do savings need to be increased? Can I retire earlier? Must I retire later? Do I need to reduce my withdrawal rate? Can I increase my withdrawal rate? Disadvantages. Simplistic use of historical data, such as expected returns for the inputs. Returns change and have a major effect on projected future values of the portfolio. Models that simulate the return of asset classes, but not the actual assets held. Simulating the return of the Wilshire 5000 or the S&P 500 when a fund with fees will be held could significantly overstate the future value or time period over which distributions can be sustained. For an individual entering retirement, the timing of the cash flows out of the portfolio and the sequence of returns are critical. Example. Consider two clients, Mr. Jones and Ms. Smith. Both enter retirement with $1 million. Both withdraw $50,000 per year from their portfolios, and both portfolios generate an average return of 10% over the life of the portfolios. Their yearly results are the same, but they come in different sequences. Mr. Jones experiences 15 up years followed by 5 down years. Ms. Smith experiences 5 down years followed by 15 up years. Mr. Jones will be better off than Ms. Smith because Ms. Smith will deplete her portfolio in the early years, and hence her portfolio will not benefit fully from the positive return years down the line. The concept of ill-timed cash flows may be easy for experienced advisors to grasp, but it is not one that clients readily understand. Through the use of MCS, advisors can easily generate charts and graphs to educate clients about sequential return issues. Learning Objective 21F. Compare the 3 techniques for minimizing interest rate risk. Most of the substance of the exam will deal with strategies employed in equity investing, but you may be asked about several popular strategies used by bond buyers. Primarily, the goal in all of these strategies is to mitigate the effects of interest rate fluctuations on the value of the principal, the income received, or both. Three in particular that have appeared on the exam are the barbell strategy, the bullet strategy, and the laddering strategy. All three of these are considered active rather than passive, and we will look at them individually. Barbells. Envision a barbell. What do you see? A thin bar with heavy weights of equal size on each end. That's what a bond portfolio using the barbell strategy looks like. The investor purchases bonds maturing in 1 or 2 years and an equal amount maturing in 10 or more years with no bonds in between. Assuming a normal yield curve, the long-term end of the barbell contains bonds offering the higher long-term interest rates, while the short-term end provides you with soon-to-be realized cash as they mature. They may be reinvested at higher rates if that is the direction the market takes. This is not a passive strategy like buy and hold. You will be actively buying new bonds as the old ones get closer to maturity. Bullets. For what do you use a bullet? You use it to hit a target, and that is the concept behind the bullet strategy. Let's say the target is funds for a child's college education, and the child is currently 6 years old. This strategy would have the investor purchase bonds today that mature in 12 years, assuming college will start when the child is 18. 2 years from now, the investor should purchase some more bonds, but those should have a 10-year maturity. In another 2 years, another purchase is made, this time of bonds that have 8 years to go, and so forth. A picture of this active strategy would reveal bonds purchased at different times but all maturing at the same time. This tends to allow the investor to capture current interest rates as they change rather than having the entire portfolio locked into one rate. Ladders. Picture a ladder. You see rungs at set intervals going from bottom to top. That is the concept behind a laddered portfolio. Unlike the bullet strategy described previously, where the bonds are bought at different times but all mature together, in a laddered strategy the bonds are all purchased at the same time but mature at different times, like the steps on the ladder. As the shorter maturities come due, they are reinvested and now become the long-term ones. This has also been a very common strategy with those purchasing CDs at their local bank. Practice question. An investor in debt securities might elect to use any one of the following techniques to limit interest rate risk except A. Barbells, B. Bullets, C. Increasing the duration, D. Laddering. The answer is C. The longer the duration, the greater the interest rate risk, so the investor would not want to do that. The others are useful strategies for reducing interest rate risk. Knowledge Check 21.3. Question 1. An analyst using the dividend discount model is attempting to A. Estimate the current earnings of a stock, B. Estimate the current price of a stock, C. Estimate the current return of a stock, D. Calculate the current return of a stock. The correct answer is B. The dividend discount model is a quantitative tool that estimates the fair current market value of a stock. The calculation assumes that a fair price should be equal to the present value of all future dividends. Question 2. A portfolio manager who typically purchases common stock when its market price is below the book value per share is most likely categorized as A. A contrarian, B. A growth manager, C. A value manager, D. Using the buy and hold strategy. The correct answer is C. Value managers look for undervalued stocks. In general, those stocks are selling below the book value per share. A contrarian buys when others are selling, and the reverse. That could be when the stock's value has gotten quite high when compared to its book value, and others don't believe it can continue its run. Growth stocks invariably trade at prices well in excess of their book value. Investors are buying future growth. Question 3. Which of the following statements regarding a bond ladder strategy is correct? A. A bond ladder strategy involves the purchase of very long-term and very short-term bonds. B. A laddered portfolio of bonds will provide lower yields than a portfolio consisting entirely of short-term bonds. C. A bond ladder strategy is generally more aggressive than a bond barbell strategy. D. A bond ladder strategy is a relatively easy way to immunize a portfolio against interest rate risk. The correct answer is D. A bond ladder strategy is a relatively easy way to protect a portfolio against interest rate risk. By holding many positions across the yield curve, The individual is diversified in the event that yields behave differently in one part of the curve than in another. The laddered portfolio will generally provide higher, not lower, yields than a portfolio consisting entirely of short-term bonds. Purchasing very long-term and very short-term bonds describes the bond barbell strategy, a more aggressive strategy than the bond ladder strategy. Lesson 21.4 Modern Portfolio Theory. Learning Objective 21G. Identify the components of the capital market theory. Capital market theory. Portfolio management theory builds on a foundation of assumptions about investors' behavior and was first introduced by Harry Markowitz in 1952. At its core, modern portfolio theory proceeds from the premise that investors will behave rationally. Pricing models have been introduced to determine what should be the proper market price for investment assets. The most familiar and useful of these models is the capital asset pricing model, known as Kaplan, which derives from the work of Markowitz and others, including William Sharpe, after whom the Sharpe ratio was named. There are several capital market theories, all with the goal of maximizing returns while minimizing risks. The capital asset pricing model, Kaplan, is a securities market investment theory allowing the investor to determine an asset's expected rate of return, a form of risk-adjusted return encapsulating how much risk the investor should assume to obtain a particular return from an investment. The Kaplan does so solely on the basis of the asset's systematic, non-diversifiable risk. It was William Sharpe who first formulated the Kaplan in the 1960s. The basic premise is that every investment carries two distinct risks: systematic risk, which cannot be diversified away, and unsystematic risk, which can be mitigated through appropriate diversification. As a result of this work and its further refinements, Professor Sharpe was awarded the Nobel Prize in Economics in 1990. That isn't tested. You will see several applications of the Kaplan in upcoming paragraphs. Modern portfolio theory. Modern portfolio theory, MPT, is an approach that attempts to quantify and control portfolio risk. It differs from a traditional securities analysis in that it emphasizes determining the relationship between risk and reward in the total portfolio, rather than analyzing specific securities. Under the Kaplan, the investor should be rewarded for the risks taken, so it is proper to assume that the higher the risk, the higher the return. Instead of emphasizing particular stocks, MPT focuses on the relationships among all the investments in a portfolio. This theory holds that specific risk can be diversified away by building portfolios of assets whose returns are not correlated. MPT diversification allows investors to reduce the risk in a portfolio while simultaneously increasing expected returns. Diversification reduces risk only when assets whose prices move inversely, or at different times, in relation to each other are combined. In other words, decreased correlation leads to decreased risk. The theory is that, all factors being equal, the portfolio with the least amount of volatility would do better than one with a greater amount of volatility. Test topic alert. The goal is to design the optimal portfolio. An optimal portfolio is one that returns the highest rate of return consistent with the amount of risk an investor is willing to take. In other words, an optimal portfolio is the portfolio that makes the best trade-off between risk and reward for a given investor's investment profile. Simply stated, given a choice between assets with equal rates of expected return, the risk-averse investor will always select the asset with the lowest level of risk. Practice question. Risk aversion means that if two assets have identical expected returns, a risk-averse individual will choose the asset with the A lower risk level, B higher standard deviation, C shorter payback period, D higher expected return. The answer is A. Risk-averse investors are those with a low tolerance or capacity for risk. Given a choice between assets with equal rates of expected return, the risk-averse investor will always select the asset with the lowest level of risk. Choice A. Standard deviation is a way to quantify risk. The higher the standard deviation, the greater the volatility. The payback period is used to evaluate capital projects, not investment returns. Capital market assumptions. The capital market theory builds upon the Markowitz portfolio model. The main assumptions of the capital market theory are as follows. 1. All investors can borrow or lend money at the risk-free rate of return. 2. All investors are rational and evaluate investments in terms of expected return and variability, standard deviation. Therefore, given a set of security prices and a risk-free rate, all investors use the same information to generate an efficient frontier. 3. The time horizon is equal for all investors. When choosing investments, investors have equal time horizons for the chosen investments. 4. There are no transaction costs or personal income taxes. Investors are indifferent between capital gains and dividends. 5. There is no inflation. 6. All assets are infinitely divisible. This indicates that fractional shares can be purchased. 7. There is no mispricing within the capital markets. It is assumed that the markets are efficient and that no mispricings within the markets exist. Another way to state this is that capital markets are in equilibrium. Capital market line. One of the offshoots of the CAP is the capital market line, CMO. The CMO provides an expected return based on the total level of risk as measured by the standard deviation. The equation for the CMO uses the expected return of the portfolio, risk-free rate, return on the market, standard deviation of the market, and standard deviation of the portfolio. Take note. Note that the CMO, like Markowitz's efficient frontier, uses standard deviation as the measure of risk. Test topic alert. Please note that alpha and beta are not used in the CMO equation, while standard deviation is used. Efficient portfolios/efficient frontier. The goal of modern portfolio theory is to construct the most efficient portfolio. One selects the efficient set from the feasible set. The feasible set of portfolios represents all portfolios that can be constructed from a given set of equities. An efficient portfolio is one that offers the most return for a given amount of risk, or the least risk for a given amount of return. The collection of efficient portfolios is called the efficient set or efficient frontier. The universe of these portfolios is in turn plotted on a risk-return parabola known as the efficient frontier. Specifically, this curve represents that set of portfolios that has the maximum rate of return for every given level of risk. The objective is for the portfolio to lie on the curve. Then, by being on the efficient frontier, the optimal portfolio has been created. Any portfolio that is below the curve, not an efficient one, is said to be taking too much risk for too little return. A portfolio above the efficient frontier is impossible. In pictorial terms, the efficient frontier is depicted as follows. A scatter plot chart with the horizontal axis measuring risk and the vertical axis measuring expected return. There are many points representing portfolios which are bounded by an upward sloping curve with the slope flattening as risk increases. Portfolio A is on the low risk end of the graph and lies on the boundary. Portfolio B is also on the boundary, but with higher risk and return than Portfolio A. Portfolio C is under the boundary and has the same expected return as A and the same risk as B. Portfolio D is above the boundary. Every portfolio residing on the efficient frontier has either a higher rate of return for equal risk or lower risk for an equal rate of return than another portfolio below, underneath the frontier. For example, in the previous graphic, portfolios A and B are both equally efficient and are more efficient than Portfolio C because 1. Portfolio A has an equal expected rate of return as Portfolio C, but with a significantly lower level of assumed risk, and 2. Portfolio B has an equal level of assumed risk as Portfolio C, but with a significantly higher expected rate of return. Therefore, Portfolio C is inefficient. It is attainable, but not optimal. Portfolio B is unattainable because it resides above the efficient frontier. As the graphic indicates, the expected rate of return is unattainable because it is located outside the universe of available portfolios. In the figure, portfolios A and B are both efficient, but Portfolio C is not. Practice question. According to modern portfolio theory, the optimal portfolio is one that A. lies above the efficient frontier. B. lies below the efficient frontier. C. lies on the efficient frontier. D provides the lowest return for the highest risk. The answer is C. The efficient frontier is a curve representing the amount of return for a specified risk. Portfolios residing on that curve provide the highest return for that level of risk and are considered optimal or efficient portfolios. A portfolio below the efficient frontier is inefficient, and a portfolio cannot lie above the curve. Learning Objective 21H. Calculate the expected return using the security market line. The CNL provides an expected return for a portfolio based on the expected return of the market, the risk-free rate of return, and the standard deviation of the portfolio in relation to the standard deviation of the market. The CNL is generally used to evaluate diversified portfolios. The security market line, SNO, which is derived from the CNO, allows us to evaluate individual securities for use in a diversified portfolio based on the expected return for the asset, the risk-free rate, the return on the market, and the beta of the asset. The security market line determines the expected return for a security on the basis of its beta and the expectations about the market and the risk-free rate. Basically, we want to determine how much over the risk-free rate we should earn for taking the investment risk. You may be asked to compute the expected return using the SNL. It is done like this. We start by comparing the market's return to the RF rate, expecting it will be higher because of the risk. Then we multiply that difference by the stock's beta and add that number to the RF rate. Here is the formula. Return of the market minus the risk-free rate times beta plus RF rate. It is much easier to follow with the numbers. Example. If the beta of ABC company is 1.2 and the market return is expected to be 13% with a risk-free return of 3%, then the expected return of ABC is 15% as follows. Let's follow the formula we just showed you. We begin with the difference between the risk-free rate and market rate. 13% minus 3 equals 10%. Then we multiply the expected return in excess of the RF rate by the stock's beta. 10% times 1.2 equals 12%. Finally, we add the RF rate, 3%, to the 12% and arrive at 15%. Therefore, on the basis of the level of systematic risk of ABC company, it should earn a return of 15%. The SNL helps identify how the characteristics of a portfolio will be impacted when a security is added to the portfolio. You should note that the SNL accounts for the impact of systematic risk, as measured by beta, only and does not take into consideration unsystematic risk, which is assumed to have been diversified away. Test topic alert. The CNL measures the risk through standard deviation, total risk. The SML measures the risk through beta, systematic risk only. Learning Objective 21I. Identify the three forms of the efficient market hypothesis. The efficient market hypothesis, EMH, maintains that security prices adjust rapidly to new information, with security prices fully reflecting all available information. In other words, markets are efficiently priced as a result. This is sometimes referred to as the random walk theory. The random walk theory would suggest that throwing darts at the stock listings is as good a method as any for selecting stocks for investment. Eugene F. Fama, professor at the University of Chicago, coined the term in a 1965 Financial Analyst Journal article entitled Random Walks in Stock Market Prices. There are three versions of the EMH based upon the level of available information. The more information available, the more likely it is that you should be able to beat the market. But, as we will see, under this theory the conclusion is that under all circumstances, there is no way to accurately predict stock prices, and a passive strategy is probably the most suitable for investment success. Weak form market efficiency. The weak form holds that current stock prices have already incorporated all historical market data, and that historical price trends are, therefore, of no value in predicting future price changes. Although fundamental analysis and insider information may produce above-market returns under the weak form, technical analysis is of no value. Indeed, none of the forms of EMH attributes any value to technical analysis. Semi-strong form market efficiency. The semi-strong form holds that current stock prices not only reflect all historical price data, but also reflect data from analyzing financial statements, industry, or current economic outlook. Thus, even fundamental analysis is of no value in this form, and only insider information may produce above-market returns. Technical analysis is also of no value. Strong form market efficiency. The strong form of the EMH states that security prices fully reflect all information from both public and private sources. The strong form includes all types of information: past security market, public and private, inside information. This means that no group of investors has monopolistic access to information relevant to the formation of prices, and none should be able to consistently achieve positive abnormal returns. Although some would disagree, the prevailing opinion is that the only thing that will work in this case is the random walk just throwing darts, because the market is totally efficient, with market prices quickly adjusting to reflect new information. Take note. According to the EMH, if a financial market is weakly efficient, technical analysis will be useless, but it is still possible to use fundamental analysis to seek out mispriced investments. On the other hand, if a financial market is semi-strongly efficient, There is no point in using any fundamental analysis tools. All of that information is already in the hands of all investors. If a financial market is strongly efficient, then everything, including information generally only available to insiders, is known and, without an edge, there is no benefit to be gained by using any analytical tools. Take note. As a base-level knowledge of the EMH, you should know that the weak form is based on past security market information. The semi-strong form is based on all public information, including market information, and the strong form is based on both public information and inside or private information. The following chart may help you with EMH. The three forms of EMH. Form weak, won't work, technical analysis, will work, fundamental analysis and insider information. Form semi-strong, won't work, technical and fundamental analysis, will work, insider information. Form strong, won't work, technical and fundamental analysis and insider information, will work, random walk. Test topic alert. You may have to know that there is no such term as semi-weak EMH. We can't imagine what would be weaker than weak anyway. Practice question. Followers of the efficient market hypothesis believe that A. Following the business cycle is the best way to maximize returns. B. Concentration, rather than diversification, will produce superior returns. C. By following the pundits on TV, you'll wind up rich. D. An efficient market is one that produces random results. The answer is D. EMH is really just an extension of the random walk theory, which states that throwing darts at the stock market page is as good as any way to select investments. If the market is truly efficient, no one has an edge. Knowledge Check 21.4. Question 1. The Capital Asset Pricing Model, Kaplan, is a securities market investment theory, allowing the investor to determine an asset's expected rate of return, a form of risk-adjusted return encapsulating how much risk the investor should assume to obtain a particular return from an investment. The theory includes a number of assumptions. Which of the following is not one of those assumptions? A. All investors can borrow or lend money at the risk-free rate of return. B. The time horizon is equal for all investors. C. There are no transaction costs or personal income taxes other than those on capital gains. D. There is no inflation. The correct answer is C. The Kaplan assumes no personal income taxes at all, not on dividends or capital gains. Question 2. If the beta of KMS company is 0.7 and the market return is expected to be 20% with a risk-free return of 2%, then, using the SNO, the expected return of ABC is A. 14.0%, B. 14.6%, C. 17.4%, D. 25.7%. The correct answer is B. Using the formula we showed you, we begin with the difference between the risk-free rate and market rate. 20% minus 2% equals 18%. Then we multiply the expected return in excess of the RF rate by the stock's beta. 18% times 0.7 equals 12.6%. Finally, we add the RF rate, 2%, to the 12.6% and arrive at 14.6%. The choice of 14% would be correct if we did not have the RF rate given in the question. The choice of 25.7% is immediately discarded because, with a beta below 1, the expected return cannot be higher than the market return. Question 3. Which form of the efficient market hypothesis, EMH, states that excess returns cannot be obtained using technical analysis? A. Semi-strong form. B. Strong form. C. Weak form. D. All of these. The correct answer is C. The weak form of EMH assumes that current stock prices fully reflect all currently available public information, such as prices and volume. Because those are already figured into the stock's price, the EMH concludes that excess returns cannot be achieved using technical analysis, price, and volume charts. Lesson 21.5. Averaging and Hedging Techniques. Learning Objective 21J. Illustrate how dollar-cost averaging results in lowering an investor's average cost per share. One common fear of investors is buying at the top of the market. One can never know when a bull market will reverse its course. Conversely, we all want to get in at the bottom. But how do you know when the bear market is over? Because no one knows all of the answers, one popular technique is time-based investing to average your cost. The most tested time-based investment program used by investors is dollar cost averaging. Investors use dollar cost averaging as a means to invest consistent amounts of money in a mutual fund or stock at regular periodic intervals, such as monthly or quarterly. This form of investing allows the individual to purchase more shares when prices are low and fewer shares when prices are high. This has the effect of reducing timing risk, the risk that all of your money will be invested at a market top. In a fluctuating market, the average cost per share is lower than the average price per share. Example. The following table illustrates how average price and average cost may vary with dollar cost averaging. Month January. Amount invested, $600. Price per share, $20. Number of shares, 30. Month February. Amount invested, $600. Price per share, $24. Number of shares, 25. Month March. Amount invested, $600. Price per share, $30. Number of shares, 20. Month April. Amount invested, $600. Price per share, $40. Number of shares, 15. Total amount invested, $2,400. Price per share, $114. Number of shares, 90. The average cost per share equals $2,400. The total investment, divided by 90. The total number of shares purchased, or $26.67 per share, whereas the average price per share is $28.50, $114 divided by 4. With any market fluctuations, this strategy will produce a lower cost, $26.67, than average price, $28.50. This average cost of $26.67, not the average price paid of $28.50, is the investor's cost basis when the shares are subsequently sold. Test topic alert. Although it is unlikely that you will have to compute the average price or average cost per share, a question may ask the purpose of dollar cost averaging. The purpose of dollar cost averaging is to reduce the investor's average cost to acquire a security over the buying period relative to its average price. Learning Objective 21K. Describe the use of put and call options to hedge positions. Hedging strategies. The final strategy discussed in this unit is using options to hedge a position. In the real world, these are very popular tools to limit risk, and the exam usually contains one question on their use. An investor with a long position in a stock, she owns it, can use options to hedge the position's risks. Remember the term hedge, used in this context, means to protect. Long stock and long puts. What if the investor is concerned about a potential drop in the price of her stock? An investor who owns a stock can protect against a decline in market value by buying a put. Doing so allows the investor to sell the stock by exercising the put if the stock price declines before expiration, which will offset the decline in the stock price. This strategy is called portfolio insurance, or the purchase of a protected put. Any profits in the stock are offset by the cost of the put premiums. Example. A concerned, afraid investor who owns 100 shares of stock with a current market value of $50 purchases a 50 put at $2.50 for protection. If the stock goes down to $40 per share, the investor has the ability to exercise the put, deliver the stock, and receive $50 per share. The only cost for this protection is the premium of $2.50 paid for the put. So instead of losing $1,000, the loss was held to only $250. Test topic alert. This strategy is also useful for managers of large portfolios, such as pension funds. If the portfolio consisted of large-cap stocks, a way to hedge against a down market would be to purchase put options on an index that mirrors the portfolio. In the case of large-cap stocks, that would generally be the S&P 500 index. More about that in Unit 22. Long stock and short calls, covered call writing. A covered call is a call written, sold, on a stock an investor owns. The covered call writer reduces the risk of that long stock position and generates income with the dollars received in premiums from selling the call. If the call is not exercised, the call writer keeps the premium. If the call is exercised, the covered call writer can deliver the stock owned. The covered call writer limits potential gain in exchange for the partial protection against a loss. Partial protection. By writing a covered call and receiving the premium, an investor, in effect, reduces the stock cost by the premium amount. If the stock price falls below the purchase price minus the premium received, the investor incurs a loss. Should the stock price rise dramatically, the stock will likely be called. Example: an investor buys 100 shares of RST at 53 and writes one RST 55 call for 2. The premium offsets the stock price by the $2 per share premium received. The maximum gain equals $400. If the stock price rises above 55, the call will be exercised. Thus, the investor will sell the stock for a gain of $200, in addition to the $200 premium received. The $200 premium initially received lowers the true cost of the stock to $51 per share, so the investor is protected against loss for the first 2 points of market decline. The maximum loss is $5,100 instead of $5,300 should the stock become worthless. Take note: a covered call provides partial protection that generates income but reduces the stock's potential gain. Buying puts provides nearly total loss protection that costs money yet does not reduce the stock position's potential gain. The benefit of the covered call is that it does offer some hedging with no cost. In fact, the investor actually receives income in the form of the premium. Short stock and long calls. An investor who sells a stock short sells borrowed stock, expecting the price to decline. The short seller must buy stock to repay the stock loan and hopes to do so at a lower price. A short seller can buy calls to protect against a price rise. If you are not familiar with the concept of short selling, it will be covered in Unit 23. Example: an investor sells short 100 shares of RST at 58 and buys an RST 60 call for 3. The maximum loss is no longer unlimited as it would normally be for a short sale. Instead, it is $500. No matter how high the stock price rises above $60, the investor will exercise the call to buy the stock for $60, incurring a $200 loss on the short sale in addition to the $300 paid for the call. Test topic alert. The majority of our students report a question on protecting against loss on a short sale. As shown above, the best way to hedge is to buy a call option on the stock underlying the short sale. This strategy offers full protection against loss. Please notice that in protecting the long or short position, the investor buys an option. It is useful to remember that you buy protection, you don't sell it. The same logic is true with futures contracts. The way to hedge is to buy. That creates what is called a long hedge. Knowledge Check 21.5. Question 1. An investor has set up an automatic bank draft to purchase $200 of the KEPCO balanced fund every month. Over the past 5 months, per share prices when the purchases were executed were $10, $12, $15, $14, and $11. Using this dollar cost averaging program resulted in an average cost per share of $82. B. $12.13. C. $12.40. D. $82.47. The correct answer is B. For the 5 months, the investor purchased a total of 82,468 shares. This is calculated by taking the $200 investment and dividing it by the cost per share for each transaction. In sequence, those purchases were 20 shares, 16.667 shares, 13.333 shares, 14.286 shares, and 18.182 shares. To find the average cost per share, we divide the total investment, 1,000, by the total number of shares, 82.468, and the result is approximately $12.13. If you take the 5 purchase prices and find the average, it is $12.40. That is the average price paid per transaction, not per share dollar. Cost averaging saved this investor about 27 cents per share. 2. An investor owns 100 shares of Lockstone Pipeline Incorporated, LPI, and is concerned that the stock's price has downside volatility. Without a cash outlay, this investor could partially hedge the position by A. Buying an LPI call, B. Buying an LPI put, C. Selling an LPI put, D. Selling an LPI call. The correct answer is D. The only possible answers are the option writers. Buying an option requires a cash outlay, while selling one brings in cash premium. When an investor is long a stock, the partial hedge position is the short call. When one is short the stock, the partial hedge is the short put. Remember, hedging means taking an opposite position. When you are long a stock, you are bullish, while writing a call is bearishly neutral.
Unit 22. Performance Measures. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 22A. Calculate the investment return measurements most commonly found on the exam. Learning Objective 22B. Match the appropriate benchmarks for various portfolios. Your exam will include approximately 4 questions from the topics covered in Unit 22. Introduction. Ultimately, the judge of the value of an investment advisor is the performance of the client's account. There are a number of different ways to measure the performance, and one must always keep in mind that it is how well the account meets the investor's objectives that counts. For example, an account that appreciated 10% in 1 year while distributing an income return of 1% is not meeting the goals of a client needing current income. Lesson 22.1 Investment Return Measurements. Learning Objective 22A. Calculate the investment return measurements most commonly found on the exam. There will probably be 2 computations on your exam dealing with different types of returns. We'll cover all of them and indicate which are the most and least likely to appear on your test. Take note. As you review these quantitative evaluation measurements, know that the exam is more concerned with the ability to identify what they measure than how to perform the calculation. 1 or 2 questions might require a relatively simple calculation on current yield, after-tax return/yield, inflation-adjusted return, or total return. Total return. Total return includes the income from dividends or interest plus any capital appreciation or less any capital depreciation over a given time period, usually 1 year. As such, total return is considered to be the best measure of how a security has performed for an investor. Example. A common stock purchased for $20 with an annual dividend of $1 is sold after 1 year for $24. The total return on the investment is $5. $1 in dividends plus $4 in capital appreciation. The total return, then, is 25%. $5 divided by $20 equals 25%. Test topic alert. The exam may require you to know how to calculate total return. Keep in mind that the total annual return on an investment includes income and capital appreciation. In the case of bonds held to maturity, this is the YTM. Otherwise, it is the coupon income plus any appreciation or less any price depreciation. In the case of stocks, one would use the dividend income plus or minus the appreciation or depreciation. Mutual fund returns. Unlike other securities, an investor's total return from a mutual fund investment may include, in addition to income distributions in the form of dividends, distribution of realized capital gains. They are all added together, along with unrealized appreciation, or mutual funds must separate their total return from their current return. The SEC requires that current return calculations be based only on income distributions for the past 12 months divided by the current per-share price. Annual dividend divided by current price equals current yield. Practice question. The KEPCO Income Fund has a current public offering price of $10.50 and a net asset value per share of $10. During the past 12 months, the fund has made 4 quarterly distributions from net investment income of 15 cents and 1 distribution from capital gains in the amount of 25 cents. What would the fund's current yield be? A. 1.5%. B. 5.7%. C. 6.0%. D. 1.1%. The answer is B. It is computed by dividing the annual income, 4 times 15 cents equals 60 cents, by the POP, not the NAV, of $10.50. Only the dividends are used for current yield. Holding period return. The length of time an investor owns an investment is called the holding period. The return for that period is called the holding period return, HPR. HPR is the total return, income plus capital appreciation, of an investment over a specified period, the holding period. It is essentially the same as the total return, but whereas the total return is usually computed on an annual basis, the holding period return can be for any period. Example. An investment purchased for $100 and sold 3 years later for $120. $20 capital appreciation after paying a total of $30, $10 per year. In dividends has a holding period return of 50%, $120 plus $30 equals $150. The total gain is $150 minus $100 equals $50. A $50 return on a $100 investment is 50%. $50 divided by $100 equals 50%. Take note. Holding period return is not an annualized return. It is the percentage return over a defined period. Test topic alert. We tend to focus on looking at the total return and the holding period return for equities, but it is also a valid measurement for bond returns. In this case, we combine the interest received and any appreciation or depreciation. However, there is one other factor that is sometimes considered: the rate at which the coupons are reinvested. If we assume the bondholder will keep the bond until maturity date, in a period of rising interest rates, the bondholder should be able to reinvest the coupons at a higher rate than the current coupon, thus causing the holding period return to exceed the yield to maturity. If, on the other hand, interest rates are falling, the coupons will only be able to be reinvested at a lower rate, causing a holding period return that is less than the bond's ITM. Annualized return. Annualized return is the return an investor would have received had he held an investment for 1 year. Annualized return is determined by multiplying the actual return by an annualization factor. The annualization factor is the number of months in the year divided by the number of months an investment is held. Example: an investor receives $5 on a $100 investment held for 6 months. The annualized return is determined by multiplying the 5% return by the annualization factor of 2 to 12 months divided by 6 months equals 2, for an annualized return of 10%. Another investor has a capital gain of 30% from an investment held for 18 months. The annualized return is 20%, calculated as follows: 30 times 12 divided by 18 equals 20. Take note: the formula we've shown you is only approximate. The computation has never been asked on the exam. In reality, because of compounding, the annualized return would actually be a bit different. In the first example shown, it would be about 10.2% instead of 10%. In the second example, the 18-month holding period, it would be about 19.1% instead of 20%. Inflation-adjusted return, real return. Because inflation reduces the buying power of a dollar, investment performance measurements are often adjusted to provide a measure of the buying power earned from a given investment. Returns that have been adjusted for inflation are called real rates of return. This is a frequently required computation on the exam. To determine the inflation-adjusted rate of return of a debt security, reduce its nominal return by the inflation rate as reflected in the Consumer Price Index, CPI. To determine the inflation-adjusted rate of return of an equity security, reduce the total return, as taught above, by the inflation rate as reflected in the CPI. Example: a bond with an 8% coupon has a nominal return of 8%. If inflation, as measured by the CPI, is 3%, then the inflation-adjusted return of the bond investment is 8% minus 3%, or 5%. Example: let's revisit the total return example from a couple of pages ago. A common stock purchased for $20 with an annual dividend of $1 is sold after 1 year for $24. The total return on the investment is $5. $1 in dividends plus $4 in capital appreciation. The total return, then, is 25%. $5 divided by $20 equals 25%. If the question asked for the real rate of return and told you that the CPI increase for the period was 6%, you would subtract that from the 25% total return to arrive at an inflation-adjusted return of 19%. Example: for fixed income investors, inflation and taxes reduce the buying power of their dollars. For an investor in the 25% tax bracket in a 2.5% inflationary environment, an investment that yields 10% before taxes provides the investor with a 5% after-tax inflation-adjusted return. To calculate the 5% after-tax inflation-adjusted return, first determine the after-tax return. In this case, 10% less 25% for taxes results in a 7.5% after-tax return. The easiest way to compute the real rate of return is to reduce the return by the amount of inflation during the period. In this case, 7.5% less 2.5% inflation results in a 5% after-tax inflation-adjusted return. Even though a calculation of this type might not be on your exam, you need to understand the concept that your final returns are reduced by both taxes and inflation. Test topic alert. The exam will require you to know how to calculate the approximate inflation-adjusted return by merely subtracting the CPI from the total return. What we've shown you is only an approximation. The correct formula is the sum of 1 plus the nominal rate divided by the sum of 1 plus the inflation rate, which then is subtracted by 1. But we've never heard of that being asked on the exam. Calculating the return on a TIPS bond. We covered the basics of TIPS, Treasury Inflation Protected Securities, In Unit 2, you might have to compute the value of a TIPS bond after several years, or the amount of an interest payment. There are two key points to remember. Every 6 months, the principal value is adjusted by the change to the cost of living as measured by the CPI. Every 6 months, the semi-annual interest payment is calculated by multiplying 1/2 of the annual coupon times the adjusted principal. We'll show you the steps in an example, and then show you a shortcut that will always work on the exam. Example: if you have a TIPS bond with a 3% coupon and the annual inflation rate is 4% for the next 2 years, here is what happens. Each 6 months, you will receive 1.5%, half of the annual 3% coupon of the principal value as adjusted for the inflation rate. If the inflation rate is 4% per year, that is 2% each 6 months. So after the first semi-annual period, the principal value of the bond is now $1,020. $1,000 plus 2% of $1,000, or 102% times $1,000. Therefore, the first interest check will be 1.5% times $1,020, or $15.30. 6 months later, the adjusted principal value is $1,040.40, 102% times $1,020. So that interest check will be for $15.61, $1,040.40 times 1.5%. As we continue into the next year, the principal will increase to $1,061.21, $1,040.40 times 102%, and the interest check will be for $15.92. Because we're only looking at 2 years, the ending principal value will be $1,082.43 with the final interest check of $16.24. As you can see, both the income from the TIPS and its principal value are increasing at a compounded rate based upon inflation. We know that some of you may be mathematically challenged, so here is a shortcut that will always work. The key to the increased principal value of the TIPS is that the interest is compounding. But you don't have to do that. In this example, the inflation rate is 4%. Using just simple interest would mean that the principal would increase by $40, 4% of $1,000 per year. After 2 years, that would be $80, or a new principal amount of $1,080. However, we know that compounding will give us slightly more, so we choose the first number given in the answers that is above $1,080. The same trick can be used to determine the final interest payment. We take 1.5% of $1,080, $16.20, and look for an answer choice that is slightly higher. Test topic alert. Because of the built-in inflation adjustment, the real rate of return on a TIPS bond is always equal to the coupon rate. After-tax return yield. Capital gains and income are generally taxable. Thus, taxes reduce the return of an investment. The after-tax return, also known as the adjusted return, is determined by reducing the investment's return by the client's tax rate. Example: the after-tax return of an investment that yields 10% for an investor in the 25% tax bracket is calculated by multiplying the return by 1 minus 0.25, or 0.75. The investor retains 75% of the 10% yield for a 7.5% after-tax return. Likewise, an investment that returns 45% over 3 years provides an after-tax return of 33.75%, 0.75 times 45%. The importance of the after-tax return is realizing that any investor's return is going to be reduced by the effects of taxation, whether it is the favorable capital gains tax or the higher ordinary income rate. That is the beauty of programs such as the Roth IRA or Section 529 plan, where it is possible to have totally tax-free returns. Remember, even though the interest on a municipal bond may be tax-free, any capital gains are not. Probable return. Unlike historical or actual rates of return, probable returns are estimates of the likely returns an investment may yield. To determine the probable return of an investment, the advisor assigns a probability to each return that the investment is likely to earn and then multiplies that return by the probability of it occurring. The sum of those probable returns is the expected return for that investment. The formula is as follows: expected or probable return equals probability of return number 1 times possible return number 1, plus probability of return number 2 times possible return number 2. Example: the probable expected return of an investment with a 30% probability of returning 15% and a 70% chance of returning 10% has a total expected return of 11.5%, calculated as follows. 0.3 times 15% equals 4.5%, plus 0.7 times 10% equals 7.0%, or 4.5% plus 7.0% equals 11.5%. In effect, this return reflects the arithmetic mean return of the portfolio. When one constructs a portfolio, there are usually securities with different grades of risk and hence different expectations of reward. Investors view the portfolio as a whole, looking to maximize returns for each level of risk. This overall view, or mean, of the entire portfolio is the expected or probable return of the portfolio. Test topic alert. Don't be surprised to get a question similar to our example above, but with one of the possibilities being a negative. Suppose our example had said there was a 30% probability of returning 15%, a 40% chance of returning 10%, and a 30% chance of losing 8%. The expected return would be 0.3 times 15% equals 4.5%, plus 0.4 times 10% equals 4.0%, plus 0.3 times negative 8% equals negative 2.4%, for a total of 6.1% expected return. Risk-adjusted return, Sharpe ratio. Securities practitioners have developed many measures to quantify the risk characteristics of a portfolio. One such measure that may show up on the exam is called the Sharpe ratio. The ratio is calculated by subtracting the risk-free rate, for example, the 91-day Treasury bill rate, from the overall return of the portfolio. This result, which is the portfolio's risk premium, is then divided by the standard deviation of the portfolio. This ratio measures the amount of return per unit of risk taken. The higher the ratio, the better or more return per unit of risk taken. Test topic alert. The Sharpe ratio measures risk-adjusted return. The exam might state this as, the Sharpe ratio looks at the return compared to the risk. A high ratio means that the investor is getting more bang for the buck. That is, based on the risk taken, the return is higher than what would be expected. Test topic alert. You must know that the three components of the Sharpe ratio are the actual return minus the risk-free rate, the 91-day T-bill rate, divided by the standard deviation. Beta is not a part of this ratio. Practice question. Given the following information, calculate the risk-adjusted return. Actual return, 13.5%. 91-day T-bill rate, 1.5%. Beta equals 1.6. CPI, 4%. Standard deviation, 4. A, 2%. B, 3%. C, 4.8%. D, 15.2%. The answer is B. Any question asking about risk-adjusted return is going to be referring to the Sharpe ratio. This is shown as a simple number and is calculated by subtracting the risk-free rate, 91-day T-bill, from the actual return and dividing that remainder by the standard deviation. In this example, 13.5% minus 1.5% equals 12% divided by 4 equals 3%. As will often be the case on the exam, there is unnecessary information supplied in the question, beta and CPI. Risk premium. It should be clear that in order to have a positive Sharpe ratio, our actual return on an investment must exceed the risk-free return. Therefore, any investor would surely expect to achieve that higher return, or the investment would not be made. This return is known as the risk premium. The required rate of return on any investment is a combination of the risk-free rate plus a risk premium. For equity investments, the risk premium can be determined by using the capital asset pricing model, CAPM, discussed in Unit 21. Internal rate of return, IRR. IRR has been discussed previously in Unit 20. We're just going to list a few of the points that are important for the exam. IRR is the preferred method of measuring the return on a DPP. IRR takes into consideration the time value of money. And IRR is the way the yield to maturity of a bond is computed. Time-weighted returns. Although time-weighted returns and dollar-weighted returns are both methods of determining a rate of return, they have very different purposes. A time-weighted return is determined without regard to any subsequent cash flows of the investor. As such, it measures the performance of the investment over a period of time and not of the investor, as in a dollar-weighted approach. Most returns reported on mutual funds are time-weighted because the portfolio manager does not have any control over the future cash flows to the fund with respect to investor dollars. Dollar-weighted returns. In contrast, a dollar-weighted return considers subsequent contributions to and withdrawals from an investment, including sales of, for example, stock. As a result, the dollar-weighted approach focuses on the return of the investor, not the investment, as in the time-weighted approach, over a period of time and usually results in a rate of return different than the time-weighted method. Portfolio A. Period 0. Investor deposits or withdrawals $1,000. Beginning of period value $1,000. End of period value $1,200. Periodic rate of return 20.00%. Period 1. Investor deposits or withdrawals -$400. Beginning of period value $800. End of period value $700. Periodic rate of return -12.50%. Period 2. Investor deposits or withdrawals $300. Beginning of period value $1,000. End of period value $1,400. Periodic rate of return 40.00%. Period 3. Investor deposits or withdrawals -$200. Beginning of period value $1,200. End of period value $1,000. Periodic rate of return -16.67%. Period 4. Investor deposits or withdrawals -$1,000. DWR equals 8.2311%. TWR equals 5.2034%. Portfolio B. Period 0. Investor deposits or withdrawals $1,000. Beginning of period value $1,000. End of period value $1,200. Periodic rate of return 20.00%. Period 1. Investor deposits or withdrawals -$400. Beginning of period value $1,600. End of period value $1,400. Periodic rate of return -12.50%. Period 2. Investor deposits or withdrawals -$400. Beginning of period value $1,000. End of period value $1,400. Periodic rate of return 40.00%. Period 3. Investor deposits or withdrawals $400. Beginning of period value $1,800. End of period value $1,500. Periodic rate of return -16.67%. Period 4. Investor deposits or withdrawals -$1,500. DWR equals 2.0245%. TWR equals 5.2034%. Test topic alert. The dollar-weighted return reflects the internal rate of return, IRR. The time-weighted return does not. Practice question. If you wanted to evaluate the performance of a portfolio manager, you would calculate the portfolio's A. Dollar-weighted return, B. Holding period return, C. Portfolio return, D. Time-weighted return. The answer is D, because portfolio managers have no control over the deposits and withdrawals made by clients. The time-weighted return, choice D, is a more appropriate measure of performance. Risk premium. It should be clear that in order to have a positive Sharpe ratio, our actual return on an investment must exceed the risk-free return. Therefore, any investor would surely expect to achieve that higher return, or the investment would not be made. This return is known as the risk premium. The required rate of return on any investment is a combination of the risk-free rate plus a risk premium. For equity investments, the risk premium can be determined by using the capital asset pricing model, CAPM, discussed in Unit 21. Internal rate of return, IRR. IRR has been discussed previously in Unit 20. We're just going to list a few of the points that are important for the exam. IRR is the preferred method of measuring the return on a DPP. IRR takes into consideration the time value of money, and IRR is the way the yield to maturity of a bond is computed. Time-weighted returns. Although time-weighted returns and dollar-weighted returns are both methods of determining a rate of return, they have very different purposes. A time-weighted return is determined without regard to any subsequent cash flows of the investor. As such, it measures the performance of the investment over a period of time and not of the investor, as in a dollar-weighted approach. Most returns reported on mutual funds are time-weighted because the portfolio manager does not have any control over the future cash flows to the fund with respect to investor dollars. Dollar-weighted returns. In contrast, a dollar-weighted return considers subsequent contributions to and withdrawals from an investment, including sales of, for example, stock. As a result, the dollar-weighted approach focuses on the return of the investor, not the investment, as in the time-weighted approach, over a period of time and usually results in a rate of return different than the time-weighted method. Portfolio A. Period 0. Investor deposits or withdrawals $1,000. Beginning of period value $1,000. End of period value $1,200. Periodic rate of return 20.00%. Period 1. Investor deposits or withdrawals -$400. Beginning of period value $800. End of period value $700. Periodic rate of return -12.50%. Period 2. Investor deposits or withdrawals $300. Beginning of period value $1,000. End of period value $1,400. Periodic rate of return 40.00%. Period 3. Investor deposits or withdrawals -$200. Beginning of period value $1,200. End of period value $1,000. Periodic rate of return -16.67%. Period 4. Investor deposits or withdrawals -$1,000. DWR equals 8.2311%. TWR equals 5.2034%. Portfolio B. Period 0. Investor deposits or withdrawals $1,000. Beginning of period value $1,000. End of period value $1,200. Periodic rate of return 20.00%. Period 1. Investor deposits or withdrawals -$400. Beginning of period value $1,600. End of period value $1,400. Periodic rate of return -12.50%. Period 2. Investor deposits or withdrawals -$400. Beginning of period value $1,000. End of period value $1,400. Periodic rate of return 40.00%. Period 3. Investor deposits or withdrawals $400. Beginning of period value $1,800. End of period value $1,500. Periodic rate of return -16.67%. Period 4. Investor deposits or withdrawals -$1,500. DWR equals 2.0245%. TWR equals 5.2034%. Test topic alert. The dollar-weighted return reflects the internal rate of return, IRR. The time-weighted return does not. Practice question. If you wanted to evaluate the performance of a portfolio manager, you would calculate the portfolio's A. Dollar-weighted return, B. Holding period return, C. Portfolio return, D. Time-weighted return. The answer is D, because portfolio managers have no control over the deposits and withdrawals made by clients. The time-weighted return, choice D, is a more appropriate measure of performance. Lesson 22.2. Portfolio benchmarks. Learning Objective 22. B. Match the appropriate benchmarks for various portfolios. Tens of thousands of stocks trade in the stock markets. Stock indexes, such as the S&P 500 or the utility index, are smaller groups of stocks that serve as a benchmark for measuring the performance of the overall market or sectors of the market. Indexes are generally weighted for the capitalization, number of outstanding shares times the market price per share, of the companies included. Therefore, a large company's stock price changes will have a greater effect on the index. Indexes are often used as benchmark portfolios against which managed portfolios are measured in order to gauge the performance or added value of the fund manager. In addition, index mutual funds and ETFs will invest in the securities that compose an index to specifically mirror the index performance. Following is a listing of indexes or averages that may appear on the exam. Dow Jones Industrial Average. The best known of all of the market indexes are those published by Dow Jones and Company. There are probably two reasons why the Dow Jones Industrial Average, DAIA, is so well known? First, because the 30 industrial stocks are among the 30 best-known corporations in the world. And second, and some would say more important, because Dow Jones and Company also publishes the Wall Street Journal, the nation's leading financial newspaper. Because it is price-weighted, the Dow Jones is truly an average. Originally, it was computed by adding together the prices of one share for each of the 30 different companies and then dividing by 30. That had to be changed as soon as the first one of those 30 companies had a 2-for-1 stock split. Because a stock split will cause the market price of the stock to drop, that is, the average would be distorted by continuing to divide the 30 current market prices by 30. An adjustment had to be made to the 30, called the divisor. Over the years, stock splits and other distributions have caused the original divisor of 30 to be adjusted. There are 3 other Dow Jones averages: the 20 transportation companies, the 15 utilities, and the composite of all 65. On November 1, 1999, history was made when non-NYSE stocks were included in the DJIA for the first time. Added to the average were Microsoft and Intel, which are both listed on NASDAQ. Standard & Poor's 500. The composition of the Standard & Poor's 500, S&P 500 composite index includes 4 main groups of securities: 400 industrials, 20 transportation companies, 40 public utilities, and 40 financial institutions. The S&P 500 is a cap-weighted index using a base period of 1941 to 1943 equal to 10. Although most of the stocks in the S&P 500 are listed on the NYSE, many of the highest-priced issues, Alphabet, Google, Amazon, and Booking Holdings, Priceline, are traded on the NASDAQ stock market. New York Stock Exchange, NYSE Index. The NYSE publishes a composite index that covers all of the common stocks listed on the NYSE, more than 3,000 different companies. This index provides the most comprehensive measure of market activity on the NYSE. The NYSE index is cap-weighted, similar to the S&P 500, but the base is December 31, 1965, and the index for the base is 50. NASDAQ Composite Index. The over-the-counter market is represented by the NASDAQ Composite Index, which covers more than 3,000 over-the-counter companies. The NASDAQ Composite Index is calculated in a manner similar to those used for the S&P and NYSE indexes, with a base period of February 5, 1971, and an index number of 100. These indexes, their subgroups, and several other popular indexes are quoted daily in the Wall Street Journal. As with the others, except for the Dow Jones, this is also a cap-weighted index. Russell 2000 Index. The Russell 2000 Index measures the performance of the small-cap segment of the U.S. equity universe. It includes approximately 2,000 of the small securities, based upon their market capitalization, minimum market cap of $300 million. Like most of the others, it is market cap-weighted, with the median market cap being something approximating $600 million. EAFE. The EAFE, sometimes referred to as the MSCI EAFE, it was developed by Morgan Stanley Capital International, is an index of foreign stocks. The index is market capitalization weighted. The EAFE acronym stands for Europe, Australasia, and the Far East. The index includes a selection of stocks from 21 developed countries outside of the United States and Canada. The index has been calculated since the end of 1969, making it the oldest truly international stock index. It is probably the most common benchmark for foreign stock funds. Wilshire 5000. The Wilshire 5000 Total Market Index measures the performance of all U.S. equity securities with readily available price data. This is another market, or cap-weighted index, that when it was initially created in 1974, did contain approximately 5,000 issues. Now, as of December 31, 2021, the number was 3,687 issues. Test Topic Alert. If you were asked to identify the index that reflects the broadest coverage of the U.S. stock markets, it is the Wilshire 5000. Test Topic Alert. The exam will want you to know which index serves as the benchmark for which type of portfolio. Large Cap, S&P 500. Mid Cap, S&P 400. Small Cap, Russell 2000. International Stocks, EAFE. Knowledge Check 22.2. Question 1. Which of the following is a price-weighted average? A. Dow Jones Industrial Average. B. MSCI EAFE, C. Russell 2000, D. S&P 500. The correct answer is A. The only major benchmark that is price-weighted is the Dow Jones. All the others are market cap-weighted. Question 2. A mayor is the portfolio manager of a mutual fund concentrating on stocks with a market capitalization between $500 million and $1 billion. The benchmark that a mayor's performance is compared to is most likely A. The Dow Jones Industrial Average, B. The Russell 2000, C. The S&P 400, D. The S&P 500. The correct answer is B. A mayor's focus is on small-cap stocks. The benchmark index for those is the Russell 2000. The S&P 400 is the benchmark index for mid-cap stocks, and the S&P 500 is the benchmark index for large-cap stocks. The DJI is not generally thought of as a portfolio benchmark index.
Unit 23, Trading Securities. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 23A, Compare cash and margin accounts. Learning Objective 23B, Compute the margin account calculations. Learning Objective 23C, Contrast stock exchanges and the over-the-counter market. Learning Objective 23D, Identify the difference between functioning as a broker and acting as a dealer. Learning Objective 23E, Describe the costs of trading securities. Learning Objective 23F, Identify the features and uses of market, stop, and limit orders and short sales. Learning Objective 23G, Describe high-frequency trading, HFT, and dark pools. Your exam will include approximately 4 questions from the topics covered in Unit 23. Introduction. By this time in the course, you're probably itching to go out and try some of these great strategies and techniques and get active in the market. In this unit, we'll cover the first thing you have to do to decide what type of account you're going to open. Then, we'll discuss where the securities you wish to purchase or sell are traded. It isn't like you can visit your local Walmart and pick up a few hundred shares of stock. Nor can you go online to Amazon, and even if you have Prime, order some bonds and have them delivered in 2 business days. Lesson 23.1, Customer Accounts. Learning Objective 23A, Compare cash and margin accounts. Customers can open either cash accounts or margin accounts, depending on how they choose to pay for securities. In cash accounts, customers pay the full purchase price of securities by the transaction's settlement date. In margin accounts, customers may borrow part of a security's purchase price from the broker-dealer under terms set by Regulation T of the Federal Reserve Board, FRB. That power was given to the FRB in the Securities Exchange Act of 1934. Cash accounts. A cash account is the basic investment account, and anyone eligible to open an investment account can open one. In a cash account, a customer must pay in full for any securities purchased. Although, there are exceptions, as with almost everything in this course. For exam purposes, certain accounts may only be opened as cash accounts, including personal retirement accounts such as IRAs, corporate retirement accounts, custodial accounts such as Uniform Transfer to Minors Act accounts, UTMAs, and Coverdell ESAs. Margin accounts. Margin accounts allow customers to control investments for less money than they would need if they were to buy the securities outright, because a margin account allows a customer to borrow money for investing. The term margin refers to the minimum amount of cash or marginable securities a customer must deposit to buy securities. Margin also is a potential source of cash. If a customer has fully paid securities in an account and needs cash, a broker-dealer is permitted to lend money against those securities up to the margin limit that the FRB has set. Customers who open margin accounts must meet certain minimal suitability requirements. The customer may then buy securities on margin and pay interest on the borrowed funds. The securities purchased are held in street name as collateral for the margin loan. When buying on margin, investors are using financial leverage, that is, they are increasing the potential for gain, and for loss as well, by using borrowed funds. Leveraging can be beneficial when the security is moving up, but it can result in a loss greater than the original investment if the security goes against the investor. Marginable securities. In addition to prescribing the loan value of securities, Regulation T also identifies which securities are eligible for purchase on margin, and which may be used as collateral for loans for other purchases. These are known as marginable securities. The following should be helpful. Securities that may be purchased on margin/used as collateral. Exchange-listed stocks and bonds. Stocks traded on the Nasdaq stock market. Warrants traded on either of the above. Securities that cannot be purchased on margin/used as collateral. Options, puts and calls, leaps are an exception, but that is unlikely to be tested. Stock rights, preemptive, and insurance contracts. For example, variable annuities and variable life. Securities that cannot be purchased on margin, but may be used as margin collateral once owned at least 30 days. Mutual funds and new issues. Finally, although they are exempt from Regulation T, the self-regulatory organizations, primarily FINRA, have established margin requirements for government and municipal securities. That means that they can also be purchased on margin and have value as collateral. Documenting a margin account. Opening a margin account requires more documentation than opening a regular cash account. The customer signs a margin agreement, which includes the required credit agreement, the hypothecation agreement, and an optional loan consent. Under NASA policies, it is an unethical business practice to execute any transaction in a margin account without securing from the customer a properly executed written margin agreement promptly after the initial transaction in the account. Margin account agreements, credit agreement, hypothecation agreement, and loan consent, optional. Discloses the terms under which credit is extended, including the use of the client's securities as collateral for the margin loan. SEC Rule 10b-16 requires firms to disclose the method of computing interest and the conditions under which interest rates and charges will be changed. Firms must send customers an assurance that statements accounting for interest charges will be sent with the same frequency that interest is charged, monthly or quarterly. Gives the firm permission to pledge, hypothecate, securities held on margin to a lending institution. It is a mandatory part of a margin agreement. Gives the firm permission to lend securities held in the margin account to other brokers, usually for short sales. It is not mandatory for customers to sign the loan consent agreement. Take note. Although NASA does not have FINRA rules, which most states view as practices to be followed by broker-dealers under their jurisdiction, do have a risk disclosure requirement for margin accounts. As part of opening a margin account, the broker-dealer must provide customers with a risk disclosure document. Unlike the promptly after the initial trade requirement that NASA has for its required documentation, FINRA requires this document to be delivered prior to or at the time of opening the account. This information must also be provided to margin customers on an annual basis. The document discusses the risks associated with margin trading, some of which are listed below. You can lose more funds than you deposit in the margin account. The firm can force the sale of securities or other assets in your accounts, and do so without contacting you. You are not entitled to choose which securities can be sold if a call for additional funds is not met. You are not entitled to an extension of time to meet a margin call. The firm can increase its house maintenance margin requirements at any time and is not required to provide advance written notice to the client. Take note. One of the agreements described above is the hypothecation agreement. In order to finance the loan that the broker-dealer makes to the client, the firm takes the newly purchased security and hypothecates, pledges, it to a bank to collateralize a loan made by the bank to the BD. The broker call loan rate is the interest rate banks charge broker-dealers on money they borrow to lend to margin account customers. The broker call loan rate is also known as the call loan rate or call money rate. The broker call loan rate usually is slightly higher than other short-term rates. Broker call loans are callable on 24-hour notice. Invariably, call loan appears on the exam as one of the incorrect choices. Learning Objective 23b. Compute the margin account calculations. The term margin call is properly defined as the initial call for funds when making a margin transaction. For example, with the margin requirements of the Federal Reserve Board's Regulation T at 50%, as they have been since 1974, a purchase of $12,000 of stock will result in a margin call of $6,000. The broker-dealer lends the client the other $6,000, creating a debit balance in the account. The equity in the account is 50%, and the client's debt is the other 50%. Maintenance. The self-regulatory organizations, SROs, for example FINRA, and the NYSE, rather than the Fed through Regulation T, have established minimum levels of equity in a margin account below which a call will go out for additional funds. This is properly referred to as margin maintenance or a maintenance call. Current SRO levels are 25% for long margin accounts. For example, if in the above purchase the stock's price were to drop to $8,000, there would only be $2,000 of equity in the account. Market value of $8,000 minus debit balance of $6,000 equals $2,000. At this point, the equity represents 25% of the current market value, $2,000 divided by $8,000. If the stock should drop any further, a maintenance margin call would be sent with a request for immediate funds. You will not have to do any of these computations, but you will need to know the term. If the maintenance call is not met, the broker-dealer will liquidate enough securities in the account to bring the equity back to the maintenance level. If there is more than one security in the account, the firm can select which to sell. It does not have to be one whose decline triggered the call. House maintenance. This is the term used to describe stricter limits imposed by the broker-dealers themselves. Typically, instead of relying on the SRO maintenance level of 25%, the individual firm may require a minimum of 35% or even higher. Take note. This should help you remember the three terms we just discussed. Margin call, set by the Federal Reserve Board under Regulation T. This is the initial deposit required when purchasing securities on margin. The broker-dealer lends the balance of the purchase price. For most equity securities, the initial margin requirement is 50% of the purchase price. Minimum maintenance, set by the SROs. This is the minimum equity that must be maintained in a margin account. Should the equity fall below the minimum required, a maintenance call, sometimes called maintenance margin, will go out demanding an immediate deposit of enough equity to bring the account above the required level. Currently, the minimum maintenance level for long positions is 25%. House maintenance, set by the individual broker-dealer firm as a cushion, and to reduce the possible sellout caused by failure to meet a maintenance call, most firms set a minimum equity level above the SRO minimum. A common house requirement is 35%. Falling below triggers a house call. None of these numbers will be tested, only the concepts. Mixed margin account. Later in this unit, we'll describe the short sale. Short sales must take place in a margin account. When the margin account contains both long and short positions, it is said to be a mixed margin account. Computing the equity, sometimes called net equity, in one of these accounts is done by calculating the equity for both the longs and shorts and then combining them. In a long account, the equity is what you own minus what you owe. That would be the current market value of the long stock minus the debit balance. In the case of the short position, it is basically the same, except the terms are different. What you owe in a short position is the cost to buy back the stock you borrowed. What you own is the credit balance representing what you received when you sold the stock in the first place. So the equity in a short account is the credit balance minus the current market value of the short stock. Perhaps the following will make it a bit easier. CMV long minus debit balance equals long equity. Credit balance minus CMV short equals short equity. We have two positive numbers, the stock we own and the credit balance. You know that when you get a bill and there is a credit balance, it means they owe you money that's yours. On the other side, we have two negative numbers. The cost to buy back the stock we're short and the debit balance. If we add the two positives and then subtract the two negatives, we've got our net equity. Example. A client's mixed margin account shows the following information. The current market value of the long positions is $50,000, while the current market value of the short positions is $25,000. There is a debit balance of $20,000 and a credit balance of $40,000. What is the combined or net equity in the account? Find the equity in each account, long, $50,000 minus $20,000 equals $30,000 and short. $40,000 minus $25,000 equals $15,000, so the total is $45,000. Or take the two positive numbers, $50,000 plus $40,000, which equal $90,000, and subtract the two negative numbers, $20,000 plus $25,000, which equal $45,000, and yield the same, $45,000. Positive negative margin. The term positive margin simply means that your returns are higher than the cost of the borrowed money to carry the positions in a margin account. For example, if you buy $10,000 of stock on 50% margin, you will be borrowing $5,000 of that purchase price from the broker-dealer. If over the holding period you pay $400 in interest and sell the stock for $11,000, you made a profit of $1,000 against the cost of $400 for net winnings of $600. That would be considered positive margin. If, however, you sold the stock for $10,300, your interest cost would have exceeded the profit by $100, and that would be considered negative margin. There is one more fact we need to cover about margin accounts. Margin interest is a tax-deductible expense. The one exception is interest expense incurred in the purchase of municipal securities. Because municipal interest income is federally tax-exempt, the IRS does not allow taxpayers to deduct the margin interest expenses for municipal securities. Investors can deduct interest expenses incurred when borrowing money to purchase other securities to the extent those interest expenses do not exceed their portfolio income, which includes interest income, dividends, and all capital gains. Knowledge Check 23.1. Question 1. Certain documentation is required to open a margin account. Which of the following is optional? A. The credit agreement. B. The hypothecation agreement. C. The loan consent agreement. D. The risk disclosure document. The correct answer is C. The loan consent agreement is optional. Investors need to sign the credit and hypothecation agreements, and the BD must furnish the risk disclosure document. Question 2. When dealing with margin accounts, there are generally 3 different percentages involved: the initial margin, the house requirement, and the maintenance level. Rank those 3 from the highest to the lowest percentage. A. Initial margin, maintenance margin, house maintenance. B. Initial margin, house maintenance, maintenance margin. C. House maintenance, maintenance margin, initial margin. D. Maintenance margin, initial margin, house maintenance. The correct answer is B. Initial margin, 50%, is the highest, and maintenance margin, 25%, is the lowest. House maintenance is whatever the broker-dealer sets, but is most often 30% or 35%. Lesson 23.2. Types of securities markets. Learning Objective 23C. Contrast stock exchanges and the over-the-counter market. Securities markets. There are 2 terms used to describe the market for securities. The primary market is the market in which the proceeds of sales go to the issuer of the securities sold. The secondary market is where previously issued securities are bought and sold. This unit will focus on secondary market trading. After the initial offering, many stocks and bonds are bought and sold on exchanges in a 2-way auction process. The major exchanges include the New York Stock Exchange, NYSE, NYSE American LLC, formerly known as the American Stock Exchange, MXC, the Chicago Board Options Exchange, CBOE, and the NASDAQ stock market. Other trades take place in the nationwide network of broker-dealers known as the over-the-counter OTC market. Exchange market. The exchange market is composed of the NYSE and other exchanges on which listed securities are traded. Listed security refers to any security listed for trading on an exchange. Each stock exchange requires corporations to meet certain criteria before it will allow their stock to be listed for trading on the exchange. In order to operate in the United States, an exchange must be registered with the Securities and Exchange Commission, as called for in the Securities Exchange Act of 1934. Under that act, the SEC has many powers, including enforcement of the laws. 2 specific actions that the SEC can take that might be tested are: to suspend trading in any non-exempt security for up to 10 days without prior notice, and to suspend trading on an entire exchange for up to 90 days. In order to do this, the SEC must give prior notification to the President of the United States. Location. Most stock exchanges, such as the NYSE, maintain central marketplaces and trading floors. Some, such as the NASDAQ stock market, are strictly electronic markets. As of the date of this printing, there are 21 exchanges registered as national stock exchanges with the SEC. At one time, there were a number of regional stock exchanges, but they have either been closed or merged into the national ones. Pricing system. Historically, listed markets operated as auction markets. Floor brokers competed to execute trades at the most favorable prices. That process still exists on some exchanges. Specialist. The specialist maintains an orderly market and provides price continuity. He fills limit and market orders for the public and trades for his own account to either stabilize or facilitate trading when imbalances in supply and demand occur. The specialist's chief function is to maintain a fair and orderly market in the stocks for which he is responsible. An additional function is to minimize price disparities that may occur at the opening of daily trading. He does this by buying or selling as a dealer stock from his own inventory only when a need for such intervention exists. Otherwise, the specialist lets public supply and demand set the stock's price. Take note. The term specialist has been replaced with designated market maker, DMM, but it is possible to still see specialists on your exam. Over-the-counter OTC market. The OTC market functions as an interdealer market in which unlisted securities, that is, securities not listed on any exchange, trade. In the OTC market, securities dealers across the country are connected by computer and telephone. Thousands of securities are traded OTC, including stocks, corporate bonds, and all municipal and U.S. government securities. One of the best known of the OTC markets are those operated by the OTC Markets Group. An example of them is the pink market, which for many years was known as the pink sheets because the quotes were printed on pink-colored paper. These tend to include those stocks that are thinly traded, little trading activity, with higher than normal spreads. Location. No central marketplace facilitates OTC trading. Trading takes place over the phone, over computer networks, and in trading rooms across the country. Pricing system. The OTC market is an interdealer network. Registered market makers compete to post the best bid and ask prices. The OTC market is a negotiated market. Market makers. Market makers are broker-dealers who stand ready to buy and sell at least the minimum trading unit, usually 100 shares or any larger amount they have indicated, in each stock in which they have published bid and ask quotes. Market makers acting in a dealer principal capacity sell from their inventory at their asking price and buy for their inventory at the bid price. Take note. The differences between the OTC and NYSE markets are summarized below. OTC, securities prices determined through negotiation. NYSE, securities prices determined through auction bidding. OTC, FINRA is the SRO regulator. NYSE is the SRO regulator. OTC, traded at many locations across the country. NYSE, traded on the NYSE floor on Wall Street. Exchange, listed securities equals prices determined by an auction. OTC, unlisted securities equals prices determined by negotiation. Government and municipal bonds and unlisted corporate stocks and bonds trade in the OTC market. Knowledge Check 23.2. Question 1. Which of the following has the power to close a stock exchange for up to 90 days? A. The Securities and Exchange Commission. B. The President of the United States. C. The governing board of that stock exchange. D. The administrator in the state where that stock exchange is located. The correct answer is A. The Securities Exchange Act of 1934 granted the SEC the power to close any registered stock exchange for up to 90 days. All that is required is notice to the President of the United States. Question 2. Which of the following is the most accurate statement regarding pricing systems on U.S. securities markets? A. Supply and demand determines prices on all markets. B. Exchanges are auction markets, while the OTC markets are negotiated markets. C. Exchanges are negotiated markets, while the OTC markets are auction markets. D. Exchanges and the OTC markets are both auction markets. The correct answer is B. Be careful. Prices of securities are determined by supply and demand, but the question wants to know what system is used to measure that supply and demand. On the exchanges, the pricing system is by auction, while in the OTC markets, the pricing system used is negotiation. Lesson 23.3. Brokers and dealers and their costs. Learning Objective 23D. Identify the difference between functioning as a broker and acting as a dealer. Most securities firms act as both brokers and dealers, but never in the same transaction. Let's examine the differences between these two terms. Dual capacity of a broker-dealer. Brokers. When a broker-dealer acts in the capacity of a broker, it is said to be acting in an agency capacity. That is, the firm represents clients who wish to buy a security by finding a seller or finding a buyer for those clients with a security to sell. For this service, they charge a commission. Brokers do not buy shares for inventory but facilitate trades between buyers and sellers. Dealers. When a broker-dealer acts in the capacity of a dealer, it is said to be acting as a principal in the trade. Just as with any transaction, there are always two principals, the buyer and the seller. Dealers, acting as principals, buy and sell securities to their own account. When they receive a customer order to buy a security, they sell that security out of their inventory in the same manner as an automobile dealer sells you a car off the lot. When they receive a customer order to sell, dealers buy that security for their inventory. Once again, similar to an automobile dealer who buys your old clunker from you. Test topic alert. Disclosure of the capacity in which the broker-dealer acted is always required on the trade confirmation. Learning Objective 23E. Describe the costs of trading securities. Trading costs. Commissions. Buying and selling securities is not without cost. As described above, there are two ways in which broker-dealers function: as brokers or as dealers. As brokers, they are acting as their clients' agents, and as is typical in any business, agents charge a commission for their service. In other words, when an investor buys a security, the broker's commission will be added to the investor's purchase price. Likewise, when an investor sells a security, the broker's commission will be deducted from the investor's proceeds. Markup and markdown. When selling from their inventories, dealers charge the buying customers a markup rather than a commission. When buying for their inventory, dealers charge the selling customers a markdown. They buy for less than they can sell it for. Think about what happens when the auto dealer buys your used car from you and what it sells for on the lot a week later after they've cleaned it up. Take note. The term principal has several meanings in the securities industry. A broker-dealer acts as a principal in a dealer transaction. A principal of a firm is a person who acts in a supervisory capacity. Principal can also mean the face value of a bond or an asset in a trust. Example. A firm cannot make a market in a stock, mark up that stock, and then add an agency commission. If the firm acts as a broker, it may charge a commission. If it acts as a dealer, it may charge a markup or markdown. Violation of this practice is called making a hidden profit. Broker acts as an agent, transacting orders on the client's behalf. Dealer acts as a principal, dealing in securities for its own account and at its own risk. Broker charges a commission. Dealer charges a markup or markdown. Broker is not a market maker. Dealer makes markets and slash or takes positions, long or short, in securities. Broker must disclose its role and the amount of its commission to the client. Dealer must disclose its role to the client, but not necessarily the amount or source of the markup or markdown. Take note. An easy way to remember these relationships is to memorize the following letters. DPP brokers act as agents for commissions, /dealers act as principals for profits. ABCD agents that are brokers for commissions that must be disclosed. Practice question. When viewing several of your clients' trade confirmations, you notice that a recent purchase was made of ABC stock where there was no commission indicated, while a sale took place of DEF stock in which the commission listed was $55. From this information, you could determine that Roman numeral 1. A BC was purchased in an agency transaction. Roman numeral 2. A BC was purchased in a principal transaction. Roman numeral 3. DEF was sold in an agency transaction. Roman numeral 4. DEF was sold in a principal transaction. A 1 and 3. B 1 and 4. C 2 and 3. D 2 and 4. The answer is C. Whenever a trade is made without a commission indicated on the confirmation, it means that a markup or markdown was charged. That makes it a dealer or principal transaction. Commissions are always disclosed on agency transactions. Therefore, we know that a BC2 was purchased in a principal transaction and DEF3 was sold in an agency transaction, so the correct match is choice C. Bids, offers, and quotes. A firm quote is a market maker's current bid and offer on a security. The current bid is the highest price at which the dealer will buy, and the current offer is the lowest price at which the dealer will sell. The difference between the bid and ask is known as the spread. A general rule is, the more active the stock, the narrower the spread. This concept plays out in our everyday life, because those products that move off the shelves quickly, think about milk, eggs, and bread in the grocery store, tend to have a lower retail markup than items that move slowly, such as antiques and fine art. We have mentioned earlier that higher markups or commissions on thinly traded, not highly active, securities would generally not be in violation as long as they are properly disclosed. In most cases, a market maker's quote will also include the size that indicates the number of shares the quote is good for. For example, a quote of 45 to 45.28 by 10 means that the dealer is offering 1,000 shares for sale at $45.20 and is ready to buy 800 shares at $45. If not stated, the quote is firm for a single round lot, 100 shares. Remember, when acting in a principal capacity, there are no commissions added. This should help you regarding the prices received or paid by BDs and investors. Bid price. BD or market maker buys at and investor receives. Ask or offer price. BD or market maker receives and investor pays. Practice question. If WXYZ is quoted as 43.25 to 43.50, it means that the bid price, the price that a customer would receive for her shares, is $43.25 and the ask price, the price that the customer would pay to buy shares, is $43.50. The 25-cent difference is the dealer's spread. Alternatively, the examiner might put it like this. A broker-dealer quotes a stock 42 to a half. The difference between these two numbers is known as A. The broker's commission, B. The dealer's markup, C. The profit margin, D. The spread. The answer is D. The dealer's quote represents the bid and the offer, ask prices. This quote is 42 bid and 42.50 offered. The difference between these two is the spread. Markup is added to the higher price, the ask or offering price. Test topic alert. If a client has U.S. Treasury bonds, she wishes to sell and receives a quote of $104.22, which represents the bid price, don't select an answer choice that says a premium. It is a premium, but that is not as good an answer. Knowledge Check 23.3. Question 1. When viewing several of your client's trade confirmations, you notice that a recent purchase was made of ABC stock where there was no commission indicated, while a sale took place of DF stock in which the commission listed was $55. From this information, you could determine that Roman numeral 1. A BC was purchased in an agency transaction. Roman numeral 2. A BC was purchased in a principal transaction. Roman numeral 3. DEF was sold in an agency transaction. Roman numeral 4. DEF was sold in a principal transaction. A. 1 and 3. B. 1 and 4. C. 2 and 3. D. 2 and 4. The correct answer is C. Whenever a trade is made without a commission indicated on the confirmation, it means that a markup or markdown was charged. That makes it a dealer or principal transaction. Commissions are always disclosed on agency transactions. Therefore, we know that a BC2 was purchased in a principal transaction and DEF3 was sold in an agency transaction. Question 2. To fill a customer buy order for 600 ABCD shares, your firm requests a quote from a market maker for 600 shares. The response is bid 18, ask 18.15. If the order is placed, the market maker must sell A. 100 shares at $18.15 per share. B. 600 shares at no more than $18 per share. C. 600 shares at $18 per share. D. 600 shares at $18.15 per share. The correct answer is D. A market maker is responsible for honoring a firm quote. If no size is requested by the inquiring trader, a quote is firm for 100 shares. In this example, the trader requested an 800-share quote, so the market maker is responsible for selling 6 round lots of 100 shares at the ask price of $18.15 per share. Lesson 23.4. Types of orders. Learning Objective 23F. Identify the features and uses of market, stop, and limit orders and short sales. Order trade ticket. Many types of orders are available to customers. The type will be indicated on the order ticket. SEC rules require preparation of order tickets before order entry. Required disclosures include the account number, whether the order is solicited, unsolicited, or discretionary, including time or price. If a sale, whether long or short. The terms and conditions of the order, market, limit, or stop. The number of shares of a stock, and if a bond, aggregate par value, but not rating or current yield. The time of order entry, execution time and execution price will be added, and the name of the broker-dealer and identity of the registered individual who accepted the order or is responsible for the account. Test topic alert. 2 items that would not be on an order ticket are the current market price of the security and the client's name or address. Order types. Price. Orders that restrict the price of the transaction include the following. Market. Executed immediately at the market price with no restrictions. Limit. Limits the amount paid or received for securities. Stop. Becomes a market order if the stock reaches or goes through the stop price. Stop limit. entered as a stop order and changed to a limit order if the stock hits or goes through the trigger price. Time. Limit orders based on time considerations include the following. Day. Expires if not filled by the end of the day. Good till canceled. Does not expire until filled or canceled. Practice question. Which of the following types of orders does not restrict the price at which an order is executed? A. Limit. B. Stop. C. Market. D. Stop limit. The answer is C. A market order does not reflect or restrict the price at which a security is executed. A limit order limits the amount to be paid or received for securities. A stop order becomes a market order if the stock reaches or goes through the stop price. A stop limit order becomes a limit order if the stock hits or goes through the trigger price. Market orders. A market order is sent immediately to the floor for execution without restrictions or limits. It is executed immediately at the current market price and has priority over all other types of orders. A market order to buy is executed at the lowest offering price available. A market order to sell is executed at the highest bid price available. Those prices are usually referred to as the inside market or inside quote. As long as the security is trading, a market order guarantees execution. Limit orders. In a limit order, a customer limits the acceptable purchase or selling price. A limit order can be executed only at the specified price or better. Better means lower in a buy order and higher in a sell order. If the order cannot be executed at the market, the order is left with the specialist, now called the DMM, who records the trade in the order book and executes the order if and when the market price meets the limit order price. A customer who enters a limit order risks missing the chance to buy or sell, especially if the market moves away from the limit price. The market price may never go as low as the buy limit price or as high as the sell limit price. Test topic alert. If any part of an order can be filled at the limit price, it is done. For example, if a day limit order to buy 400 shares at $22.45 is turned in, and all that can be executed at that price or better is 200 shares before the market closes, that sale is confirmed and the order for the balance is canceled. Short sales. Selling short is a technique to profit from the decline in a stock's price. The short seller initially borrows stock from a broker-dealer to sell at the market. The investor expects the stock price to decline enough to allow him to buy shares at a lower price and replace the borrowed stock at a later date. Unless the stock price declines to zero, the short seller is obligated to buy the stock and replace the borrowed shares to close the short position. Because of this borrowing, a margin deposit is required. Therefore, short sales can only take place in a margin account. Short sales are risky because if the stock price rises instead of falls, an investor still must buy the shares to replace the borrowed stock and a stock's price can rise without limit. Therefore, the position has unlimited risk. Stop orders. A stop order, also known as a stop-loss order, may be entered to protect a profit or prevent a loss if the stock begins to move in the wrong direction. The stop order becomes a market order once the stock trades at or moves through a certain price known as the stop price. Stop orders for listed stocks are usually left with and executed by the specialist, DMM. A trade at or through, lower in the case of a sell stop, higher in the case of a buy stop. The stop price triggers the order, which then becomes a market order. As a market order, there is no assurance of any specific price. The order may wind up being executed at above or below the stop price. A stop order takes two trades to execute. Trigger. The trigger transaction at or through the stop price activates the trade. Execution. The stop order becomes a market order and is executed at the market price, completing the trade. Stop limit order. A stop limit order is a stop order that, once triggered, becomes a limit order instead of a market order. Example. An order that reads sell 100 COD at 52 stop, 5150 limit, means that the stop will be activated at or below 52. Because a 5150 limit applies, the order to sell cannot be executed below 5150. Take note. The uses of buy and sell stop orders are summarized below. Buy stop orders might be called stop buy on the exam. Protect against loss in a short stock position. Protect a gain from a short stock position. Establish a long position when a breakout occurs above the line of resistance, i.e., stock prices rise above historic high levels. Sell stop orders might be called stop sell on the exam. Protect against loss in a long stock position. Protect a gain from a long stock position. Establish a short position when a breakout occurs below the line of support, Stock prices decline below low level. Mechanics of a stop order. As stated above, it takes more than one trade for a stop order to be executed. The first of those, the trigger, occurs whenever the subject security trades at or through the stop price. In the case of a buy stop order, through means at a higher price. In the case of a sell stop order, through means at a lower price. Then, once the order has been triggered, unless it is a stop limit order, the next price in the market is the one at which the trade is executed. It will probably be easier to follow if we display an example. Example. A client enters a buy stop order for 100 shares of XYZ at 40. Trades then occur at 38.39, 39.90, 40.05, 40.10, and 39.78. What price did the client pay for the stock? The order will be triggered as soon as the price gets to 40 or higher. That would be the trade at 40.05. At that time, a market order is entered and the client pays the next price, which could be more or less than 40. In this case, the next price is 40.10, and that is the price per share paid by the client. We're ignoring any commissions. How is this different for a stop limit order? If we change the above example to make the order, buy stop at 40, limit 40, then the client is stating that once the order has been triggered, enter a limit order and do not pay any more than 40 for the stock. Once again, the order is triggered with the trade at 40.05, but now, because a limit order has been placed, we can't buy on the next trade. 40.10 is too high. However, the following trade at 39.78 allows us to meet the client's limit of paying no more than 40 for the stock. Practice question. A client order is received with the following instructions. Buy stop 100 shares of BC at 34, limit 34.20. After the order is submitted, trades occur at 33, 33.90, 34.10, 33.85, 34.05, and 34.25. More than likely, the client paid A. 33.85, B. 34.05, C. 34.10, D. 34.25. The answer is A. This is two orders in one. The first does not become triggered until the price gets as high as 34. That happens at 34.10. Once triggered, a buy limit order at 34.20 is entered, pay 34.20 or less, and the trade at 33.85 meets that requirement. Market manipulation. In Unit 14, we discuss the prohibitions against market manipulation. Here are some additional cases that will make more sense now. Capping. This is the act of entering sell orders in a stock for the purpose of keeping the stock from rising above the sale price when one is short the stock. If successful, the stock will stay below the strike price, and the short position will be profitable. The opposite of this is supporting, where purchase orders are entered in an attempt to keep the price of a stock from falling when one has a long position. Pegging. This is a generic term that applies to any activity intended to keep the price of a stock from moving. This can involve entering either buy or sell orders or both. For example, a short straddle rider will profit most if the stock price and strike prices of the position are the same at expiration, that is, the short options are right at the money. Test topic alert. There is a danger in using stop orders in that once they are triggered, the marketplace receives an increase of sell orders in a falling market and buy orders in a rising market. This can have the tendency to accelerate the direction of the market, sell stops in a bearish market, or buy stops in a bullish one. Take note. An interesting legal question arises when an agent becomes aware of M1PI after a stop order is triggered, but prior to execution. Unless the agent has reason to suspect that the client was acting on that information, the order can proceed as normal because it was received prior to the agent becoming aware of the information. Block trade. NICE Rule 72 defines a block as at least 10,000 shares or $200,000 USD, whichever is less. Thus, for stocks priced at less than $20, a 10,000 share trade can be a block, but in higher priced stocks, even a 1,000 share trade could constitute a block. Learning Objective 23G. Describe high-frequency trading, HFT, and dark pools. High-frequency trading. Over the past 10 years, high-frequency trading, HFT, has gone from a small niche strategy in financial markets to the dominant form of trading. It currently accounts for well over half of the trading volume in U.S. equity markets and 40% in European equity markets, and is quickly growing in Asian fixed income, commodity, foreign exchange, and nearly every other market. Although a precise definition of HFT does not exist, It is generally classified as autonomous computerized trading that seeks quick profits using high-speed connections to financial exchanges. The objective of HFT is to take advantage of minute discrepancies in prices and trade on them quickly and in huge quantities. As computers get more technically advanced, trading practices have increased in size, and algorithms have become more sophisticated. The trades are done at close to the speed of light. In fact, HFT firms have moved their servers to be near an exchange computer to further increase trading speeds. Regulators across the globe are spending considerable effort deciding if and how to regulate AFT. On the one hand, HFT appears to make markets more efficient. Algorithmic trading in general, and AFT specifically, increases the accuracy of prices and lowers transaction costs. On the other hand, HFT appears to make the financial system as a whole more fragile. The rapid fall and subsequent rise in prices that occurred in U.S. markets on May 6, 2010, known as the flash crash, when the Dow Jones Industrial Average plunged about 1,000 points in a matter of minutes, was in part due to HFT. Because HFT firms do not openly disclose their trading activities, it has so far been unclear how and why HFT produces these outcomes, a circumstance that has greatly increased the controversy surrounding its existence. A typical objective of high-frequency traders is to identify and capture minute price discrepancies present in the market. They do so with no human intervention, using computers to automatically capture and read market data in real time, transmit thousands of order messages per second to an exchange and execute, cancel, or replace orders based on new information on prices or demand. In most cases, the trades are executed before individual investors know the quotes of prices, or that the trades happen at all. For example, a computer recognizes when one exchange quotes an asked price of 1 cent more than the quote on another exchange. This computer then trades in extraordinarily large volumes on this information, taking advantage of the arbitrage opportunity in a split second. Before individual and other investors who do not possess the same sophisticated technology realize it, the 1 cent spread between the two exchanges is erased and the stock price trades at the same level. Benefits of HFT: increased liquidity in the markets, especially for more active stocks. Market efficiency price differences are arbitraged away, leading to narrower spreads. Reduced costs, especially for institutional purchasers such as mutual funds. Negatives of HFT: market manipulation with a huge volume that can be generated. HFT traders entering phony trades that are later canceled can prompt market activity that would not have happened had these HFT traders not manipulated the market to their advantage. Harm to small investors: they do not have access to the same trading information anywhere near as soon as the HFT traders. Snowballing effect of HFT: for years, one of the problems with stop orders was the acceleration of a downward move when sell stop orders were triggered. With HFT, the volume is so much greater that this movement, as we saw in the flash crash, has been magnified. Take note: HFTs rely on very low latency for their algorithmic trading schemes. Low latency is just a fancy way of saying quick trading. It's not unusual nowadays to have a DMA, direct market access. Customer enter and have executed 5,000 or 6,000 orders or more in 1 second. Trades are being executed and reported in microseconds. AFT customers are the most likely customers to be provided by their broker-dealers with DMA, which bypasses the firm's trading desk. This kind of DMA trading is called low or no-touch. No-touch doesn't mean no obligation. The broker-dealers still have an obligation to monitor their DMA customers' behavior. No broker-dealer can throw its hands up and say to the regulators, "We didn't know what they were doing." Dark pools. Dark pools, sometimes referred to as dark pools of liquidity, or simply dark liquidity, are trading volume that occurs or liquidity that is not openly available to the public. The bulk of this volume represents trades engaged in by institutional traders and trading desks away from the exchange markets. Generally, these are large volume transactions that occur on crossing networks or alternative trading systems, ATS, that match buy and sell orders electronically for execution without routing the order to an exchange or other market where, quote, last sale price and volume information is displayed. Institutional trading desks that choose to use dark pools are able to execute large block orders without impacting public quotes or price, or revealing their investment strategy regarding any of their holding accumulations or divestitures. Additionally, orders can be placed anonymously, so that the identity of the entity placing the order is unknown to the general investing public, along with the volume and price for the transaction. The concern with dark pools is that some market participants are left disadvantaged because they cannot see the trades, volume, or prices agreed upon within the pools, and thus market transparency is darkened. Dark pools account for about 17% of the trading volume in the U.S. stock market. Here are some points you should try to remember about dark pools. Benefits of dark pools. Orders entered can't be seen by other market participants before the trade occurs. There is no risk of information leakage. An execution venue with high pre-trade transparency is called a lit venue, for example, national stock exchanges. Negatives of dark pools. Traders can't see orders on the other side of the trade, so they do not know the pre-trade likelihood of execution. Knowledge check 23.4. Question 1. A customer enters an order to sell 100 BCT at 49 stop limit. Prior to the order, BCT was trading at 49.25. Subsequent trades are reported on the tape as follows: TCB 49.10, 48.75, 48.85, 49, 49.25. Which trade triggered the order? A. 48.75, B. 48.85, C. 49, D. 49.25. The correct answer is A. This is an order where the stop price and limit price, stop, limit, are the same. A sell stop limit order is triggered, elected, by the first trade that is at or below the stop price. It is subsequently executed at a price at or better than the limit price. 2. A dark pool would most likely be used by A. a market manipulator, B. a high-frequency trader, C. an institution, D. a retail investor. The correct answer is C. Dark pools are favored by institutions because of the anonymity they give to the institution's trading.
Unit 24. Insurance-based products. Learning objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 24A, Contrast Fixed and Variable Annuities. Learning Objective 24B. Compare variable annuities and mutual funds. Learning Objective 24C. Calculate the account return for an index annuity. Learning Objective 24D. Compare the different purchase and settlement options for annuities. Learning Objective 24E. Calculate the tax on an early withdrawal from an annuity. Learning Objective 24F. Compare the major types of life insurance. Learning Objective 24G. Recognize the special characteristics of variable life insurance. Your exam will include approximately 2 questions from the topics covered in Unit 24. Introduction. In Unit 3, we discussed a number of different pooled investment vehicles. In this unit, we're going to cover 2 more: variable annuities and variable life insurance. But those are not the only insurance-based products that are relevant to this exam. Even though the others we'll discuss are not securities, understanding what they are and their basic features are testable items. Lesson 24.1. What are annuities? Although many products offered by insurance companies are not securities, the securities professional should be aware of the features of both securities and non-securities offerings. Learning Objective 24A, Contrast Fixed and Variable Annuities. Annuities. An annuity is generally a contract between an individual and a life insurance company, usually purchased for retirement income. An investor, the annuitant, pays the premium in one lump sum or in periodic payments. At a future date, the annuitant can either elect to surrender the policy and receive a lump sum payout or begin receiving regular income distributions that will continue for life. Because all earnings are tax-deferred, many individuals looking to accumulate additional funds for retirement find annuities to be a valuable tool. Unlike IRAs and qualified retirement plans covered in Unit 18 that limit the amount that can be contributed, there is no legal limit to the amount that can be invested in an annuity. The insurance company may place a limit, generally in the range of $1 to $3 million, that it will accept. Annuity contracts are classified into 2 major types, depending on the guarantees offered: fixed annuities and variable annuities. Test topic alert. For exam purposes, every annuity is non-qualified. Contributions are made with after-tax dollars, unless stated otherwise. Fixed annuities. A fixed annuity guarantees a fixed rate of return. When the individual elects to begin receiving income, the payout is determined by the account's value and the annuitant's life expectancy based on mortality tables. A fixed annuity payout remains constant throughout the annuitant's life. Although principal and interest are not at risk, A fixed annuity risks loss of purchasing power because of inflation. Take note. Because the insurance company guarantees the return and the annuitant bears no risk, a fixed annuity is an insurance product and not a security. A salesperson must have a life insurance license to sell fixed annuities, but does not need to be securities licensed. Example: an individual who annuitized a contract in 1990 may have been guaranteed a monthly payout of $800. Decades later, this amount may prove insufficient to live on. Variable annuities. Instead of purchase payments being directed to the insurance company's general account, money deposited in a variable annuity is directed into one or more subaccounts of the company's separate account. Although the options include money market securities and bonds, purchase payments are frequently invested in a stock portfolio, which has the greater potential gain of a variable annuity involves more potential risk than a fixed annuity because it invests in securities rather than accepting the insurance company's guarantees. Payouts may vary considerably because an annuity unit's worth fluctuates with the value of the selected subaccounts. Fixed annuities. Monthly payout is fixed, guaranteed interest rate, investment risk assumed by insurance company, portfolio of fixed income securities and mortgages, general account, vulnerable to inflation and insurance regulation. Variable annuities. Monthly payout varies, variable rate of return, investment risk assumed by annuitant, portfolio of equities, debt, money market instruments, separate account, resistant to inflation, and insurance and securities regulation. Practice question. The key difference between a fixed annuity and a variable annuity is that the fixed annuity: A. Offers a guaranteed return. B. Offers a monthly payment that may vary in amount. C. Will always pay out more money than a variable annuity. D. Attempts to offer protection to the annuitant from inflation risk. The answer is A. If an annuity is fixed, it means the return to the investor is guaranteed, whereas with a variable annuity, there are no guarantees as to the amount of return. It is the variable annuity whose annuity payment will vary and because of the growth opportunity offers potential inflation protection. Separate account. The contributions that investors make to a variable annuity are kept in a separate account from the insurance company's general funds. Some insurance companies' separate accounts offer 25, 30, or even more subaccounts, from the most aggressive to the most conservative. Investors determine the subaccounts into which their money will be placed. Because the investor rather than the insurance company bears the risk, a variable annuity is considered to be a security. As a consequence, variable annuity salespersons must have both a securities license, registered with a broker-dealer member of FINRA and the applicable state or states, and an insurance license issued by the appropriate states. Test topic alert. It is the performance of the specific subaccounts selected by the investor that determines the investment return. Learning Objective 24B. Compare variable annuities and mutual funds. In the eyes of many novice investors, there doesn't seem to be very much difference between a mutual fund and a variable annuity. Although there are many similarities, there are critical differences. The following chart is a good place to begin. Principal features of mutual funds versus variable annuities. Mutual funds. Investment company product, shares, investment objectives, varied, no guarantees, redeemed by issuer, price based on formula, voting rights. Variable annuities. Insurance company product, units, investment objectives, varied, some guarantees, redeemed by issuer, price based on formula, voting rights. Looking at the above chart, there doesn't seem to be much difference other than one being an insurance product with some guarantees and the other not. The following discussion applies to non-qualified annuities, those which are not included in a qualified retirement plan, such as the 403B plan covered in Unit 18. Let's look a bit deeper. Advantages of investing in variable annuities compared to mutual funds. Tax-deferred growth. All income and capital gains generated in the portfolio of the separate account are free from income tax until the money is withdrawn. Over time, this tax-deferred compounding can make a significant difference in the value of the account. Guaranteed death benefit. Most variable annuities offer an option stating that if the investor dies during the accumulation period, the beneficiary will receive the greater of the current value of the account or the amount invested. Therefore, the estate is assured of getting back at least the original investment. Lifetime income. Although a variable annuity cannot guarantee how much will be paid, choosing a payout option with lifetime benefits gives assurance that there will be a check every month as long as the annuitant is alive. This benefit protects against longevity risk, the uncertainty that one will outlive one's money. Be sure that you don't refer to this as guaranteed income. That would be an incorrect statement on the exam, because the income is variable. IRS Section 1035 Exchanges. If you don't like the annuity you're in, you can exchange into another one without any tax consequences. However, it is possible there will be a surrender charge. This is unlike mutual funds, for which use of the exchange privilege is a taxable event. No age restrictions or requirements. Unlike traditional retirement plans that have required minimum distributions after the age of 72, an investor can delay withdrawals as desired and, in fact, can continue to contribute. Please note that annuities are always non-qualified unless something in the exam question indicates otherwise. No contribution limits. Unlike retirement plans, where the annual contribution is limited, no IRS ceiling is placed on the amount that may be invested into a fixed or tax-free transfer between subaccounts. Unlike mutual funds, where the exchange between funds is a taxable event, the investor can transfer from one subaccount to another without any current tax liability. No probate. Because the annuity calls for direct designation of a beneficiary, upon death, the asset passes directly without the time and expense of probate. Disadvantages of investing in variable annuities compared to mutual funds. Earnings are taxed as ordinary income. Even though it is possible that the majority of the increase in value is generated through long-term capital gains, all earnings will be taxed at the higher ordinary income rate. The administrative and insurance-related expense fees are typically much higher than the fees incurred by owning a mutual fund. Withdrawals made before age 59.5 will generally incur a 10% penalty, in addition to the ordinary income tax on that portion of the withdrawal representing the earnings. Most variable annuities carry a conditional deferred surrender sales charge. Therefore, surrender in the early years will usually involve additional costs. Test topic alert. A variable annuity offers an investor the opportunity to have tax-deferred participation in the equity markets, albeit with expenses that are generally higher than for a mutual fund with a similar objective. Practice question. The test topic alert. Shown above represents an idea that is commonly tested. It could look something like this. When comparing mutual funds and variable annuities, it would be correct to state that A, both offer tax-deferred growth of earnings. B, both require that the salesperson possess a securities license and an insurance license. C, the surrender charges on a mutual fund are usually higher than on a variable annuity. D, the expense ratio of the variable annuity is usually higher than that of a comparable mutual fund. The answer is D. It is generally correct to state that variable annuities offer a way to accumulate funds on a tax-deferred basis, although generally with operating expenses somewhat higher than mutual funds with the same investment objective. There is no tax deferral with mutual funds, and an insurance license is not required to sell them. Only Class B and C shares have back-end fees, a form of surrender charge, and they are invariable lower and slash or run for fewer years than annuity surrender charges. Knowledge Check 24.1. Question 1. When comparing fixed and variable annuities, which of the following statements applies solely to variable ones? A. Payments guaranteed for life. B. Level payout each month. C. Owner's contribution goes into a separate account. D. Issued by a life insurance company. The correct answer is C. The major difference between fixed and variable annuity policies is the existence of the separate account for VA purchasers. This separate account is what makes a VA a security. Both guarantee payments for life, and both are issued by insurance companies. It is the fixed annuity with a level payout each month. Question 2. When comparing mutual funds and variable annuities, it would be most correct to state that A. Both permit tax deferral of earnings in the account. B. Neither are traded in the secondary markets. C. The expense ratio of mutual funds tends to be somewhat higher than variable annuities. D. Mutual funds are generally invested equities, while variable annuities are invested in debt. The correct answer is B. Both mutual funds and variable annuities are redeemable by the issuer. That being the case, there is no secondary trading. You can't buy a mutual fund or a variable annuity on a stock exchange or OTC. It is the variable annuity that offers tax deferral and has a higher expense ratio. When it comes to portfolio holdings, both funds and separate accounts have offerings covering the gamut of securities. It is the fixed annuity where the money goes to the insurance company's general account, and that is primarily invested in debt instruments. Lesson 24.2 Index Annuities. Learning Objective 24C. Calculate the account return for an index annuity. Index annuity. In an effort to overcome the purchasing power risk of fixed annuities, but without the market risk of the variable annuity, the industry developed the index annuity IO. This product is sometimes called an equity index annuity or a fixed index annuity. Indexed annuities, IAs, are currently popular among investors seeking market participation with a guarantee against loss. Unlike a traditional fixed annuity, an index annuity credits interest to the owner's account using a formula based on the performance of a particular stock index, such as the S&P 500. If the index does well, the annuitant is credited with a specified percentage of the growth of the index, typically 80% or 90% of the growth. This is known as the participation rate. If, over the life of the annuity, the index does poorly, the annuitant may receive the IA's minimum guaranteed return, typically 1 to 3%. In addition to the participation rate, there is usually a cap rate. A typical cap might be 8%. This means that if your annuity was pegged to the S&P 500 and that index increased 20% during the year, your gain would be capped at 8%. One other negative characteristic of these products is that they tend to have longer surrender charge periods, as long as 15 years, than other annuities, especially if there is a front-end bonus. Example. To give you an idea of how an index annuity might work, consider one with a participation rate of 80%, a cap rate of 8%, and a minimum guarantee of 2%. If the index shows growth of 9% during the index annuity's measurement period, the annuitant would be credited with 7.2% growth, 80% of 9%, which is less than the cap of 8%. However, if the index grew at a rate of 12%, the participation rate of 80% would yield 9.6%, but because that is over the 8% cap, the account would only be credited with 8%. In any year where the index declines, the annuitant's account is not credited with any earnings, but, and this is the real benefit, the account does not lose any value either. The 2% guaranteed rate would apply if, over the term of the annuity, performance was less than 2%. Take note. Although index annuity is the preferred term in the industry, your exam may refer to this product as an equity index annuity. Test topic alert. In NASA's never-ending battle to try to baffle potential investment advisor representatives with questions about products they will most likely never handle, we are hearing from students that you should know the different crediting methods used for index annuities. Without going into the technicalities, it seems all you have to know is the different types, not a lot about how they work. The purchaser can be offered the following choices as to how growth in the underlying index will be credited in the form of interest to the account. 1. Annual reset. In this method, the interest to be credited to the account is computed by comparing the index value at the end of the year to the value at the beginning of the year, hence the term annual. Annual reset generally has a lower participation rate than point-to-point. 2. High water mark. In this method, the highest value reached by the index between anniversary dates of the annuity is compared to the value at the beginning of the year. This option can provide the greatest gain. 3. Point-to-point. In this method, the interest is computed based on the value of the index at the end of the contract compared to the beginning. 4. Averaging. The most common is a monthly average, and this can be the best option when markets are expected to be highly volatile. Knowledge Check 24.2. Question 1. An investor purchased an equity index annuity. The terms of the contract call for a 90% participation rate with an 11% cap. If during the measurement period the index increased by 13.2%, the investor's account would be credited with A. 9.90%, B. 11.00%, C. 11.88%, D. 13.20%. The correct answer is B. Here's the math. The account participates to the extent of 90% of the 13.2% increase, which is 11.88%. However, there is a cap limiting the amount to be credited to 11%. Therefore, that is what this investor's account receives. Question 2. An investor purchased an index annuity. The terms of the contract call for a 100% participation rate with a 6% cap. If during the measurement period the index decreased by 4.0%, the investor's account would A. Decrease by 4%, B. Decrease by 6%, C. Remain at the same level, D. Increase by 4%. The correct answer is C. One of the selling features of index annuities is that their value increases when the underlying index increases, but it does not fall when the index reports negative returns. As a practical matter, many of these products offer a minimum guaranteed return, but unless it is stated in the question, you can't assume there is one. Lesson 24.3. Purchasing and withdrawing from annuities. Learning Objective 24D. Compare the different purchase and settlement options for annuities. Purchasing annuities. Insurance companies offer a number of purchase options to make it easy for annuity owners to accumulate money. Deferred annuity. An annuity may be purchased with a single lump sum investment, with payout of benefits deferred until the annuitant elects to receive them. This type of investment is referred to as a single premium deferred annuity. Periodic payment deferred annuity. A periodic payment deferred annuity allows a person to make periodic payments. The contract holder can invest money on a monthly, quarterly, or annual basis, with payout of benefits deferred until the annuitant elects to receive them. Accumulation stage. The pay-in period for a deferred annuity is known as the accumulation stage. There is no accumulation period for an immediate annuity. During the accumulation stage of an annuity contract, the contract terms are flexible. An investor who misses a periodic payment is in no danger of forfeiting the preceding contributions. The contract holder can terminate the contract at any time during the accumulation stage, although the contract holder is likely to incur surrender charges on amounts withdrawn in the first 5 to 10 years after issuance of the contract. Accumulation units. An accumulation unit is an accounting measure that represents an investor's share of ownership in the separate account. An accumulation unit's value is determined in the same way as the value of mutual fund shares. The unit value changes with the value of the securities held in the separate account. Immediate annuity. An investor may purchase an immediate annuity contract by depositing a single lump sum. The insurance company begins to pay out the annuity's benefits immediately, usually within 60 days. Unlike deferred annuities, there is no accumulation stage, so there are no accumulation units. The deposit acquires annuity units only. The names of various purchase options are quite descriptive of how they operate and should not be difficult to follow. Just to be sure, let's try the following question. Practice question. Insurance companies selling annuities offer a variety of purchase options to owners. Which of the following definitions regarding these annuity options is not correct? A. Accumulation annuity, an annuity that allows the investor to accumulate funds in a separate account before investment in an annuity. B. Single premium deferred annuity, an annuity with a lump sum investment, with payment of benefits deferred until the annuitant elects to receive them. C. Periodic payment deferred annuity allows a person to make periodic payments over time. The contract holder can invest money on a monthly, quarterly, or annual basis. D. Immediate annuity allows an investor to deposit a lump sum with the insurance company. Payout of the annuitant's benefits starts immediately, usually within 60 days. The answer is A. Accumulation does not refer to a purchase option. The pay-in period for an annuity is known as the accumulation stage. A single premium deferred annuity is an annuity with a lump sum investment, with payment of benefits deferred until the annuitant elects to receive them. Periodic payment deferred annuities allow a person to make periodic payments over time. Immediate annuities allow an investor to deposit a lump sum with the insurance company. Payout of the annuitant's benefits starting immediately, usually within 60 days. Bonus annuities. It is not uncommon for index annuities and variable annuities to offer a bonus on top of the investor's initial contribution. For example, investing $60,000 into a single premium annuity with a 5% bonus would result in an account balance of $63,000. Usually, bonus annuities have surrender charges lasting longer than those without the bonus. Receiving distributions from annuities. The payout period for an annuity is known as the annuity stage. It happens when the owner of the annuity annuitizes. Annuity payout options. It is now time for the contract holder to decide on the settlement option. An annuity offers several payout options for amounts accumulated in the annuity contract. The investor can let the money accumulate in the annuity, withdraw the accumulated funds in a lump sum, or withdraw the accumulated funds periodically by annuitizing the contract. Annuitizing occurs when the investor converts from the accumulation pay-in stage to the distribution payout stage. The decision to annuitize the contract locks in the specified payout option. The contract holder may not change it. Annuity payout options in order from largest monthly payout to smallest monthly payout follow. Life annuity, straight life, pure life. Under this option, the payout is structured so that the annuitant receives periodic payments, usually monthly, until death. No added options or benefits exist. Therefore, for a given amount of funds, this option provides the largest periodic payment. Life annuity with period certain. Under the life annuity with period certain payout option, an annuitant receives payments for life with a certain minimum period guaranteed. If the annuitant dies before the period certain expires, payments continue to the annuitant's named beneficiaries for the period certain. If the annuitant lives beyond the period certain, payments continue until the annuitant's death. Example: a client purchases a life annuity with a 10-year period certain payout. The insurance company guarantees payments for the life of the annuitant or 10 years, whichever is longer. If the annuitant lives for only 1 year after payments begin, the company continues to make payments to the annuitant's beneficiaries for 9 more years. If the annuitant dies after receiving payments for 13 years, payments cease at death. Joint life with last survivor annuity. With this option, the annuity covers 2 or more people and the payout is conditioned on both all lives. Example: a married couple owns an annuity jointly with a last survivor clause. The contract pays benefits as long as one of the annuitants remains alive. The payment may be the same as when both were alive, or it may be reduced for the surviving annuitant, depending on the contract. If this option includes more than 2 annuitants, payments cease at the last survivor's death. Refund annuity. Sometimes referred to as a unit refund annuity, under this settlement option, payments will continue after death of the insured until the full value of the initial premium, principal, has been returned. In some cases, the payment to the beneficiary will be a lump sum of cash, and in others, a series of monthly payments. Mortality guarantee. Annuity companies guarantee payments for as long as annuitants live. If a change occurs in life expectancy and annuitants live longer than originally anticipated, the insurance companies assume the increased mortality cost the mortality guarantee. Practice question: which of the following types of annuity settlement options provides a lifetime income to the annuitant regardless of how long he lives and the highest monthly payment amount? A. Straight life annuity. B. Life annuity with period certain. C. Installment refund annuity. D. Joint and survivor annuity. The answer is A. A straight life annuity provides a lifetime income to the owner/annuitant regardless of how long he lives. If the annuitant is fortunate to outlive his anticipated life expectancy, he has made a wise distribution choice. However, if he dies shortly after beginning distribution, he has made an imprudent choice because after the annuitant dies, the issuer makes no further payments. Nevertheless, for a given purchase price, a single life annuity provides the highest monthly payment amount because the annuity provides no guarantees beyond the annuitant's life. Annuity units. When a variable annuity contract is annuitized, accumulation units are exchanged for annuity units. An annuity unit is a measure of value used only during an annuitized contract's payout period. It is an accounting measure that determines the amount of each payment to the annuitant during the payout period. The number of annuity units is calculated when an owner annuitizes the contract. The number of annuity units liquidated each month does not change. It is fixed at the time of annuitizing based on the value of the contract when the payout period begins and on other variables, such as the payout option selected, the individual's age and sex, and assumed interest rate. The payment the annuitant will receive each month varies because each unit's value fluctuates with the separate account portfolio's value. This is, after all, a variable annuity. Assumed interest rate, AIR. The assumed interest rate, AIR, is a basis for determining distributions from a variable annuity. The rate, usually estimated conservatively, provides an earnings target for the separate account. Simply put, if the actual earnings exceed the AIR, the annuity payments increase. If they fall short of the AIR, the payments decrease. Example: an investor who annuitized a variable annuity in 1990 and began with a monthly payout of $375 might now be receiving $2,275 per month because of an increase in the value of the annuity unit. Learning Objective 24E: calculate the tax on an early withdrawal from an annuity. Premature withdrawal. Contributions to an annuity that is not part of an employer-sponsored retirement plan, qualified annuities, are made with after-tax dollars, non-qualified. Because contributions have been taxed already, when the account is annuitized, the portion of each payment representing a return of the original principal is not taxed. As with other investments, the money invested in an annuity represents the investor's cost basis. The primary advantage of an annuity as an investment is that the tax on interest, dividends, and capital gains is deferred until the owner withdraws money from the contract. On withdrawal, the amount exceeding the investor's cost basis is taxed as ordinary income. Partial or full withdrawals. One of the rights of the holder of an annuity contract is the ability to withdraw funds. A partial withdrawal is, as the term implies, when the policyholder requests part of the value of the account. A full withdrawal is when the request is to terminate the contract and receive all of the available funds. Random and full withdrawals from annuity contracts, remember all annuities are non-qualified unless stated to the contrary, are taxed under the last in, first out, LIFO method. Earnings are presumed by the IRS to be the last monies to hit the account. The earnings are considered to be withdrawn first from the annuity and are taxable as ordinary income plus a 10% penalty if the investor has not reached 59.5. After the withdrawal of all earnings, contributions representing cost basis may be withdrawn without tax. The penalty does not apply if the funds are withdrawn after age 59.5, are withdrawn because of death or disability, or are part of a life income option plan with fixed payouts. The contract is annuitized. Example: a contract with a $100,000 value consists of $40,000 in contributions and $60,000 in earnings. If the investor withdraws all $100,000 at once, the $60,000 in earnings is taxed as ordinary income and the $40,000 cost basis is returned tax-free. If the investor is at least 59.5, there is no 10% tax penalty. If younger, the 10% tax penalty applies. However, the penalty only applies to the taxable portion, $60,000. There is never a penalty tax on money that is not taxable. If the investor withdraws $10,000 or any amount up to $60,000, under the LIFO rule, it is considered a withdrawal of earnings and will be taxed as ordinary income. If a partial withdrawal of $50,000 is made, the entire withdrawal consists of earnings and is taxable. There is never a capital gain with an annuity. Test topic alert. Yes, it is true. Even when the distribution is from a non-qualified annuity, if it is made before the age of 59.5, it is subject to the 10% additional tax, unless it meets one of the exceptions listed above. Annuitizing. Annuitized payouts are typically made monthly and are taxed according to an exclusion ratio. The exclusion ratio expresses the percentages of the annuity's value upon annuitization of contribution basis to the total. Under certain circumstances, the annuitant's life expectancy may also factor in the exclusion ratio, but that is unlikely to be tested. We're just keeping it simple. Example: if $50,000 in after-tax dollars was contributed to an annuity contract worth $100,000 at annuitization, 50% of each payment will be treated as ordinary income, whereas the other 50% of each payment will be treated, for tax purposes, as non-taxable return of basis. Test topic alert. Upon annuitization, there is never a 10% tax penalty, even if annuitization commences prior to age 59.5. Knowledge Check 24.3. Question 1. All of the following statements concerning categories of annuities are correct except A. A deferred annuity is one in which the first benefit payment is made one payment interval after the date of purchase. B. An annuity may be paid periodically in a fixed amount for a period determined by the purchaser. C. A joint and last survivor annuity provides income that ceases upon the last death among the covered lives. D. A straight life annuity provides periodic, usually monthly, income payments that continue as long as the annuitant lives and terminate at the annuitant's death. The correct answer is A. A single premium immediate annuity is one in which the first benefit payment is made one payment interval after the date of purchase. That is not the case with a deferred annuity. Annuities provide lifetime income, although some are set up to pay out over a specified number of years. Question 2. After the death of the annuitant, beneficiaries under a life and 15-year period certain option are subject to A. Capital gains taxation on the total amount of payments received. B. Ordinary income taxation on the total amount of payments received, plus a 10% withdrawal penalty if the annuitant was under age 59 and a half. C. Ordinary income taxation on the amount of the payout that exceeds the cost basis based on the exclusion ratio. D. Tax-free payout of all remaining annuity benefits. The correct answer is C. Payments from the annuity to the beneficiary through a period certain option are taxed in the same way as other periodic annuity payments. Benefits over the amount of the cost basis are taxable as ordinary income. However, no 10% penalty applies in this situation. Lesson 24.4 Life Insurance Policies. Learning Objective 24F. Compare the major types of life insurance. A life insurance policy is a contract between an insurance company and an individual that is designed to provide financial compensation to the named beneficiaries in the event of the insured's death. In exchange for payment of premiums, the insurance company agrees to pay the proceeds of the policy, the death benefit, upon the death of the insured. Many types of life insurance contracts are available. Each type serves a different need. We will focus more attention on those contracts that use separate accounts to fund the death benefits and those that are considered securities, as defined by the Securities Act of 1933. Term insurance. Term insurance is protection for a specified period, hence the description term. Term insurance provides pure protection and is the least expensive form of life insurance. The important facts about term life insurance policies include the following. They provide temporary insurance protection for a specified period of time, the policy term. For example, the term may be 1 year, 5 years, 10 years, 30 years, or to a specified age, such as age 65. They pay the death benefit only if the insured dies during the term of coverage. For example, a person buying a 20-year term policy at age 35 who dies at 56 will receive nothing. They do not accumulate cash value. The death protection and premium remain level for the specified term. For example, a $100,000 5-year term policy provides a death benefit of $100,000 any time during that 5-year term. If renewed at the end of the term, the face amount remains the same, but because the new premium is based upon the insured's attained age, renewal premiums always increase. Term insurance has a variety of useful applications. One of the most common uses for term is to provide a substantial amount of coverage at a minimum cost. Because term insurance provides pure protection, it allows a person with a limited income to purchase more coverage than might otherwise be affordable. This is particularly important when there is a clear need for additional protection, particularly in the case of younger people who are married with children. Test topic alert. For test purposes, younger people with children are better off purchasing term insurance because the lower premiums allow significantly more protection. For those age 60 and older, the rates are generally prohibitive. Whole life insurance, GBLI. A type of permanent or cash value insurance. Whole life insurance, GBLI, provides protection for the whole of life. Coverage begins on the date of issue and continues to the date of the insured's death, provided the premiums are paid. The benefit payable is the face amount or face value of the policy, which remains constant throughout the policy's life. The premium is set at the time of the policy's issue and it, too, remains level for the policy's life. As with all life insurance policies, the insured can choose how to spread out the premium payments, known as the mode. Premiums can be paid annually, semi-annually, quarterly, or monthly. Please note that ordinary life or straight life are synonyms for whole life. Cash values. Unlike term insurance, which provides only a death benefit, whole life insurance combines a death benefit with an accumulation or a savings element. This accumulation, commonly referred to as the policy's cash surrender value, increases each year the policy is kept in force. In traditional whole life insurance, the insurer invests reserves in conservative investments, for example, bonds, real estate, mortgage loans. Because of the low risk of such investments, the insurer can guarantee the policy's cash value and the non-forfeiture options that are based on that cash value. Traditional life insurance reserves are held in the insurer's general accounts. Policy loans. Once an insured has accumulated cash value, it cannot be forfeited. An insured may cash in a policy at any time by surrendering it in exchange for its cash value. An insured may also borrow a portion of the cash value in the form of a policy loan, but this must be paid back with interest in order to restore policy values. When a policy owner takes a cash value loan, the amount borrowed and any accumulated interest due on the loan become an indebtedness against the policy. If the insured dies before the loan has been repaid, any indebtedness will reduce the face amount of the policy. Accordingly, it will be subtracted from any death benefit. Policy dividends. Some whole life policies, known as participating policies, may pay dividends to the policy owner. These are not the same kind of dividends as we've covered throughout this course. Simply put, they are a return of the excess premiums charged on these policies. Because policy dividends are a return of premium, they are not taxable. Uses of whole life. The principal advantage of whole life is that it is permanent insurance and accordingly can be used to satisfy permanent needs such as the cost of death, dying, and final burial expenses. The level premium allows the policy owner to always know exactly what the cost of insurance will be, and basically offers a form of forced savings. Whole life builds a living benefit through its guaranteed cash value that enables the policy owner to use some of this cash, through policy loans, for emergencies as a supplemental source of retirement income, and for other living needs. The principal disadvantages of whole life insurance are that the premium paying period may last longer than the insured's income-producing years, and it does not provide as much protection per dollar of premium as term insurance. Whole life versus term. Whole life insurance has a guaranteed interest rate on cash value buildup. Whole life insurance builds cash value with ability to borrow. Whole life insurance remains in effect until age 100 as long as premiums are paid. Term insurance will provide the highest face amount for the lowest premium. Term insurance does not build cash value. Term insurance provides coverage for a specific period of time. It is pure protection. Practice question. A 30-year-old client indicates that he needs $500,000 of life insurance coverage for the next 20 years. The lowest out-of-pocket cost would be if he purchased a 20-pay life policy, B 20-year level term policy, C whole life policy, D variable annuity with an extended death benefit. The answer is B. In almost all circumstances, certainly for short to immediate time periods, term life will be the least expensive form of insurance. A 20-pay life is a permanent policy where the premiums are paid in a 20-year period rather than until death. Variable annuities are not life insurance policies even though they are issued by life insurance companies. Surrendering the policy. If the policy owner decides to stop paying the premiums, the policy owner may surrender the policy for its cash value, take a reduced paid-up policy where the death benefit is decreased and future premiums are no longer required, or take extended term insurance, which pays the beneficiaries the full face amount if death occurs within a specified time period. Universal life insurance. Universal life insurance was developed in the late 1970s in response to the relatively low interest rates, generally 3.5 to 5%, earned by traditional whole life insurance cash values, which made the whole life product less attractive during periods of high inflation. In order to be more competitive, insurers introduced universal life policies that might pay higher interest rates, such as 8%, 10%, or even 12%, during inflationary times. These policies also provide greater flexibility because they allow policy owners to adjust the death benefits and slash or premium payments based on their current needs assessment. A universal life policy is similar to a whole life policy in the sense that it has the same two components, death protection and cash value. However, instead of being fixed and guaranteed amounts, the death protection resembles one-year renewable term insurance, and the cash value grows according to current interest rates. Characteristics of universal life. Premium payments are separated, with the first being paid toward the insurance protection and the remaining balance being used to build the cash value with interest. The policy owner may increase or decrease the death benefit during the policy term, subject to any insurability requirements. Premium amounts may be changed as long as enough premium is paid to maintain the policy. This is why universal life is known as flexible premium life. In fact, it is even possible to skip premium payments as long as there is sufficient cash value in the policy to keep it in force. The interest earned by the cash account will vary, subject to a guaranteed minimum. Universal life is not a security. Variable universal life, VUL, or universal variable life, UVL, two ways of saying the same thing, is a security because of the variable. Universal life interest rates. Universal life contracts are actually subject to two different interest rates, the current annual rate and the contract rate. The current annual rate varies with current market conditions and may change every year. The contract rate is the minimum guaranteed interest rate, and the policy will never pay less than that amount. For example, if the guaranteed contract rate is 5% and the current rate is 8%, the cash account would grow by the higher 8% during that year. But if the current rate falls below 5%, the cash account would still grow by the minimum rate of 5% during that year. Universal life death benefits. Generally, there are two options available regarding the death benefit payable under a universal life policy. Option 1, also known as Option A, provides a level death benefit equal to the policy's face amount. As the policy's cash value increases, net death protection actually decreases over the life of the policy, which makes the policy structure similar to a whole life contract. The major advantage of Option 1 is that the premiums are lower for the same face amount of death coverage. The trade-off is that the level death benefit will not keep pace with inflation. Option 2, also known as Option B, provides for an increasing death benefit equal to the policy's face amount plus the cash account. In terms of policy structure, this contract is more like a combination of level term insurance and increasing cash value than whole life insurance. The primary advantage of universal life insurance Option B is that cash values grow more quickly over time. The cash values accumulate more quickly because of the higher initial premiums and lower initial death benefit. Because the premiums are higher and the death benefit is initially lower, a greater portion of the premium is added to the policy cash value, which then grows interest-free inside the contract. Take note. With the original universal life policies, it was common that the flexibility of premium payments caused policies to lapse, with the result that one could not truly say there was a guaranteed death benefit. Because of this, most insurers today offer a guaranteed death benefit universal life, where the policy is guaranteed not to lapse if the sum of the premiums paid, less any loans or partial withdrawals and partial withdrawal fees, is greater than or equal to the sum of the minimum monthly premiums required. As a result, one can say that a universal life insurance policy has at least some guaranteed death benefit. Universal life policy loans. Universal life provides for cash value loans in the same manner that whole life or any permanent plan of insurance does. If a loan is taken, it is subject to interest, and, if unpaid, both the interest and the loan amount will reduce the face amount of the policy. Uses of universal life. This is a form of permanent insurance that can build cash values, hopefully at a rate greater than with traditional whole life. There is typically a guaranteed minimum interest rate stated in the policy, usually around 2%, which means that no matter how the investments perform, there will be a known minimum return on the investment. The unique feature is the flexibility to adjust the death benefit as needs change, as well as the flexibility to pay smaller or larger premiums as financial conditions dictate. However, if the premium payments are reduced to the point where they can no longer support the policy, a lapse could occur. Another use of the flexibility of the premium payments is to overfund the policy, particularly when Option 2 has been chosen, that is, pay premiums in excess of those required, with that excess going into the savings portion of the policy. This can have the effect of greatly increasing the cash value, money that may be borrowed out of the policy without tax consequences if done properly. This is beyond the coverage of this course. Practice question. All of the following are advantages of universal life insurance except A. The ability to adjust the amount of premium payments. B. The policy is guaranteed never to lapse. C. The ability to change the death benefit amount. D. When the cash value is sufficient, no premium payment is required. The answer is B. A universal life policy may lapse if the accumulation fund drops below a specified level and an additional premium is not paid. Universal life has flexible premiums, and when there is sufficient cash value in the policy, premiums may be skipped, with the premium payments taken from that cash value. Variable life insurance. Variable life insurance differs from whole life insurance with regard to where the premium is invested. In the case of whole life insurance, the premiums are invested solely in the insurance company's general account. On the other hand, in a variable life insurance (VLI) policy, the general account receives an amount equal to the actual cost of the life insurance, and the portion in excess of that is invested in a separate account. The separate account has a number of subaccounts with varying objectives, giving the insured some choice from highly aggressive, think mostly common stock, to highly conservative, think bonds and money market instruments. The purpose is to let the customer assume some investment risk in an attempt to get inflation protection for the policy's death benefit. Cash value in the policy fluctuates with the performance of the chosen subaccounts in the separate account and is not guaranteed. Variable life policies provide policy owners with a minimum guaranteed death benefit. The benefit may increase above this minimum amount, depending on investment results, but may never fall below. Also, remember what was said earlier about variable annuities being securities requiring those who sell them to be duly licensed, insurance and securities. The same is true for those who wish to sell variable life insurance. Flexible Premium Variable Life Universal. Universal Variable Life Insurance, UVL or VUL, is a type of variable life insurance with flexible premiums and thus a flexible death benefit. Premiums are invested only in a separate account, and there is only a variable death benefit. The insured has the option to increase, skip, or reduce premium payments, though he must maintain a minimum cash value, and the death benefit is adjusted appropriately. Scheduled Fixed Premium Variable Life. A scheduled premium or fixed premium VLI contract is issued with a minimum guaranteed death benefit. The premiums for some variable life contracts are flexible. This is discussed next under Variable Universal Life. A scheduled premium VLI contract's death benefit is determined at issue and evidence of insurability is required. The premium is calculated according to the insured's age and sex and the policy's face amount, guaranteed amount, at issue. Once the premium has been determined and the expenses have been deducted, the net premium is invested in the separate accounts, subaccounts the policy owner selects. Deductions from the premium. Deductions from the gross premium normally reduce the amount of money invested in the separate account. The greater the deductions, the less money available for the investment base in the separate account. Charges deducted from the gross premium include the administrative fee, the sales load, and state premium taxes, if any. The administrative fee is normally a one-time charge to cover the cost of processing the application. The maximum allowable sales load on variable life insurance is the equivalent of an average of 9% of premium per year computed over a 20-year period. The sales charge may be front-end loaded to 50% of the first year's premium, but must average out to 9% over a 20-year period. Because of the front-end loading, there are special sales charge refund rights for the first 2 years, spelled out in the Investment Company Act of 1940. Deductions from the separate account. Deductions from the separate account normally reduce the investment return payable to the policy owner. Charges deducted from the separate account include mortality risk fee, cost of insurance, expense risk fee, and investment management fee. The mortality risk fee covers the risk that the insured may live for a period shorter than assumed. The expense risk fee covers the risk that the costs of administering and issuing the policy may be greater than assumed. And of course, the investment management fee is the cost of the management of the chosen separate accounts, subaccounts. Take note. The exam may ask you which charges are deducted from the gross premium and which are deducted from the separate account, the net premium. Remember the acronym SAS to make it simple. The charges deducted from the gross premium are sales load, administrative fee, and state premium taxes. Any other charges, such as cost of insurance, expense risk fees, and investment management fees, are deducted from the net premium, which is invested in the separate account. Variable life insurance death benefit. The death benefit payable under a variable life insurance policy consists of two parts: a guaranteed minimum provided by the portion of funds invested in the general account and a variable death benefit provided by those invested in the separate account. The guaranteed minimum does not change, but total benefit, including the variable portion of the death benefit, must be recalculated at least annually. The effect that a change in earnings has on the contract's variable death benefit depends on comparison of actual account performance and the performance assumed by the insurance company. If the separate account returns are greater than the assumed interest rate (AIR), additional funds are available to the insured. These extra earnings are reflected in an increase in the death benefit. If the separate account returns equal the AIR, actual earnings meet estimated expenses, resulting in no change in benefit levels. Should the separate account returns be less than the AIR, the contract's death benefit may decrease. However, it may never fall below the amount guaranteed at issue. Take note. If a variable life insurance policy has a minimum, stated, death benefit, the premiums necessary to fund this part of the death benefit are held in the insurer's general account. Any policy benefit that is guaranteed is invested in the insurer's general account. Any premium above what is necessary to pay for the minimum death benefit is invested in the separate account. This portion of the premium is subject to investment risk. The death benefit will grow above the minimum guaranteed amount if the separate account performs positively. The death benefit will never be less than the minimum guarantee, even if the separate account performs poorly. Take note. With positive performance in the separate account, the death benefit will increase. If this is followed by several periods of performance that fails to equal the error, the death benefit will decline, but never below the minimum guarantee. If the decline has been steep enough, it may take several periods of positive results before the death benefit increases again. Variable life insurance cash value. The policy's cash values reflect the investments held in the separate account. Unlike the death benefit, the individual policy's cash value must be calculated at least monthly. The cash value, like the death benefit, may increase or decrease depending on the separate account's performance. However, because the cash value is not based on any assumed interest rate error, any positive performance will result in cash value growth. If performance has been negative, the cash value may decrease to zero, even if the contract has been in force for several years. The cash value cannot be negative, but the insurance company keeps track of negative performance. Therefore, like the death benefit, the cash value may not increase until prior negative performance has been offset. Test topic alert. The error has no effect on cash value accumulation in a variable life policy. The cash value will grow whenever the separate account has positive performance. The error, however, does affect the death benefit. If the separate account performance for the year is greater than the error, the death benefit will increase. If the separate account performance for the year is equal to the error, the death benefit will stay the same. If the separate account performance for the year is less than the error, the death benefit will decrease, but never below the guaranteed minimum. Test topic alert. You may see a question that asks about the frequency of certain calculations associated with variable life insurance policies. Know that death benefits are calculated annually, cash value is calculated monthly, and separate account unit values are calculated daily, in the event there is a withdrawal of cash value. Comparison of whole life and variable life policies. Whole life. Scheduled premium, fixed death benefit, premiums to general account, guaranteed cash value. Variable life, VLI. Scheduled premium, minimum guaranteed plus variable death benefit, premiums to general and separate accounts, no guaranteed cash value. Universal variable life, UVL or VUL. Flexible premium, variable death benefit, premiums to separate account, no guaranteed cash value. It must be emphasized that variable life insurance must be sold as life insurance, not as an investment. However, the ability to commit a portion of the premium to investor-selected separate account subaccounts makes this form of insurance unique. There is a guaranteed minimum death benefit, but if separate account performance merits such, the death benefit can increase to keep pace with inflation. Cash values, although not guaranteed, can also increase based upon that performance. As with any variable product, the investor bears the investment risk rather than the insurance company. Comparison of life insurance policies. Death benefit. Level term expires at end of term. Whole life, fixed and level. Universal life, adjustable, level, or increasing options. Variable life varies with investment performance. Original face amount is guaranteed minimum. Variable universal life, adjustable, level, or increasing options. Premiums. Level term, fixed schedule, increases at each renewal. Whole life, fixed schedule, level amount. Universal life, flexible schedule, flexible amount. Variable life, fixed schedule, level amount. Variable universal life, flexible schedule, flexible amount. Cash values. Level term, none. Whole life, fixed and guaranteed. Universal life, current interest with guaranteed minimum rate. Variable life, varies with investment performance, no guaranteed minimum, and at risk for loss. Variable universal life, varies with investment performance, no guaranteed minimum, and at risk for loss. Learning Objective 24G. Recognize the special characteristics of variable life insurance. Variable life policy loans. Like traditional whole life insurance, a VLI contract allows the insured to borrow against the cash value that is accumulated in the contract. However, certain restrictions exist. Usually, the insured may only borrow a percentage of the cash value. The minimum percentage that must be made available is 75% after the policy has been in force for 3 years. If the death benefit becomes payable during any period that a loan is outstanding, the loan amount is deducted from the death benefit before payment. The interest rate charged is stated in the policy. Test topic alert. Several testable facts about policy loans are as follows. A minimum of 75% of the cash value must be available for a policy loan after the policy has been in force for 3 years. The insurer is never required to loan 100% of the cash value. Full cash value is obtained by surrendering the policy to the insurer. If the insured dies with a loan outstanding, the death benefit is reduced by the amount of the loan. If the insured surrenders the contract with a loan outstanding, cash value is reduced by the amount of the loan. Variable life insurance contract exchange. A unique feature of variable life insurance is the ability for the insured to have a change of heart. During the early stage of ownership, you have the right to exchange a VLI contract for a form of permanent insurance issued by the company with comparable benefits, usually whole life. The length of time this exchange privilege is in effect varies from company to company, but under no circumstances may the period be less than 24 months federal law. The exchange is allowed without evidence of insurability. If a contract is exchanged, the new permanent policy has the same contract date and death benefit as the minimum guaranteed in the VLI contract. The premiums equal the amounts guaranteed in the new permanent contract as if it were the original contract. Test topic alert. 3 testable facts about the contract exchange provision are listed here. The contract exchange provision must be available for a minimum of 24 months. It could say 2 years on the exam. No medical underwriting, evidence of insurability, is required for the exchange. The new policy is issued as if everything were retroactive. That is, the age of the insured as of the original date is the age used for premium calculations for the new policy. Variable life insurance voting rights. Unlike any other type of life insurance, variable life contract holders have voting rights. Contract holders receive 1 vote per $100 of cash value funded by the separate account. As with other investment company securities, changes in investment objectives and other important matters may be accomplished only by a majority vote of the separate account's outstanding shares or by order of the State Insurance Commissioner. Test topic alert. Do not confuse the voting rights of variable annuities and variable life. Variable annuities and mutual funds are the same. 1 vote per unit, share. Variable life is 1 vote per $100 of cash value. Knowledge Check 24.4. Question 1. Which of the following is indicative of the primary difference between variable life insurance and straight whole life insurance? A. Amount of insurance that can be issued. B. Cost of the insurance. C. Tax treatment of the death proceeds. D. The way in which the cash values are invested. The correct answer is D. Variable life insurance allows the policy owner to decide how the cash value is invested through a number of subaccounts. With a whole life policy, all investment decisions are made by the insurance company. Question 2. On July 15, 2019, your client purchased a variable life insurance policy with a death benefit of $500,000. The November 2021 statement showed a cash value of $30,000. If the client wanted to borrow as much as possible, the insurance company would have to allow a loan of at least A. $0, B. $15,000, C. $22,500, D. $27,000. The correct answer is A. Until a variable life policy is in force for a minimum of 3 years, this one is a bit less than 2.5 years. There is no requirement to make the loan provision available. Once the 3-year mark is reached, that minimum becomes 75% of the computed cash value.
This concludes the Series 65 audiobook, 12th edition by Kaplan, published on YouTube by Collective Colin.